chart, Pippa, and wonder when their prices were going to come down. And I was just looking at a chart from the St. Louis Fed saying that, nat gas prices are having an increasingly muted impact on the actual price consumers pay for electricity because of all the demands on the grid and the need for CapEx.
That's right. So one thing, of course, we have to remember that Henry Hub is a regional benchmark. And so, if you really want a more accurate look at what the price of natural gas actually is, you have to look around the country, like Algonquin City Gates, for example, into the Northeast. But the reason why these power prices get so high is because they do have to pay everyone what that marginal supplier is. And those marginal suppliers are what's known as peaker plants. They only come online at times of extreme stress, and they are very expensive to operate. And they typically are owned by private equity firms, and maybe they only operate for, say, 2 days a year. And during those 2 days, they capture so much money that then it's fine to be offline for the rest of the year. And so that's why, as the demands on the grid grow, it's more about what is the marginal cost for supply versus what is the natural gas price. That's becoming an increasingly smaller share of the overall bill. Because when you think about utilities, you also have to think about all their input costs, things like labor, their power prices. All of those costs are going up. And so that's also feeding into our electric bills. Now, we're not going to feel the entirety of this power price spike because utilities typically are hedged to a certain extent, maybe a third on 10 years, a third on 3 to 5 year contracts, and a third in the spot market. But, this makes the case for more generation needing to be added to the grid, which then they can earn a rate of return on that rate base.
Yeah, for sure. Hopefully, maybe just a couple days of this white knuckling to get through, Pippa, this high demand period. Let's now turn to the bond market. The 10-year yield starting the week at 437 has risen to more than 448 as it digested a lot of data along the way. Let's turn to Rick Santelli in Chicago. Hi, Rick.
Hi, Mike. Indeed. If you look at a week to date, what should jump out at you is right towards the middle of that chart. Wednesday, jolts, boom, yields popped up on that 10-year. They've stayed elevated. As a matter of fact, the markets closed early today. But if you look at how they closed, it's pretty fascinating. We are unchanged on the day in the 10s. However, on the week, we're up 11 basis points. Now, throw in the 2-year. The 2-year gave most of the jolts Wednesday back, and it hovered right around down 4 basis points on the close, up 5 on the week. Why is this important? Well, we had fewer jobs and a lower unemployment rate. The 2-year seemed to concentrate on the fact that probably the easing cycle's over, but no decision on tightening, whereas the 10-year, well, even though it peaked, as you look at this chart going back to April, it peaked at 467 in May. It is definitely still elevated because inflation is elevated, even though it might not be accelerating but decelerating. And one other thing, looking at that chart, where's all the bottoms there to the left and now to the right? Right around the mid-430s. Mid-430 support, 467 resistance, and dollar yen. Finally, we see the yen bounce a bit. That chart's a week to date of the dollar. So after hitting 40-year highs midweek, we did see a little give back in front of the holiday weekend. Melissa, back to you.
Rick, thanks. Have a good 4th. Rick Santelli. Let's stay on jobs now. While today's number is being viewed by some as Goldilocks for the Fed, there are still lingering questions about the impact that AI will continue to have on the jobs market. While professional and business services, social assistance, and healthcare all saw gains, the technology sector saw declines in June, specifically in the IT industry. That was down 3.3% from May. Joining us now is Torsten Slok, Apollo Global Management Chief Economist, who is just back from Portugal. He was at the meeting of the central bank heads. Torsten, great to see you.
Thank you.
I'm glad you made it back from Portugal all safe and sound. In terms of what we're seeing in the jobs reports, it was 17 of the past 18 months we saw declines in information technology payrolls. Is that the impact from AI?
Well, there's probably a lot of things going on. I mean, generally speaking, exactly as you say, it was a Goldilocks report where we still have steady, strong job growth. It was not as good as the market had expected. And we also had the unemployment rate going down, which was better than what the market had expected. And in terms of the composition, yes, maybe some of that is because the tech sector has been slowing a bit down. It could be because of AI implementation. It could also be because jobs in the tech sector have already been fairly elevated for quite some time. So there's several reasons why it could be that the tech sector specifically did show some weakness.
And in terms of AI in general being a potential source of risk, is it that it's a risk to job creation, or is it a risk that there's a tremendous amount of capex going on? We don't really know if there's malinvestment along the way, and if that goes away or if that gets reduced, then that all of a sudden decelerates the whole economy.
Well, from a market perspective, there are really three reasons why AI is playing such a big role. First of all, exactly, if AI does begin to slow down for whatever reason, either that people begin to worry about that it's not delivering the ROI that people expected, it could also be because we're not seeing the implementation as quick as people expected. All those things could ultimately result in simply less capex over time, not necessarily the next several quarters. A lot of the financings have already been in place, but that would mean a GDP forecast where growth would ultimately begin to slow down. But the second reason, of course, which is very important, is what we're seeing in markets and what you just spoke about, namely the rotation away from the high concentration that we've had now for several years, where the 10 biggest stocks still make up about 40% of the index. That would also have very significant implications if AI does not deliver on the expectations that people have, both in public and in private companies. And finally, it also becomes important for demand for treasuries, because hyperscaler issuance in the belly of the curve at about $700 billion in issuance this year is crowding out demand for treasuries. So that means that fixed income managers that have to buy investment grade credit, they can either buy hyperscaler debt, they can buy financials, or they can buy US treasuries. Now, if there's less dollars going to US treasuries, that means that there's just more money that's going to hyperscaler debt, and that also begins to have implications if AI does not deliver. So there's a number of reasons, not only on GDP, but also for financial markets, that could potentially become very important if AI does not deliver on the high expectations that are currently in markets.
There's a lot at stake. I mean, a lot is riding on this AI boom, Torsten, in terms of the risks to the economy. Do you see the risks outweighing? I mean, how do you sort of view the risks in terms of the balance of risks here?
Yeah, because the challenge is that if AI does not succeed, in other words, if we do not see the ROI coming as quickly as we are all hoping and expecting, if that happens to take a longer time, we will, of course, begin to see some valuations, especially the Magnificent Seven, come down quite significantly. And that's a problem because they have such a high concentration in the S&P 500. So if AI underdelivers, we have a problem. But if AI overdelivers and the unemployment rate goes to 10, 20%, we will also have a problem, because in that case, we will have a lot of people who do not have money for consumption. The unemployment rate will be high. And if that's the case, GDP will also be slowing down in a significant way, but in this case, driven more by the consumer. So that's why there's a fairly narrow path where AI can succeed, because if it underdelivers, we have problems. If it overdelivers, we have problems. So that's why the markets discussion here is all about what's the likelihood that we walk on the narrow path where we will not have the case where things either go wrong to the downside or go wrong to the upside.
There was some discussion, certainly, at the conference in Portugal, I'm sure, along with, an interview that we had with Kevin Warsh about productivity, what we should expect out of it, when we might expect to see benefits, and what that means for Fed policy.
Absolutely. Sarah had the interview with Warsh, of course, and the other central bank governors on the stage. And the key response that he did that he gave exactly to this question was that he did expect productivity gains to come along. But he, of course, also talked about the task forces. He talked about communication policy. He didn't give any forward guidance, but he did give the little hint that he did think that inflation had been come down, and therefore inflation risk to inflation had been moving lower, which makes a lot of sense given where oil prices have gone. But the conversation was indeed also in all the discussions in the panels in Central really about what is the outlook for AI, not only for the US, but Europe is far, far behind when it comes to AI. So therefore, what can Europe do to catch up to the AI investments that we have in the US? So there was a lot of discussions that really centered around this broader issue of what is the outlook for AI. That's why the conversations we are having at the moment about what is the earnings that are coming, what are the earnings that are coming from these companies, is absolutely critical over the next several quarters.
But it does sound, Torsten, like you're saying that the path is so narrow for AI to succeed and the impact on the economy to be good, that it's actually kind of frightening. I mean, it sounds like there are more scenarios than fewer scenarios where AI will negatively impact the economy.
Well, and you have, in the last 48 hours, had several guests on your shows that have talked about the downside risks. But let's not forget that there's also the upside risk that AI is being implemented. Companies are investing a lot. We are all seeing our lives change because of AI. So we will see dramatic changes in the economy. The question is just what is the speed of those changes? And that's what the market is betting on at the moment.
Torsten, thank you. Good to talk to you as we just see options trading close for the day with the closing bell at CBOE. OpenAI is reportedly offering the U.S. government a 5% stake in the company worth more than $42 billion. The proposal suggests other AI companies could also offer a stake, but Anthropic and the Trump administration have yet to discuss any plans. The proposal comes as AI firms face growing concern over cybersecurity vulnerabilities and Chinese competition, while OpenAI and Anthropic are planning to go public. Is this what's best for OpenAI investors? Joining us now is Brett Winton. He is chief futurist at ARK Invest. He also helps manage the ARK Venture Fund and owner of OpenAI and others. And Brent, good to see you. And how are you thinking about this? I mean, on one level, I guess it would dilute investors in OpenAI out to some degree and maybe constrain what they can do. But is it smart strategically or politically?
Well, it's very clear that AI generally, OpenAI and SpaceX XAI, Anthropic, all of which are in our venture fund, by the way, these are geopolitically important technologies. And so I can understand why people are focusing on them they're also macroeconomically important technologies. This is important for American competitiveness going into the future. And I do think already American people have a stake in kind of like how quickly these companies can develop and how they can commercialize. It's better for us macroeconomically. All of the data centers that are being built here to support these AI models are great for jobs. The previous speaker said, hey, if AI succeeds too much, you'll have high rates of unemployment. That's hogwash. This is an amazing macroeconomic boom that we're going to experience because of the diffusion of AI across the economy. Now, strategically, it might be wise to create some fund that has like AI equity so that people feel like they have the benefit of AI, lining their own pockets. I think that the companies going public could be another mechanism by which you can achieve broad ownership of these companies. And to be frank, like the reason we created our venture fund and allow anybody to invest, not just, accredited investors who have to hit certain wealth thresholds, was to allow people to have access to these meaningful, monumental companies.
Does this, in your view, in any way stunt the competitiveness of American AI? I mean, does it create sort of this ring fence around U.S. AI where we don't have to compete against China because they're going to limit potentially, for instance, Microsoft's ability to run a Chinese open source model on its platform and sort of create these artificial barriers?
I do think, well, one, at a first principles perspective, I think AI companies should be treated like any other company, as in every company has to pay corporate tax rates, and every company can't break the law. And we have laws in place. If you sell a gun and then somebody uses the gun to murder somebody, the person who did the murdering is the person who's liable. I think the same should apply to AI. If you use an AI tool to steal from somebody or to do something, you, the person who enabled that, should be liable, not the underlying company. And if we try to restrict the acceleration of these companies, it does give companies in China, which are essentially distilling our models at some years removed. So they're effectively stealing the IP from the US AI companies and then operating as if, hey, you can have this for free. And there are some embedded risks in those models. For instance, they could embed in the weights mechanisms that kind of sway or potentially strategically impair companies at an inopportune time. So there is a risk to, I think, adopting that software without appropriate safeguards. But I think that broadly, there should not be the government picking winners and losers here. As in, even within the US, we have a vested interest in XAI, OpenAI, and Anthropic, both in our venture fund and in our ETFs, in OpenAI's case. And I think a level playing field where everybody can compete will result in the best outcome for certainly Americans, but really for the whole world. And that's what I'd advocate for.
So are you saying, Brett, that Chinese open source models are stealing from closed models in the United States?
I mean, this is pretty well documented, as in if I systematically ask a frontier model questions, I can figure out some of the underlying magic behind it, how it's answering questions, and then compress it into my own model. So I don't have to pay the R&D costs that OpenAI or Anthropic did to get nearly frontier class performance. Now, there are things that Anthropic and OpenAI and AI are doing to try to protect themselves from that attack vector, but it definitely exists, and it's a way that open weight models have been, keeping touch with, albeit not in competition with, the frontier.
Brett, you own all three or have an interest in Anthropic, OpenAI, XAI, you said. Does that mean that you're indifferent as to how this plays out in terms of which one wins? Is there likely to be one that turns into the industry standard in some respect or kind of the base level model for what we're looking at in the future?
I mean, there certainly could be. We think of the frontier model kind of layer of the value chain as being worth $15 to $20 trillion by 2030. And I think those three companies are all jockeying for that position. It's likely that there is a handful of players, just like there is in the infrastructure as a service space, and that the margin structure looks very similar. So on the enterprise side, I don't think it's likely to be a winner take all. I do think there are some platform-like characteristics that could allow one company to position itself ahead of the others, but ultimately it will resolve into how much compute they control on an underlying basis. On the consumer side, likely to be winner take all, and their OpenAI is extraordinarily well positioned versus the Google and the Metas of the world. And so we see that as almost a $10 trillion opportunity alone by 2030. So you can think of collectively the AI opportunity for these frontier model companies across enterprise and consumer being on the order of $20 to $25 trillion in enterprise value. And that's why the companies underwrite well for us as exposures in the venture fund. So, we do very careful price targeting over 5 and 10 years. And we think that they are really incredible places to deploy capital today. People look at the valuations, they say, these are very large. And they're very large because the opportunity is monumental. And this goes back to the macroeconomic point. I think this is going to be a remarkable half decade of macroeconomic growth. That's going to be great for jobs, not negative for jobs. So I'm profoundly bullish both on AI and on the U.S. in terms of competitiveness with the world.
Spoken like a chief futurist. Brett, thank you.
Thanks.
Brett Winton. This wouldn't be the first time the Trump administration has taken a stake in a private company. According to the Council on Foreign Relations, the government has participated in more than 30 deals, committing over $26 billion in direct investment, while catalyzing another $7 billion from the private sector. Most of those investments have been concentrated in semiconductors, critical minerals, and quantum technology. The standout has been Intel. The government acquired a 9.9% stake in August 2025 at just under $21 a share. Intel closing today above $120 a share, making that investment one of the program's biggest winners. Joining us now is Council on Foreign Relations Senior Fellow for Geoeconomics, Jonathan Hillman. Jonathan, great to have you with us. This is a sort of unprecedented, I would imagine. I mean, most of the time governments take stakes in companies at a time of duress and a time of economic duress. Does this make sense in your view, or is this something that we should be concerned about, that the government is taking such an active role in investing?
So this would be a unique investment, even for the Trump administration, which, as you point out, according to our data at the Council on Foreign Relations, we're tracking 30 deals that the administration has done that involve equity or quasi-equity. Most of those deals, the vast majority of them, have been done in areas that lack sufficient private capital. These are strategically important areas like critical minerals, semiconductors, quantum computing, and others, where there is not enough private sector investment going to those places, given how strategically important they are to the U.S., given not only their commercial importance, but their applications and capabilities for military uses. This OpenAI proposal, I think, is quite different, right? You're talking about a company that's very well capitalized, that is preparing for an IPO that will attract even more money. And yes, of course, AI is strategically important, but it's hard to see the market failure here and the case for the government being involved to attract additional investment.
Well, I guess then what do you think the case is? Clearly, it seems to be political protection, or at least making sure from OpenAI's perspective that they're not restrained or otherwise penalized by a government that has shown misgivings about the development of AI and when it comes to Anthropic or something.
It does feel less like industrial policy and more like political insurance. And because on the industrial policy side of things, again, yes, it's a strategically important area, but there is not an absence of investment going to this area. In fact, Thorsten, for example, was arguing, this is actually quite the opposite, right? And so, one of the arguments has been, let's give Americans a slice of the upside in AI. And I think we need to remember here that I don't know when the last time is that you looked at your retirement account, but if you've got an S&P 500 index, you've got lots of AI exposure. You've got an emerging markets index, you've got lots of AI exposure. And increasingly, if you've got a bond index, you've got growing AI exposure. So I don't think the question is necessarily how do we give Americans more exposure to AI? We should be thinking also about how to protect them if indeed this is a bubble that bursts, while continuing to do the work that we need to do in other strategically important areas and supply chains.
Yeah, in a bull market, you only think about the upside and not the downside which is bound to happen. Jonathan, I'm curious though, from the standpoint of the CFR. I mean, it seems like a lot of this investment is really fueled by a fear of China, or the fear of Chinese technology making it here, or a fear that China will lock us out of access to various things that we need. Is that sort of the common thread in your view?
Yeah, we've had a couple of wake-up calls in Washington. I think we had one during COVID when we saw factories in the U.S. begin to close because we couldn't get access to important supply chains that were on the other side of the world. But much more recently, we saw the Chinese impose a series of export controls on rare earths that really got the attention of business leaders and leaders in Washington. And so we've now see a really very serious effort to build capacity domestically and to work with partners and allies to address those areas. You can't do it overnight, and you can't do it for free. And the case for the government being involved in those areas is because there is not sufficient private investment. And the Chinese are playing a game in those areas where in many cases they're competing at below market terms.
Jonathan, great to speak with you. Thank you. Jonathan
Thanks.
Hillman. Speaking of the administration, do not miss Joe Kernan's exclusive interview with President Trump. That's coming up 5 p.m. Eastern Time on Fast Money. Well, software stocks making a big comeback, and Palantir, the latest name to get upgraded by analysts. Look at whether this surge is sustainable straight ahead. Plus, NVIDIA announcing a new revenue sharing plan as investors start to get more nervous that its biggest customers could soon be its competitor. Details next. Closing bell overtime live from the NASDAQ market site. We'll be right back.
Welcome back. NVIDIA is announcing a new revenue sharing plan today. The company will partner with AI startups offering its computing infrastructure in exchange for a share of future revenue, naming 2 initial partners who will provide the compute power behind this scheme. Similar to Microsoft, Oracle, and Amazon, NVIDIA is looking for new ways to secure long-term financial deals with customers. I spoke with Ed Zitron of Easy Primary Research this morning. He's a skeptic of the AI business model in general and its future. He sees today's NVIDIA move as telling of what's to come. Take a listen.
I think it could be the neo-clouds, because with this rumor of Meta selling their AI capacity, I think companies like CoreWeave, and especially Nebius and Iron and Cypher Mining and all of them, TeraWulf as well, they're basically outgrowths and they're subsidiaries of NVIDIA. NVIDIA is now, according to the information, going to be paying them to rent back their GPUs when they install them in the data center. This is something that only happens in an industry without diverse and real demand.
It's like there's a kind of gold rush for the mining claims, and then the ones who got there first are willing to kind of sell access for other people to search in there as well. And, there's obviously a lot of criticism of the whole circularity with NVIDIA for a long time now.
Completely.
And, it's just the complexity continues to grow around all this.
Yeah.
And you wonder what the underlying organic demand might be.
This reminds me of when software companies said to SPACs, we'll supply you with whatever subscriptions it is for share revenue. I mean, it just sounds very sort of, we're going to help you finance your growth.
Right, exactly.
Yeah.
And, you want to ensure that the whole infrastructure remains refreshed. And maybe there is a good kind of shortcut for some smaller players out there who just want to plug into what NVIDIA can offer. But it's hard to keep up with, frankly.
Yeah. Well, Palantir getting an upgrade from D.A. Davidson to a buy from a neutral, raising the price target to 175. That helped lead to Palantir's best week since March. The analyst says the recent back and forth between Anthropic and the federal government highlights Palantir's value as a key AI deployment layer, allowing customers to avoid being locked into any single model provider, strengthening Palantir's position. And it's not just Palantir. Software has been leading recently, with IGV posting its best week in a month. Meanwhile, the chip ETF SMH has fallen 11% over the past 2 weeks, its worst stretch since April 2025. You have to wonder if that narrative of hardware eating software has sort of abated, at least for now, how long that will last. We saw Microsoft notably do pretty well this week as well.
Absolutely. And, it's hard to separate it out from just kind of money is circulating in other directions from into laggard groups. And Palantir has had exaggerated moves in both directions. Now, whether it's an attractive valuation, I'd just look back at the price to sales ratio on a forward basis. It was 30 times on the day of the 2024 election. It shot up to 90 because it was considered to be very much in favor. It's back down to 30. So it's essentially given back that huge valuation ramp. And maybe it's a more mature business. We'll see if it's worth it. But kind of interesting how we made a round trip there. Up next, a breakdown of the recent big divergence between growth and value stocks and whether that trend is here to stay. Closing bell overtime. We'll be right back. These radical rotations we've been talking about in the market, pretty noticeable here in growth versus value. So IWD, that is the Russell 1000 value ETF. IWF is the growth ETF. You see a smoother ride for value, but really exaggerated moves when it comes to here in late October was when growth peaked in a pretty dramatic way relative to value. You see, we lost a lot of ground in growth. Value managed to do okay over that period of time. That was the broadening, right? From November through February was the broadening. And then growth comes back much more sharply after the low in March 30th, and then it falls away. Value keeps going up. So this is what the broadening looks like in terms of style. Want to point out it's not entirely different sets of stocks. Okay, Amazon is in both, okay, but it's represented in a higher way in one versus the other. So it's kind of just about like emphasis, not totally discrete names.
Right, but there's no sort of pattern that we can discern, even if you brought this back in terms of how long they stay correlated or when they diverge.
It's multi-month often when you really have one of these wholesale switches at this point. Here you see directionally. It's not just one going up less than the other one. Yeah. So this shows you that it got a little bit out of whack and we're coming back into some balance.
All right. Time now for a CNBC News update with Pippa Stevens. Pippa.
Hey, Melissa. Former U.S. Olympian David Hearn was indicted today on one felony charge of destruction of property. Hearn was arrested last month after he touched a piece of coating in the reflecting pool on the National Mall. He has denied wrongdoing. Several others have been arrested and cited after President Trump blamed vandals without citing evidence for the pool issues since its recent renovation. As extreme heat descends on much of the country, the Energy Department is telling grid operators to require data centers to use backup power systems if they need to ease the strain on the grid. Many of them often go unused. The strain expected to be especially pronounced in the Mid-Atlantic, which is home to the largest concentration of data centers in the world. The NHL's all-time leading scorer is coming back for a 22nd season. Alex Ovechkin re-signed the Washington Capitals today on a one-year deal. He had said in recent months that he was waiting for the offseason to decide whether to retire. The Russian superstar and Stanley Cup winner passed Wayne Gretzky's record of 894 goals in spring of 2025. Mike?
All right, Pippa, thank you. Well, believe it or not, we are on the verge of earnings season again. We'll discuss whether earnings strength could push this market even higher. Closing bell overtime. We'll be right back.
Reflects growing unease.
Earnings season is around the corner, and investors are awaiting a strong Q2 driven by AI investment boom. So can earnings strength drive the market higher from here? Joining us now is BD8 Capital Partners CEO Barbara Duran and Unlimited CEO and CIO Bob Elliott. Good to see you both. Barb, is the market in these kind of violent churning that we've seen from one type of stock to another, is it telling us anything about earnings expectations or where investors want to be positioned for it?
Mike, I think that's what everybody's trying to figure out for this second half. I mean, you had, 9 weeks of new highs leading up until June, and then June has just been a trading range back and forth, and you have seen violent rotations, profit taking out of the obvious names in the tech. And of course, since then, there's been lots of questions about tech, whether return on investment, competition, threats of substitution. And so I think you're going to continue to see that kind of churn. And then the question is the market broadening out? You've seen small caps really outperform, so in 21% in the first half, the best apparently in 35 years. But there you see about a third of the top 50 have been semiconductor small caps.
Yeah.
So, that sort of thing I think continue. But
I think the question then, as you tee it up, is the market telling you get or stay more diversified, or is it saying now you have a chance to buy those old winners in Mag 7? Cheap.
Well, I think the hyperscalers, until Meta yesterday, were down 7% on the year, and I think they were really cheap. I mean, these are still, whether you're looking at their return on investment, monetization, these are big cash flow generators. Their fundamental businesses have not changed. So I think those are places you still have to be, and on a sell-off, you have to be there. So the broadening out, I think, is really people chasing. They want to be fully invested. They're finding the laggards, small cap, whatever it is, to be in. And so I think the rotation could come right back in the second half.
Do you buy that notion that there is a rotation, a diversification within the tech sector, that maybe it is semis might, feel some chop and some volatility here, might be down, but we're going to see that rotation go to other areas within technology like hyperscalers?
Well, I think the question that folks are trying to figure out is maybe not this earnings season, which will probably be pretty good, but looking out a year or 2 years, 5 years ahead and saying, how are you going to monetize the AI boom? That's the real question. And of course, Facebook gave us some indication of that earlier this week about how that could be more broadly done. But the story of going from $1 trillion of investment to $5 trillion of capex in the sector leaves a lot of questions to be answered on that. And I think people are going to be looking at the earnings seasons not for the backward-looking picture of what's going to happen with the AI boom, but the forward-looking picture of how these things are going to get justified. If there's not enough justification, it's going to be very hard at the economy-wide level to justify the current valuations.
It was interesting at the open today, Bobby, after we got the jobs number, looked kind of Goldilocks, bond yields come in, and everything, went up together. Is the macro telling us much of anything about what equities are positioned for right now?
Well, I think, as we've all focused on the AI boom, we've sort of forgotten that there's a real economy that continues to plug along. And I think the challenge is the initial read looked like it continued that trend of taking cuts off or hikes off the table, which we talked about last week. I think then people dug into the numbers themselves in a little bit more detail, and it started to raise some questions. I mean, you see the household survey with a 500,000 job contraction. You see, revisions greater than the number posted in the last month. That's not Goldilocks. That's bad. Combined with weak wage growth. The real risk here is that the household starts to topple over. They've been really holding up a lot of this expansion in the economy by spending a lot more than they're earning. If the labor market is actually softening more than people expect, that could be a pretty bad story for the real economy through the rest of the year.
Are you worried about that, Barbara? I mean, there is an argument to be made that AI and the boom in capex spending is sort of papering over the weaknesses, underneath the headline numbers.
See, I have a different view than Bob does. I mean, looking at those numbers, but if you really look at what's happening in the economy in general, first off, you still have the 50+ trillion in wealth created. There's a big wealth effect since 2019, and housing prices have stayed up, so people have a lot of wealth there. And when you look at wage growth is not bad. It's not right now not keeping ahead of inflation, but inflation is probably peaking right here. And if you look at spending, the Bank of America Institute, which has 70 million of their accounts, it still looks good. People are spending. Even the lower income, yes, has been under pressure, and you're starting to see, the differences there. But discretionary spending is still holding up, and you're seeing that in travel and restaurants and all sorts of things. So I think that the things still look good. People have jobs, and the unemployment rate went down from 4.3 to 4.2%, which is very interesting.
It did, although that was an interesting quirk, Bob, right? The labor force shrinks in the latest survey. You mentioned the household survey. I mean, how does that all funnel into your outlook for rates and bonds and whatever else?
Well, I think it continued the story around a disinflationary narrative. That, remember, 2 years and the broader bond market, bond yields are still pretty close to nearby highs. And at the same time, we're seeing oil prices fall below $70 today. We're seeing the employment conditions weaken substantially relative to the hopes that were in the market. That's not a story for yields to be at near-term highs. That's a story for lower yields. And probably just needs to be unlocked by Warsh acknowledging that despite the rhetoric about inflation, that's a longer-term story. And in the short term, he's going to sit on his hands with the rest of the committee.
Are you worried about inflation, Barb?
Well, I
being
think
stickier?
it could stay. Yeah, I think it is stickier. I think certainly oil prices, below 70, that certainly helps. And I think that's why I said we've seen the peak in inflation. But I think there are structural issues here, given the AI spending, and you're seeing all the component prices, that I think it's going to be a little bit stickier for a while.
All right, Barb and Bob, good to see you. Thank you.
Thank you.
Well, Tesla having its worst day in more than 5 years, despite stronger than expected vehicle deliveries. Coming up with the results say about the state of the overall EV market. Coming up at the top of the hour, a can't miss interview. Joe Kernan's exclusive sit down with President Trump. That's straight ahead, 5 p.m. on Fast Money.
Welcome back. Shares of Tesla and Rivian heading in opposite directions despite both companies reporting better than expected second quarter delivery numbers. Phil LeBeau has the details. Hi, Phil.
Hey, Mike, let's start first off with Tesla and the numbers that it delivered in the second quarter in terms of vehicle deliveries. Much better than expected. The company delivered almost 481,000 vehicles. The street was expecting just 406,000 vehicles. So as you take a look at the company right now, you sit there and say, okay, coming off a very strong second quarter, what can we expect? Analysts are raising their estimates for full year deliveries. Now, they're not going up dramatically, but they do. You were starting to hear analysts talk about perhaps they will eclipse the number of deliveries from last year, which was just over 1.6 million vehicles. What's the next catalyst for this stock, and what's Elon Musk's vision for what the future holds for Tesla? We'll find out July 22nd. That's when the company reports its Q2 results. That's really the next chance that we'll get a sense of what might move this stock that has been, tied so closely into what's happening with SpaceX. Now, the other EV story, Rivian. It also delivered better than expected vehicle numbers for the second quarter. Its vehicle delivery coming in at 12,613. More important, it has raised its guidance for full year deliveries by 3,000 vehicles, now to a range of 65,000 to 70,000 vehicles. We will hear from Rivian's CEO on July 30th. So 2 stories here of better than expected deliveries, guys. But keep in mind, Tesla's deliveries, that's global. Rivian deliveries are here in the United States, some in Canada as well, but primarily United States.
Phil, is there a way to generalize about general uptake of EVs with all these numbers? I mean, I know Ford was a shortfall, but in absolute unit terms, Tesla's upside, overrides a lot of those things. Was there any response to the spike in gas prices or anything like that?
It's hard to know, Mike. Do I think that the higher gas prices had an impact for Tesla? Probably in Europe that did, because they've noticed a far greater impact in terms of gas prices due to the proximity and the flow of oil coming out of the Middle East there. And that's why we saw strong numbers. Look, Tesla doesn't break it up by region, but analysts can put the numbers together, and the expectation was that they did better in Europe than a lot of people were expecting. They're also improving their deliveries in China. I'm not sure that's tied into gas prices. That's more a reflection on the market and the competition there. So overall, Mike, can you sit there and say better than expected deliveries? That means people are rotating back into EVs. I wouldn't go that far, especially in the United States here, where EVs are still 6 to 7% of the market.
All right. Phil, thank you. Phil LeBeau. Let's get you set up with the highlights of next week's trade. On Monday, we'll get the ISM Services Index. SpaceX will join the NASDAQ 100 on Tuesday. That should be interesting. Levi Strauss earnings, latest Fed minutes, and consumer credit will be released on Wednesday. PepsiCo earnings, existing home sales and weekly jobless claims are out Thursday, as well as the reveal of this year's top states for business. And the week closes out on Friday with Delta's earnings and SK Hynix's IPO. That should be interesting in terms of how that will impact the memory trade, which has been so weak.
No doubt about it. Yeah, I mean, at first it seemed like, wow, it's sort of a perfect little accelerant to the excitement about memory when they announced they were going to do it. Now we've had 20%, 25% declines in those stocks. And then SpaceX going into the NASDAQ 100. It's so funny how they laid the groundwork before the IPO. It's probably only going to be a few $1 billion of net demand.
It's not as big as
it's well less than 1% of the QQQs, which are like $500 billion. It's not nothing, but it is interesting. And of course, it'll be interesting to see how it affects, if at all, the action in the index itself. All right, everybody, have a great 4th. You as well. And that's it for overtime.
Fast Money starts right after this break.
Sanctions along with the healthcare sector and some of these other things.
Good holiday weekend to you. Only fitting with the Navy here in America about to celebrate 250 that we have a record high on the Dow. And we will go out with another one. I'll see you on the other side of the holiday.
The bells bringing into the trading day at the NYSE. Cinda closing out the trading day, and at the NASDAQ, Team Shares doing the honors. Welcome to Closing Bell Overtime. We're live from Studio B at the NASDAQ market site. I'm Melissa Lee along with Mike Santoli. Stocks mixed today as the rotation continues. The Dow up nearly 600 points, ending near the highs of the day. S&P about flat. NASDAQ down a little less than 1%. Healthcare and staples lead today, while tech and discretionary lag. Discretionary led lower by an 8% drop in Tesla. Tech dragged down by memory names. More in the market straight ahead.
On our radar at the close, is AI the biggest risk to the market right now? NVIDIA proposes a new revenue model, and what could a government stake in OpenAI mean for a potential IPO? Lots of those questions. It continues to swirl around the AI trade, which is having a little bit of a reckoning, this extended gut check. You mentioned this mixed market. Memory got way overextended. We all knew that. The question is how much that has to correct. It's still in process. Everyone embracing the idea that the market's broadening out. We have a lot of the old economy sectors working, equal weight S&P at new highs. It's all true. It feels very virtuous. It feels very earned. Everyone kind of likes that it's on firmer footing. I get a little bit nervous because we've seen these interludes before, and when the driving leadership of the bull market gets a little bit on the defensive, sometimes you get some slippage in there. And, so far it's really hanging in there fine. But, Apple was up huge today. Yeah. Right? And Apple is less volatile than the S&P 500 as a stock. It's just kind of defensive. So it shows you the mechanics are working, but it seems, again, a little forced.
Yeah, we were talking in the breaking, you were mentioning on Closing Bell, names like Caterpillar, which are down 10%. I mean, granted off of all-time highs, but still this sort of encapsulates what is happening in the markets in terms of that broadening, what this broadening feels like. We're seeing the leaders being taken down a little bit. Stocks, it's its worst two-day stretch in about a month. So we'll see if that lasts until next week, and if that gut check continues in the AI trade, even as we enter earnings season.
And look, it's very positive if it's just the market's way of kind of resetting and getting rebalanced. But if it really represents the fact that the memory trade and the obsession with this shortage was the final extent of the high conviction AI trades, right? Because you went from hyperscaler, you went through NVIDIA, you went through all the rest, and then we were left with nothing but memory. So I guess we have to see if the overall market's going to have an answer for that. Let's head to Christina Partsinevelos now for a look at some of today's biggest movers. Hi, Christina.
Hi, guys. Well, let's recap. The Dow up, closing higher in the NASDAQ and S&P 500. Let's say lower, S&P pretty flat, as chip stocks really struggled, all following weaker than expected jobs report. Big tech was relatively mixed, weighed down by Meta and Tesla. So Meta was negative earlier in the day, but also gave back yesterday's 9% pop. Specifically this afternoon, Reuters reported CEO Mark Zuckerberg told employees AI agent development hasn't, quote, accelerated in the way we expected. So that added further downside momentum. Tesla, on the other hand, the second quarter deliveries beat, but expectations were quite elevated. So you saw shares close over 7% lower. Apple climbing almost 5% despite a report to cut its iPhone 15 production by roughly 15%. Shares have really just rallied since last Thursday's price hikes. And then you guys talked about this momentum trade unwinding. I checked out the SPMO, Invesco S&P 500 ETF. That fell roughly 3%, led by the usuals, Micron, SanDisk, storage name Western Digital, extending yesterday's sell-off just on reports that Meta plans to sell excess computing power, and that's really sparked fears of AI compute oversupply, or at least a lot of debate out there. And with chips down, we actually saw software move in the other direction. Adobe, Autodesk, Service Titan really lifted the IGV today. And then switching completely out of tech, defense outperformed with the ITA up for a fourth straight day after Reuters reported Canada plans a global defense bank offering billions of dollars in low-cost military financing, so to help some names there. Last but not least, we save healthcare, the day's best sector, closing higher with the XLV ETF closing at a record, guys. Happy weekend.
Dramatic move there for a sometimes sleepy sector. Christina, thank you.
Let's turn now to the energy market. More than 147 million people in the U.S. are under extreme heat warnings through the end of the week. Even overnight temperatures are expected to stay warm. Despite this, natural gas prices continue to fall. Pippa Stevens has got that story. Hey, Pippa.
Hey, Melissa. So it is really hot outside, which is setting up a major test for the electric grid. PJM, which is the largest grid operator, powering 67 million Americans across the Northeast and Midwest, forecasted peak demand today at a record 166 gigawatts that would take out the prior high from 2006. Power prices have surged as utilities paid top dollar to secure generation to make sure the lights stay on and that air conditioners continue to run smoothly. Last week, prices in the PJM day-ahead market averaged $44 per megawatt hour. For today, that was up to $436 for a gain of nearly 900%, according to S&P Capital. Yes, Energy's Jake Landis telling me the highest one-hour price from 7 to 8 p.m. tonight topped $1,200. For New York City, which is not in PJM, prices nearly doubled overnight. Now, despite this record demand, natural gas is lower on the week, thanks to the heat wave already being priced in, high production and storage above the 5-year average. But watch the utility stocks because it was the third best group on the day. Independent power producers like Constellation, Vistra, and Talon can be beneficiaries since they can get higher prices for the power they sell into competitive markets. And guys, I'm looking at the load right now. PJM says we have topped 161 gigawatts.
Wow. And it looks like, Pippa, there are some rolling blackouts going on in order to manage the demands on the grid. You know, consumers will be looking at that nat gas chart, Pippa, and wonder when their prices were going to come down. And I was just looking at a chart from the St. Louis Fed saying that, you know, nat gas prices are having an increasingly muted impact on the actual price consumers pay for electricity because of all the demands on the grid and the need for CapEx.
That's right. So one thing, of course, we have to remember that Henry Hub is a regional benchmark. And so, you know, if you really want a more accurate look at what the price of natural gas actually is, you have to look around the country, like Algonquin City Gates, for example, into the Northeast. But the reason why these power prices get so high is because they do have to pay everyone what that marginal supplier is. And those marginal suppliers are what's known as peaker plants. They only come online at times of extreme stress, and they are very expensive to operate. And they typically are owned by private equity firms, and maybe they only operate for, say, 2 days a year. And during those 2 days, they capture so much money that then it's fine to be offline for the rest of the year. And so that's why, as the demands on the grid grow, it's more about what is the marginal cost for supply versus what is the natural gas price. That's becoming an increasingly smaller share of the overall bill. Because when you think about utilities, you also have to think about all their input costs, things like labor, you know, their power prices. All of those costs are going up. And so that's also feeding into our electric bills. Now, we're not going to feel the entirety of this power price spike because utilities typically are hedged to a certain extent, maybe a third on 10 years, a third on 3 to 5 year contracts, and a third in the spot market. But, you know, this makes the case for more generation needing to be added to the grid, which then they can earn a rate of return on that rate base.
Yeah, for sure. Hopefully, maybe just a couple days of this white knuckling to get through, Pippa, this high demand period. Let's now turn to the bond market. The 10-year yield starting the week at 437 has risen to more than 448 as it digested a lot of data along the way. Let's turn to Rick Santelli in Chicago. Hi, Rick.
Hi, Mike. Indeed. If you look at a week to date, what should jump out at you is right towards the middle of that chart. Wednesday, jolts, boom, yields popped up on that 10-year. They've stayed elevated. As a matter of fact, the markets closed early today, but if you look at how they closed, it's pretty fascinating. We are unchanged on the day in the 10s. However, on the week, we're up 11 basis points. Now, throw in the 2-year. The 2-year gave most of the jolts Wednesday back, and it hovered right around down 4 basis points on the close, up 5 on the week. Why is this important? Well, we had fewer jobs and a lower unemployment rate. The 2-year seemed to concentrate on the fact that probably the easing cycle's over, but no decision on tightening, whereas the 10-year, well, even though it peaked, as you look at this chart going back to April, it peaked at 467 in May. It is definitely still elevated because inflation is elevated, even though it might not be accelerating but decelerating. And one other thing, looking at that chart, where's all the bottoms there to the left and now to the right? Right around the mid-430s. Mid-430 support, 467 resistance, and dollar yen. Finally, we see the yen bounce a bit. That chart's a week to date of the dollar. So after hitting 40-year highs midweek, we did see a little give back in front of the holiday weekend. Melissa, back to you.
Rick, thanks. Have a good 4th. Rick Santelli, let's stay on jobs now. While today's number is being viewed by some as Goldilocks for the Fed, there are still lingering questions about the impact that AI will continue to have on the jobs market. While professional and business services, social assistance, and healthcare all saw gains, the technology sector saw declines in June, specifically in the IT industry. That was down 3.3% from May. Joining us now is Torsten Slok, Apollo Global Management Chief Economist, who is just back from Portugal. He was at the meeting of the central bank heads. Torsten, great to see you.
Thank you.
I'm glad you made it back from Portugal all safe and sound. In terms of what we're seeing in the jobs reports, it was 17 of the past 18 months we saw declines in information technology payrolls. Is that the impact from AI?
Well, there's probably a lot of things going on. I mean, generally speaking, exactly as you say, it was a Goldilocks report where we still have steady, strong job growth. It was not as good as the market had expected. And we also had the unemployment rate going down, which was better than what the market had expected. And in terms of the composition, yes, maybe some of that is because the tech sector has been slowing a bit down. It could be because of AI implementation. It could also be because jobs in the tech sector have already been fairly elevated for quite some time. So there's several reasons why it could be that the tech sector specifically did show some weakness.
And in terms of AI in general being a potential source of risk, is it that it's a risk to job creation, or is it a risk that there's a tremendous amount of capex going on? We don't really know if there's malinvestment along the way, and if that goes away or if that gets reduced, then that all of a sudden decelerates the whole economy.
Well, from a market perspective, there are really 3 reasons why AI is playing such a big role. First of all, exactly, if AI does begin to slow down for whatever reason, either that people begin to worry about that it's not delivering the ROI that people expected, it could also be because we're not seeing the implementation as quick as people expected. All those things could ultimately result in simply less capex over time, not necessarily the next several quarters. A lot of the financings have already been in place, but that would mean a GDP forecast where growth would ultimately begin to slow down. But the second reason, of course, which is very important, is what we're seeing in markets and what you just spoke about, namely the rotation away from the high concentration that we've had now for several years, where the 10 biggest stocks still make up about 40% of the index. That would also have very significant implications if AI does not deliver on the expectations that people have, both in public and in private companies. And finally, it also becomes important for demand for treasuries because hyperscaler issuance in the belly of the curve at about $700 billion in issuance this year is crowding out demand for treasuries. So that means that fixed income managers that have to buy investment grade credit, they can either buy hyperscaler debt, they can buy financials, or they can buy US treasuries. Now, if there's less dollars going to US treasuries, that means that there's just more money that's going to hyperscaler debt, and that also begins to have implications if AI does not deliver. So there's a number of reasons, not only on GDP, but also for financial markets, that could potentially become very important if AI does not deliver on the high expectations that are currently in markets.
There's a lot at stake. I mean, a lot is riding on this AI boom, Torsten, in terms of the risks to the economy. Do you see the risks outweighing? I mean, how do you sort of view the risks in terms of the balance of risks here?
Yeah, because the challenge is that if AI does not succeed, in other words, if we do not see the ROI coming as quickly as we are all hoping and expecting, if that happens to take a longer time, we will, of course, begin to see some valuations, especially the Magnificent Seven, come down quite significantly. And that's a problem because they have such a high concentration in the S&P 500. So if AI under-delivers, we have a problem. But if AI over-delivers and the unemployment rate goes to 10, 20%, we will also have a problem, because in that case, we will have a lot of people who do not have money for consumption. The unemployment rate will be high. And if that's the case, GDP will also be slowing down in a significant way, but in this case, driven more by the consumer. So that's why there's a fairly narrow path where AI can succeed, because if it under-delivers, we have problems. If it over-delivers, we have problems. So that's why the markets discussion here is all about what's the likelihood that we walk on the narrow path where we will not have the case where things either go wrong to the downside or go wrong to the upside.
There was some discussion, certainly, at the conference in Portugal, I'm sure, along with, an interview that we'd had with Kevin Warsh about productivity, what we should expect out of it, when we might expect to see benefits, and what that means for Fed policy.
Absolutely. Sarah had the interview with Warsh, of course, and the other central bank governors on the stage. And the key response that he did that he gave exactly to this question was that he did expect productivity gains to come along. But he, of course, also talked about the task forces. He talked about communication policy. He didn't give any forward guidance, but he did give the little hint that he did think that inflation had been come down, and therefore inflation risk to inflation had been moving lower, which makes a lot of sense given where oil prices have gone. But the conversation was indeed also in all the discussions in the panels in Central really about what is the outlook for AI, not only for the US, but Europe is far, far behind when it comes to AI. So therefore, what can Europe do to catch up to the AI investments that we have in the US? So there was a lot of discussions that really centered around this broader issue of what is the outlook for AI. That's why the conversations we are having at the moment about what is the earnings that are coming, what are the earnings that are coming from these companies, is absolutely critical over the next several quarters.
But it does sound, Torsten, like you're saying that the path is so narrow for AI to succeed and the impact on the economy to be good, that it's actually kind of frightening. I mean, it sounds like there are more scenarios than fewer scenarios where AI will negatively impact the.
Well, and you have, in the last 48 hours, had several guests on your shows that have talked about the downside risks. But let's not forget that there's also the upside risk that AI is being implemented. Companies are investing a lot. We are all seeing our lives change because of AI. So we will see dramatic changes in the economy. The question is just what is the speed of those changes? And that's what the market is betting on at the moment.
Torsten, thank you. Good to talk to you as we just see options trading close for the day with the closing bell at CBOE. OpenAI is reportedly offering the U.S. government a 5% stake in the company worth more than $42 billion. The proposal suggests other AI companies could also offer a stake, but Anthropic and the Trump administration have yet to discuss any plans. The proposal comes as AI firms face growing concern over cybersecurity vulnerabilities and Chinese competition, while OpenAI and Anthropic are planning to go public. Is this what's best for OpenAI investors? Joining us now is Brett Winton. He is chief futurist at ARK Invest. He also helps manage the ARK Venture Fund and owner of OpenAI and others. And Brett, good to see you. And how are you thinking about this? I mean, on one level, I guess it would dilute investors in OpenAI out to some degree and maybe constrain what they can do. But is it smart strategically or politically?
Well, it's very clear that AI generally, OpenAI and SpaceX XAI, Anthropic, all of which are in our venture fund, by the way, these are geopolitically important technologies. And so I can understand why people are focusing on them as they're also macroeconomically important technologies. This is important for American competitiveness going into the future. And I do think already American people have a stake in kind of like how quickly these companies can develop and how they can commercialize. It's better for us macroeconomically. All of the data centers that are being built here to support these AI models are great for jobs. The previous speaker said, hey, if AI succeeds too much, you'll have high rates of unemployment. That's hogwash. This is an amazing macroeconomic boom that we're going to experience because of the diffusion of AI across the economy. Now, strategically, it might be wise to create some fund that has like AI equity so that people feel like they have the benefit of AI, lining their own pockets. I think that the companies going public could be another mechanism by which you can achieve broad ownership of these companies. And to be frank, like the reason we created our venture fund and allow anybody to invest, not just, accredited investors who have to hit certain wealth thresholds, was to allow people to have access to these meaningful, monumental companies.
Does this, in your view, in any way stunt the competitiveness of American AI? I mean, does it create sort of this ring fence around U.S. AI where we don't have to compete against China because they're going to limit potentially, you know, for instance, Microsoft's ability to run a Chinese open source model on its platform and sort of create these artificial barriers?
I do think, well, one, at a first principles perspective, I think AI companies should be treated like any other company, as in every company has to pay corporate tax rates, and every company can't break the law. And we have laws in place. You know, if you sell a gun and then somebody uses the gun to murder somebody, you know, the person who did the murdering is the person who's liable. I think the same should apply to AI. If you use an AI tool to steal from somebody or to do something, you, the person who enabled that, should be liable, not the underlying company. And if we try to restrict the acceleration of these companies, it does give companies in China, which are essentially distilling our models at some years removed. So they're effectively stealing the IP from the US AI companies and then operating as if, hey, you can have this for free. And there are some embedded risks in those models. For instance, they could embed in the weights mechanisms that kind of sway or potentially strategically impair companies at an inopportune time. So there is a risk to, I think, adopting that software without appropriate safeguards. But I think that broadly, there should not be the government picking winners and losers here. As in, even within the US, we have a vested interest in XAI, OpenAI, and Anthropic, both in our venture fund and in our ETFs, in OpenAI's case. And I think a level playing field where everybody can compete will result in the best outcome for certainly Americans, but really for the whole world. And that's what I'd advocate for.
So are you saying, Brett, that Chinese open source models are stealing from closed models in the United States?
I mean, this is pretty well documented, as in if I systematically ask a frontier model questions, I can figure out some of the underlying magic behind how it's answering questions, and then compress it into my own model. So I don't have to pay the R&D costs that OpenAI or Anthropic did to get nearly frontier class performance. Now, there are things that Anthropic and OpenAI and AI are doing to try to protect themselves from that attack vector, but it definitely exists, and it's a way that open weight models have been, keeping touch with, albeit not in competition with, the frontier.
Brett, you own all three or have an interest in Anthropic, OpenAI, XAI, you said. Does that mean that you're indifferent as to how this plays out in terms of which one wins? Is there likely to be one that turns into the industry standard in some respect or kind of the base level model for what we're looking at in the future?
I mean, there certainly could be. We think of the frontier model kind of layer of the value chain as being worth $15 to $20 trillion by 2030. And I think those three companies are all jockeying for that position. It's likely that there is a handful of players, just like there is in the infrastructure as a service space, and that the margin structure looks very similar. So on the enterprise side, I don't think it's likely to be a winner take all. I do think there are some platform-like characteristics that could allow one company to position itself ahead of the others, but ultimately it will resolve into how much compute they control on an underlying basis. On the consumer side, likely to be winner take all, and their OpenAI is extraordinarily well positioned versus the Google and the Metas of the world. And so we see that as almost a $10 trillion opportunity alone by 2030. So you can think of collectively the AI opportunity for these frontier model companies across enterprise and consumer being on the order of $20 to $25 trillion in enterprise value. And that's why the companies underwrite well for us as exposures in the venture fund. So, we do very careful price targeting over 5 and 10 years. And we think that they are really incredible places to deploy capital today. People look at the valuations, they say, these are very large. And they're very large because the opportunity is monumental. And this goes back to the macroeconomic point. I think this is going to be a remarkable half decade of macroeconomic growth. That's going to be great for jobs, not negative for jobs. So I'm profoundly bullish both on AI and on the U.S. in terms of competitiveness with the world.
Spoken like a chief futurist. Brett, thank you.
Thanks.
Brett Winton. This wouldn't be the first time the Trump administration has taken a stake in a private company. According to the Council on Foreign Relations, the government has participated in more than 30 deals, committing over $26 billion in direct investment, while catalyzing another $7 billion from the private sector. Most of those investments have been concentrated in semiconductors, critical minerals, and quantum technology. The standout has been Intel. The government acquired a 9.9% stake in August 2025 at just under $21 a share. Intel closing today above $120 a share, making that investment one of the program's biggest winners. Joining us now is Council on Foreign Relations Senior Fellow for Geoeconomics, Jonathan Hillman. Jonathan, great to have you with us. This is a sort of unprecedented, I would imagine. I mean, most of the time governments take stakes in companies at a time of duress and a time of economic duress. Does this make sense in your view, or is this something that we should be concerned about, that the government is taking such an active role in investing?
So this would be a unique investment, even for the Trump administration, which, as you point out, according to our data at the Council on Foreign Relations, we're tracking 30 deals that the administration has done that involve equity or quasi-equity. Most of those deals, the vast majority of them, have been done in areas that lack sufficient private capital. These are strategically important areas like critical minerals, semiconductors, quantum computing, and others, where there is not enough private sector investment going to those places, given how strategically important they are to the U.S., given not only their commercial importance, but their applications and capabilities for military uses. This OpenAI proposal, I think, is quite different, right? You're talking about a company that's very well capitalized, that is preparing for an IPO that will attract even more money. And yes, of course, AI is strategically important, but it's hard to see the market failure here and the case for the government being involved to attract additional investment.
Well, I guess then what do you think the case is? Clearly, it seems to be political protection, or at least making sure from OpenAI's perspective that they're not restrained or otherwise penalized by a government that has shown misgivings about the development of AI and when it comes to Anthropic or something.
It does feel less like industrial policy and more like political insurance. And because on the industrial policy side of things, again, yes, it's a strategically important area, but there is not an absence of investment going to this area. In fact, Thorsten, for example, was arguing, this is actually quite the opposite, right? And so, one of the arguments has been, let's give Americans a slice of the upside in AI. And I think we need to remember here that I don't know when the last time is that you looked at your retirement account, but if you've got an S&P 500 index, you've got lots of AI exposure. You've got an emerging markets index, you've got lots of AI exposure. And increasingly, if you've got a bond index, you've got growing AI exposure. So I don't think the question is necessarily how do we give Americans more exposure to AI? We should be thinking also about how to protect them if indeed this is a bubble that bursts, while continuing to do the work that we need to do in other strategically important areas and supply chains.
Yeah, in a bull market, you only think about the upside and not the downside, which is, bound to happen. Jonathan, I'm curious, though, from the standpoint of the CFR, I mean, it seems like a lot of this investment is really fueled by a fear of China, or the fear of Chinese technology making it here, or a fear that China will lock us out of access to various things that we need. Is that sort of the common thread in your view?
Yeah, we've had a couple of wake-up calls in Washington. I think we had one during COVID when we saw factories in the U.S. begin to close because we couldn't get access to important supply chains that were on the other side of the world. But much more recently, we saw the Chinese impose a series of export controls on rare earths that really got the attention of business leaders and leaders in Washington. And so we've now see a really very serious effort to build capacity domestically and to work with partners and allies to address those areas. You can't do it overnight, and you can't do it for free. And the case for the government being involved in those areas is because there is not sufficient private investment. And the Chinese are playing a game in those areas where in many cases they're competing at below market terms.
Jonathan, great to speak with you. Thank you. Jonathan
Thanks.
Hillman. Speaking of the administration, do not miss Joe Kernan's exclusive interview with President Trump. That's coming up 5 p.m. Eastern Time on Fast Money. Well, software stocks making a big comeback, and Palantir, the latest name to get upgraded by analysts, look at whether this surge is sustainable straight ahead. Plus, NVIDIA announcing a new revenue sharing plan as investors start to get more nervous that its biggest customers could soon be its competitor. Details next. Closing bell overtime, live from the NASDAQ market site. We'll be right back.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move.
These radical rotations we've been talking about in the market, pretty noticeable here in growth versus value. So IWD, that is the Russell 1000 value ETF. IWF is the growth ETF. You see a smoother ride for value, but really exaggerated moves when it comes to here in late October was when growth peaked in a pretty dramatic way relative to value. You see, we lost a lot of ground in growth. Value managed to do okay over that period of time. That was the broadening, right? From November through February was the broadening. And then growth comes back much, much more sharply after the low in March 30th, and then it falls away. Value keeps going up. So this is what the broadening looks like in terms of style. Want to point out it's not entirely different sets of stocks. Okay, Amazon is in both, but it's represented in a higher way in one versus the other. So it's kind of just about like emphasis, not totally discrete names.
Right, but there's no sort of pattern that we can discern, even if you brought this back in terms of how long they stay correlated or when they diverge.
It's multi-month often when you really have one of these wholesale switches at this point. Here you see directionally. It's not just one going up less than the other one.
Yeah.
So this shows you that it got a little bit out of whack and we're coming back into some balance.
All right. Time now for a CNBC News update with Pippa Stevens. Pippa.
Hey, Melissa. Former U.S. Olympian David Hearn was indicted today on one felony charge of destruction of property. Hearn was arrested last month after he touched a piece of coating in the reflecting pool on the National Mall. He has denied wrongdoing. Several others have been arrested and cited after President Trump blamed vandals without citing evidence for the pool issues since its recent renovation. As extreme heat descends on much of the country, the Energy Department is telling grid operators to require data centers to use backup power systems if they need to ease the strain on the grid. Many of them often go unused. The strain expected to be especially pronounced in the Mid-Atlantic, which is home to the largest concentration of data centers in the world. The NHL's all-time leading scorer is coming back for a 22nd season. Alex Ovechkin re-signed the Washington Capitals today on a one-year deal. He had said in recent months that he was waiting for the offseason to decide whether to retire. The Russian superstar and Stanley Cup winner passed Wayne Gretzky's record of 894 goals in spring of 2025. Mike?
All right, Pippa, thank you. Well, believe it or not, we are on the verge of earnings season again. We'll discuss whether earnings strength could push this market even higher. Closing bell overtime. We'll be right back.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work. It is happening now. New tomorrows, new challenges. And all of it needs energy to work.
Welcome back. Shares of Tesla and Rivian heading in opposite directions despite both companies reporting better than expected second quarter delivery numbers. Phil LeBeau has the details. Hi, Phil.
Hey, Mike, let's start first off with Tesla and the numbers that it delivered in the second quarter in terms of vehicle deliveries. much better than expected. The company delivered almost 481,000 vehicles. The street was expecting just 406,000 vehicles. So as you take a look at the company right now, you sit there and say, okay, coming off a very strong second quarter, what can we expect? Analysts are raising their estimates for full year deliveries. Now, they're not going up dramatically, but they do. You were starting to hear analysts talk about perhaps they will eclipse the number of deliveries from last year, which was just over 1.6 million vehicles. What's the next catalyst for this stock, and what's Elon Musk's vision for what the future holds for Tesla? We'll find out July 22nd. That's when the company reports its Q2 results. That's really the next chance that we'll get a sense of what might move this stock that has been, tied so closely into what's happening with SpaceX. Now, the other EV story, Rivian. It also delivered better than expected vehicle numbers for the second quarter. Its vehicle delivery coming in at 12,613. More important, it has raised its guidance for full year deliveries by 3,000 vehicles, now to a range of 65,000 to 70,000 vehicles. We will hear from Rivian's CEO on July 30th. So 2 stories here of better than expected deliveries, guys. But keep in mind, Tesla's deliveries, that's global. Rivian deliveries are here in the United States, some in Canada as well, but primarily United States.
Phil, is there a way to generalize about general uptake of EVs with all these numbers? I mean, I know Ford was a shortfall, but in absolute unit terms, Tesla's upside, overrides a lot of those things. Was there any response to the spike in gas prices or anything like that?
It's hard to know, Mike. Do I think that the higher gas prices had an impact for Tesla? Probably in Europe that did, because they've noticed a far greater impact in terms of gas prices due to the proximity and the flow of oil coming out of the Middle East there. And that's why we saw strong numbers. Look, Tesla doesn't break it up by region, but analysts can put the numbers together, and the expectation was that they did better in Europe than a lot of people were expecting. They're also improving their deliveries in China. I'm not sure that's tied into gas prices. That's more a reflection on the market and the competition there. So overall, Mike, can you sit there and say better than expected deliveries? That means people are rotating back into EVs. I wouldn't go that far, especially in the United States here, where EVs are still 6 to 7% of the market.
All right. Phil, thank you. Phil LeBeau. Let's get you set up with the highlights of next week's trade. On Monday, we'll get the ISM Services Index. SpaceX will join the NASDAQ 100 on Tuesday. That should be interesting. Levi Strauss earnings, latest Fed minutes, and consumer credit will be released on Wednesday. PepsiCo earnings, existing home sales and weekly jobless claims are out Thursday, as well as the reveal of this year's top states for business. And the week closes out on Friday with Delta's earnings and SK Hynix's IPO. That should be interesting in terms of how that will impact the memory trade, which has been so weak.
No doubt about it. Yeah, I mean, at first it seemed like, wow, it's sort of a perfect little accelerant to the excitement about memory when they announced they were going to do it. Now we've had 20%, 25% declines in those stocks. And then SpaceX going into the NASDAQ 100. It's so funny how they laid the groundwork before the IPO. It's probably only going to be a few $1 billion of net demand.
It's not as big as
it's well less than 1% of the QQQs, which are like $500 billion. It's not nothing, but it is interesting. And of course, it'll be interesting to see how it affects, if at all, the action in the index itself. All right, everybody, have a great 4th. You as well. And that's it for Overtime.
Fast Money starts right after this break.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work. It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work. It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move.
Hello, good morning. You're tuned into Power Breakfast on CNBC TV 18. I'm Vinny Motiwala. With me is my colleague Rachna as well. Rachna, a very good morning to you, and it's a Friday.
Good morning, Vinny. It is a Friday. Please take us through the headlines.
Absolutely. Let's start with the top headlines for today, and starting with the rotation out of the semiconductor stock continues that pressure on Wall Street, right? Nasdaq fell more than 0.5%. We saw Dow Jones scale to record highs. Other than that, meanwhile, when you look at the Asian markets, they've opened up mixed as investors look at the safe haven form of tech stocks. GIFT Nifty suggesting a positive start for the Indian market.
US President Donald Trump called the current period a golden age, pointing to record factory building and employment. He also doubled down on wanting to remove Fed Governor Lisa Cook, saying he'd still win that fight by winning the case. The president also defended how his family's wealth is managed, saying his finances go to large financial institutions and that there was nothing illegal or wrong with the crypto venture.
Iran's Joint Military Command has issued a warning to vessels transiting the Strait of Hormuz to follow designated paths or encounter forceful response, even as the country prepares for the funeral of former Supreme Leader Al-Khamenei, who was killed in Israel military strikes. More than 20 million people are expected to attend the funeral in Tehran.
Oil prices hold steady even as supply concerns ease around the Strait of Hormuz. Gold prices gain, heading for first weekly gain in 5 weeks, following softer than expected US jobs data. Silver too gains.
And in a slew of Q1 business updates, you have Bajaj Finserv reports a 20% growth in new loans, while M&M disbursals go up by 21%. AUM rises by 12% from the consumer space. You look at Avenue Supermart reports revenue growth of 15%, while Marico on the consumer side, India business clocks a double-digit growth.
Now let's take a look at what's happening in the Asian markets. Remember, this is the third day of the tech rotation, so Asia seems to be trading mixed. Hang Seng is up about 1.6%, while Taiwan is down about 800 points. Like I said, this is the third day of the tech rotation. So Seoul is attempting a rebound, but like I said, it is attempting a rebound. Kospi up almost 2.5%. Nikkei up about 0.5%. Now Japan is going through a 40-year low of when it comes to the yen. So likely to see a rebound today, but all of the Asia markets were trading somewhere in their record territories, but now we see that softening up. Like you have it, numbers in front of you. Kospi about 2.5%, but Kospi had a major drag yesterday when Samsung and SK Hynix both were the biggest losers of the index. Overnight also we saw some action coming in from US, but the highlight today remains the Donald Trump interview, Vinny.
Absolutely, key highlights remain on that front as well, and every day we keep an eye out on those commentaries. But let's talk about the Nifty implied open. What's the setup looking like as well, right? Nifty implied open as of now is indicating a positive, a gap up start for the Indian markets. This could be the third straight day of gain that we'll be seeing coming in for the Indian markets. Yesterday we closed at 24,175. But how about all these cues that we're picking up from the Asian markets? Commentary coming in from Donald Trump as well. How is all that going to be impacting our Indian markets? We have a team of research here to set you up for trade, tell you which are the important stocks to watch out for in the trading session as well. First up, Vivek is joining us to take us to the cues for today that we're keeping an eye out on. Vivek, good morning.
Well, good morning. Well, it appears as though the Indian markets are ready to shrug off all of the overnight uncertainties, and looking at the GIFT Nifty, it appears to be that we will have a sharp gap up opening for our own markets today. In terms of the overnight cues, like you mentioned, US markets ends largely mixed. The Nasdaq underperformance continued, but Dow managed to go ahead and post another record close. Now, talking about oil prices continue to remain at a comfortable level, especially as far as Indian macros are concerned. Closer to the $72 a barrel mark is where we are seeing Brent trade at. In terms of Asian markets, like you mentioned, again, very mixed cues coming in, a bit of a rebound as far as Korean markets are concerned. But talking about Indian markets yesterday and how they fared, well, markets ended largely in the green, and this is on the back of the fact that you saw significant outperformance coming in as far as the benchmark indices are concerned. Nifty ended above the 24,150 mark. Now, talking about the Nifty IT pack, a clear outperformance yesterday, or a clear rebound, just on back of the commentary coming in from the Palantir CEO, and you saw all of the constituents as far as the Nifty IT pack go ahead and close in the green. A couple of stocks in the radar: Bank of Baroda, sharp fall in the second half of the trading session. Market breadth managed to end in the green, and you did see the NSE advanced decline ratio at 2:1. What is it that we'll be watching out for? Well, ahead of the earnings season, you're continuing to see equity supply. PB Fintech is where we're expecting to see a large block deal. Adani Enterprises will be in focus. A large fundraise of almost 10,000 crore rupees is lined up. There's an upside option there as well. And reaction to business updates, some of the key ones will be Bajaj Finance, D-Mart, Marico. All of these stocks will be in focus today.
All right, thank you so much, Vivek, for that. Now over to Ria, who will list out the stocks to watch for in today's trade. Good morning, Ria.
Well, good morning. Let's start off with all the quarter one updates. First, the first one is Bajaj Finance. New loans have gone up by 20% to 16 million, and the AUM has seen a growth of nearly 24% to 5.47 lakh crore rupees. For Bajaj Housing, the quarter one dispersals have seen an increase of 33%, and AUM also sees a growth of 24% for quarter one. For Tata Motors passenger vehicles, the JLR quarter one wholesales have seen a decline of nearly 9% this time around, with retail sales also going down by nearly 15% to 80,000 units. For Avenue Supermarts, the quarter one revenue has seen an increase of nearly 15% to 13,700 crores thereabout. Marico has said that quarter one saw the India business volume growth in double digits. The international business constant currency growth was in the mid-teens, and the consolidated revenue is expected to grow in the early 20s going forward. For M&M Financial, the dispersals have increased by 21% to nearly 15,560 crores, and AUM also seeing a growth of around 12% and 1.37 lakh crores. For PNB, the quarter one advances have seen an increase of nearly 13%, with deposits going up by 8.5%, and for Union Bank, the advances have gone up by 12.5% this time around, with deposits seeing an increase of just about 3.5%. Moving on to some other stocks that will be in focus, we have Adani Enterprises. They have launched their QIP to sell 2.6% equity to raise 10,000 crores. The floor price has been set at 3,334.68 per share. And lastly, PB Fintech will also be in focus, as Temasek arm will be selling a 2.6% equity for 1,908 crores in a block deal, with the floor price being set at 1,604 rupees per share, which is a 4.6% discount to yesterday's closing price.
Okay, Riya, thank you so much for highlighting the stocks that we should keep on our radar this morning. But in the final update, Sudarshan is here to tell us what are the FNO trends that we are keeping an eye out on. Good morning, Sudarshan. Yesterday we saw a good day of trade coming in, closing above that 100 DMA for the Nifty. Today, what is the key? Should this momentum continue? As of now, a gap up start.
Good morning, Winnie. We say Ant Bhala to Sab Bhala, but for that to happen, we have to build the momentum that we have seen in the last 3 to 4 trading sessions. And by all the data that we are looking at, it's indicating that Nifty in all probability can move towards 24,400. Yesterday's closing level is very encouraging. It's the highest closing level that we have seen in the last 2 months. And the bigger point is that the major short covering that we have seen in all the call options and up to 24,200, that indicates you that Nifty is well placed to hit the levels around 24,400. But for that to happen, Nifty has to cross 24,200 very comfortably. And so far, GIFT Nifty for you is indicating an uptick of more than 150 points. Hope so it maintains the momentum. Now coming to F5 flows, both in the index futures and in the stock futures, they were buyers. In the index futures, they have bought almost 500 crore. In the stock futures, they have bought more than 1,400 crore. They have reduced long positions, but at the same time, they have reduced short positions too. Now, they remain heavily shorted, and on the long side, the exposure is at 9%. Now come to the options data. On the put side, the most active put option was 24,100, and on the call side, the most active call option was 24,400. So the new range for Nifty now is from 24,100 to 24,400. So support, I have taken first support 24,100, and if Nifty fails to hold that level, the next support comes around 23,830. First resistance 24,200. Next resistance comes around 24,400. Some of the stocks that will be in the focus, Muthoot Finance, because gold prices over the last 2 days have been moving higher. Avenue Supermarts after Q1 updates, a bit softish update, and Bank of Baroda has been seeing fresh shorts after the quarterly update and also related to a case.
All right, thank you so much, Sudarshan. Now let's get you an update from the commodity space. Manisha Gupta joins in with all the updates that we need from the space. Manisha, good morning.
Morning, and thank you for that. Well, it continues to be quite volatile when you look at the commodities, but remember it's a truncated week in the U.S. markets, and we already are looking at some bit of a gains coming back across commodities. For the crude oil prices, well, we did try to nudge that $70 a barrel mark. We are back to around 72 plus kind of levels. The commercial shipping through Strait of Hormuz has continued to recover. We do know that more than 10 million barrels per day is passing via Strait, and within this you have Saudi Arabia, Iran, UAE crude oil, which is being exported at the maximum level. The markets are now watching out for the OPEC meeting, which is on 5th of July, where the markets anticipate that we could be looking at increase in production yet again after June and July into the month of August as well, and that would continue to keep the prices in balance. But what really has come back quite glittering has been the precious metal prices. Gold is up 2% overnight. It's trading above $4,100 an ounce. You have silver prices gaining 3% overnight, back at around $62 an ounce. The markets do believe that with the fact that the U.S. added fewer jobs at just about 57,000 versus a market estimate of 110,000, does bring the possibility of a rate hike from the U.S. markets, and that has been very positive for precious metals. Base metals as well have seen rebound in the overnight market, so anywhere between 0.5% to 1% of gains in copper, aluminum, zinc. So it has started as a very strong day for metal prices.
Okay, started as a strong day for metal prices. Manisha, thank you so much for joining us this morning and giving us the update in the world of commodities. But let's talk more in terms of fuel and fuel price cuts. Union Petroleum Minister Hardeep Singh Puri has ruled out a fuel price cut for now. Now, during an interaction with the media in Delhi, he said that there is a case for cut only if lower crude prices hold for the next 2 or 3 months. Listen in.
The crude the petrol and diesel that you buy at the dispensing station today, that crude would have been obtained 2 months ago. Because you float a tender, you buy the crude. So it's bought either at the price, it has to be bought at the price available then. So 2 months ago, or whatever they represented, 6 weeks or 3 months, or I don't know, then the price was not this price, it was higher price. The cost of insurance freight was also that price. So today, that crude is being sold. Customers, it wasn't raised, but the oil marketing companies were losing. Now, if the question is, when will you bring prices down? Well, as I said, now they are still carrying the stock which was bought at a higher price with higher insurance, higher freight rates. If this persists next 2-3 months, then that would be a legitimate question. But, that's hypothetical. I won't get into that case.
All right, that's Minister Hardeep Puri. But now let's slip into a break. Next up, US President Donald Trump speaks exclusively to CNBC. We get you the highlights on the other side.
I'm very
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
Welcome back. You're watching Power Breakfast on CNBC TV 18. Now, before we get to the highlights from the US President Donald Trump's exclusive interview, let's focus on the US market, where Wall Street ended mixed on Thursday as the Dow Jones closed at a record high. While the S&P 500 was flat, the Nasdaq ended lower. CNBC's Pipa Stevens joins us now and gets us a wrap of all the action on Wall Street.
U.S. markets were mixed across the major indexes in Thursday trading as the Dow hits a new high and chip stocks continue to struggle. The Dow was up 595 points, the S&P was flat, and the tech-heavy Nasdaq fell 207 points. The June jobs report on Thursday showed an increase of 57,000 jobs last month, far below the Dow Jones consensus estimate of 155,000 jobs. But the unemployment rate ticked down slightly to 4.2%. But according to the Labor Department, the drop in the unemployment rate came largely from an exodus from the job market altogether. The labor force participation rate, which measures the working age population of those either employed or looking for a job, fell to the lowest level since March 2021 when the pandemic began. And the 4th of July holiday is shaping up to be the most expensive in years for people filling up at the pump. AAA says the national average for regular is now $3.84 a gallon. While that's down more than 50 cents from a month ago, it's still higher than 4th of July prices over the past 3 years. Gas Buddy says prices have fallen by nearly 2 cents per gallon a day in the past several weeks. That's what's happening here in the U.S. Back to you in Mumbai.
Okay, that's about Wall Street. But now on to a CNBC exclusive with the U.S. President Donald Trump. CNBC's Joe Kennan sat with President Trump to discuss a whole host of topics ranging from Federal Reserve to Trump's business dealings. Kennan asked the president about the latest jobs report and the newly appointed Fed chair, Kevin Warsh, and asked whether the stars had aligned for Warsh to cut rates. This is what Trump had to say. Listen in.
Well, he's got a board that maybe is a little bit hostile, and, unfortunately, and maybe a board that wants to do the wrong thing, so I don't know. He's a great guy and a great pro, and I know where he'd like to be, but he has to do what he has to do. I really think that I would love to be able to get back. In the old days, probably maybe before you started thinking about these things, but if you go back 20 or 25 years, when you announced great numbers, the stock market went up. When you announced bad numbers, the stock market would go down. Today, it's the opposite. When you announce good numbers, the stock market goes down, sometimes really way down, depending on how good. The better they are, the more, because they have this phobia, they have this horrible derangement syndrome about inflation. And growth can be good for inflation, not just bad for inflation. And it's a shame. Anytime numbers are announced that are not so good, I wish they could flip it the old way, that when you announce great numbers, because otherwise it's almost like they want to kill strength. They want to kill success. You announce good numbers. I want to, like, you have a couple of countries. India is one, doing very well, but it's at 7-8%. Others, take a look at Japan's numbers. I mean, they're doing very well. She's very good. She's doing a good job, a friend of mine, but they're allowed to go up. We're not allowed to go up. If we go up, they want to kill it. There's no reason we should stop at 4%. We should be at 12% and 13% GDP. And I hate what happens where in the old days we would be, that's how we built the country. Now you announce positive things and they want to bring it down by raising interest rates. And it shouldn't be that way. It should go back to the way it was.
You mentioned that Warsh might not, the chairman has other people on the Fed, obviously. It still has Lisa Cook on the Fed. The Supreme Court ruled on Monday. I'm not really sure exactly whether it was on the merits or whether it was procedure, but I think you said that
procedure.
You're going to take the appropriate action when the time comes. What could you do to get rid of?
Get her off.
How would you do it at this point?
By winning the case. They sent it back, not based on the merits. They sent it back on process and procedure. So we'll start the process and we'll do perfect process and perfect procedure.
All right, that was U.S. President Donald Trump. But remember, 4th of July weekend is here and hence the U.S. markets are shut. And that was also the reason why the job reports came in early. Now, here's some opinion from Kevin Hassett, director of the National Economic Council, on that U.S. jobs report.
The job market's been pretty strong. That the source of strength is factory building and construction. We had really strong manufacturing construction numbers. We think the manufacturing numbers are going through the roof because of all the new factories that are being built. So that signal wasn't countermanded in the data today. The thing that was a little bit of a puzzle is that we know that the World Cup is the most successful World Cup in history, and then the people who would be doing the travel and leisure support of all those fans who are in the country somehow their employment went down. It doesn't make a lot of sense to us. But for the most part, the data are 100% consistent with what we view as a very strong economy. If you average the last 2 or 3 months, the last 4 months, we've aired on the upside or surprised on the upside 3 out of the 4 months, and this one was a little bit below. But on average, we're basically headed straight up.
Let's move on from US to updates coming in from West Asia. Now, Iran's Joint Military Command issued a warning to vessels transiting in the Strait of Hormuz to follow the designated paths or encounter a forceful response. Iranian officials also said that any US interference in the Strait of Hormuz would trigger a decisive and rapid response, adding that the continued presence of US air assets across the waterway endangered regional security. Meanwhile, more than 20 million people are expected in Tehran for the funeral of their former supreme leader, Al-Khamenei, who was killed at the start of the US-Israel war on Iran. Okay. That's the update that we have coming in on the West Asia front. But on that note, we're going to step into a very short break. After the break, we'll come back and get you the updates in the world of tech and AI. Stay tuned in.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work. It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move.
Welcome back to Power Breakfast on CNBC TV 18. Now getting you the latest updates in the world of tech in our special segment AI Pulse. Rachna has moved on to the wall to give us those updates. Rachna, over to you.
Well, first up is the Supreme Court that set aside a judicial verdict built on fake AI-generated case law in a first-of-its-kind ruling. The court quashed an NCLT order in the SL Infra project insolvency after finding it relied on precedents that do not exist, calling hallucinated citations the methyl isocyanate of law, and directed the Bar Council of India to frame norms and disciplinary action. Staying with India, New Delhi and Tokyo have signed a joint AI statement at the Modi-Takaichi summit covering data centers, GPU capacity and semiconductors, with MOUs linking Sarvam AI to Japan's preferred networks and IIT Bombay's Bharat Gen to Japan's National Institute of Informatics, plus a plan to send 500 Indian AI professionals to Japan by 2030 and train them in the Japanese language. Now to Washington, where OpenAI has proposed giving the US government a 5% stake worth around $42.6 billion at its current $852 billion valuation. The talks are early and would likely need Congress. Anthropic, per a source cited by Reuters, has held no such talks to give government a stake. Now, Microsoft, meanwhile, is committing $2.5 billion to a new unit called Frontier Company, embedding 6,000 existing staff with clients to deploy AI just 2 days after Amazon's $1 billion push into the same model. Then there's NVIDIA, that's changing how it gets paid, offering startups compute through token credits in return for a recurring cut of their cloud revenue. Anthropic is also in the chip news, with the information reporting talks with Samsung on a new custom chip, though its purpose and specifications are not yet decided. And then there's Mark Zuckerberg, that told Meta staff that AI agent development has not accelerated as expected and that he expects the payoff in the next 3 to 6 months. However, now Alexander Wang, the AI chief, in a tweet has now clarified that Mark was clearly talking about the industry's progress and not just the company's on agentic capabilities. But in the town hall, per reports, Mark also admitted that the reorganization that led to multiple job cuts weren't very clean. That's all the updates that we have from the world of AI for now, but we'll get you more through the day.
Thank you so much for that, Rachna. But with that, we're going to wind down this edition of Power Breakfast. A quick check in terms of the Nifty implied open, still indicating a good, strong start for the Indian markets. Now up 149 to 150 points in the trading session is what we're expecting, at least the open to come in at. Let's see if the momentum that we saw yesterday continues. But with that, thank you so much for tuning in. Up next, your Bazaar Morning Call.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work. It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work. It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work. It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work. It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Friday morning, end of the week. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant with me, my colleagues Rima and Mangalam. Guys, good morning.
Hi, good morning. And monsoon is in full glory this week, at least. It continues. And U.S. markets are shut today. So at least that weekend overhand risk of what's going to happen with the U.S. markets. Will there be that negative implication on Monday? That's out of the way today.
And, we did well in yesterday's trading session led by the IT index. And that will be the key question, right? Whether that sustains or whether that was just a flash in the pan. As of now, the chip-related sell-off still continues overnight.
Yeah, I mean, that debate, it depends on it's almost as if, Monday up, Tuesday down, and that kind of a thing. But at some point, that will start to turn. Yep. And there are many in the market actually out there who believe that, well, this is it. And I think we had someone day before yesterday with us who said, well, I'd start. I think it was an analyst who said, well, it's time to buy. And I'd start to, I think the Elara analyst was of the view. Yes, that was my question, but he didn't say SIP. He said, well, I'll start to buy here. It's a debate which is ongoing, and we'll continue to address it. But tech stocks and not the software stocks, but the large tech stocks in the US slipped. Nasdaq was down 0.8%. The Dow, by the way, was up about 1% or so. It's made a new all-time high. So it's basically highlighting a clear distinction between where you're at as far as US is concerned. Non-farm payrolls came a day earlier because today markets are shut in the US. So payrolls were 57,000 in June. They're below expectations. I'm not going into details, but you also had some commentary from Fed officials, etc. The market pricing of Fed hikes is actually now, after the payrolls data, gone down. So 30 basis points is what the market is expecting now for the Fed to hike. It was 37 basis points prior to the non-farm payrolls data. Now, if you remember, yesterday we had S. Narain with us, and we asked him, what is the one indication, what is the one tell for you with regards to what IT stocks should do? And well, his basic point was it's too hard to say when this is going to happen and to look at the factors, etc. He just look at US tech stocks, US software stocks, and see what is happening there. It's something we've done over the last year plus since this tech sell-off started. And this is the last night change, right? So there is a bit of a buoyancy lift, whatever you want to call it. This is US software stocks, EPAM, Globant, Accenture, Cognizant, all up between 2.5%, 4%, 4.5% as well. So that is, I think that should provide some comfort as you open up as far as this morning here in India as far as IT is concerned. Remember, the IT index went up 4% yesterday. It was down 6% in the last 3 trading sessions or so. So net, you're still down 2% for the week. Is there more here is the question. Maybe not to the same sort of, velocity, the move like yesterday, but perhaps many would want to believe that we are somewhere in the vicinity broadly. You'd never know. You can't precisely point, well, that's the point where you should buy. But again, the debate goes on. There is, of course, also the debate which is going on with regards to how much large language models can do and what they cost and whether they should cost this much and, all of that stuff, right? It's heating up. We had the Palantir CEO comments, which we put in context yesterday as well. And that continues to generate a fair bit of debate, not just amongst tech leaders in the US, but of course, tech leaders here in India as well. People like Sridhar Vembu of Zoho, for example, has weighed in, and others as well. Broader markets here continue to do very well. And actually, I think that's the story. The Nifty, of course, was up 120 points yesterday, but broader markets just a really... And of course, yesterday was dominated by IT, both mid-cap and large-cap. All did very well. But even beyond that, there was a fair bit of activity and action. I'll just leave you with levels here. We've got past 24,100. The close was 24,175. The first level was 24,080, 24,100 rounded. So we are past that. The next target is 24,300. Supports come in, basically just take yesterday's low, which is 24,050. That's a very, very immediate kind of near-term pivot. And then 23,800, which is the bigger support, which the market has respected. And the Nifty is once again not broken. It's a Friday, and we've had 2 days of decent gains. And I think GIFT Nifty will come up on your screen. Perhaps it's indicating another 140-odd point gain. But, wouldn't be too surprised if you see some profit booking coming in at some point during the session. So let's see if we see that or not. But, we are up about 0.5%, a little more than 0.5% for the week now after a pretty bad start that is on Monday and Tuesday. Mangalam has walked across to the wall with the F&O data, the positioning and more. Mangalam, over to you.
Well, we've done better than most parts of the world over the last 10 days or so after underperforming for a while, and bulls are taking control of the market slowly but steadily. The question is whether that continues or not. Yesterday's as well move about 0.75% on the frontline index. It was absolutely flat for the Nifty Bank. The Nifty IT index was the star of the show. And yesterday's move was seminal in the sense that the Nifty crossed past the 100-day moving average. This line, the Nifty hasn't been able to cross all the way since February 27. So it's a 4-month technical breakout that we've seen on the Nifty. So this is an extremely important moment. The question, however, is whether IT outperforms or the rally continues or not. Perhaps yes, because one chip stock sold off overnight. The Kospi is opened lower. The IT index is above its 5-day moving average, so very near-term average. The important part is still about 800 points away from its 20-day moving average. So oversold conditions still continue. So to that extent, we may perhaps see a bit of a bounce. The other part, which was a worry for our markets, the FII selling, that has come down considerably over the last 15 to 20 days or so. And yesterday as well, they sold just about 312 crores. Compare that to the DII buying of about 1,800 crores. So net 1,500 crores coming into our market. If you look at their index futures action as well, they bought about 500 crores. A large part of that was committed towards covering of short positions and unwinding a few long positions as well. But the internals out there, they too are fairly positive. They committed about 1,400 crores to stock futures, and they sold about 6,600 crores worth index options. And that selling was entirely moved towards selling of puts, which tells you there is fairly strong support. And call writers were caught on the wrong side. So we saw some short covering at the 24,000 call, the 24,050 call, as well as the 23,950 call. So those call writers who were caught on the wrong position were actually covering their positions, and that caused the market to move higher. While that happened, the put writers got equally active as well. So we got 24,100 put, which saw a fair amount of writing, 24,150 put, and 24,200 put. What does all of this mean? That the support of the market, which was earlier between 23,850 to 23,900, has now moved higher to 24,050 to 24,100. And that's a big positive. But the only fly in the ointment is the put-call ratio has moved swiftly to 1.28, which is actually at the higher end of the range. So do we see some profit taking ahead of the US market not trading today or not is the big question. But the road is fairly clear. The Nifty is moving towards the 200-day moving average, which is 24,872. And so long as the Nifty Bank stays above its 200-day moving average, which is 57,200, we have no real problems for the frontline index. 24,000 support. The next big target would be closer to 24,872.
Thank you very much for that. One more sector I'll watch today, and that's metals, because the dollar index is also eased. Yesterday, it was at 101.4, and today, this morning, at 100.8. So some easing in the dollar index, so that's positive for commodities and metal names. Let's get to the equity calls then. It's Lawrence Belanco of CLSA who says, while the Nifty itself remains trapped within a broad trading range and lacks a clear directional catalyst, underlying market breadth remains constructive. He says the impending breakout in the Nifty Midcap 100 suggests risk appetite is strengthening outside the large cap universe. He adds Shriram Finance and Lodha Developers stand out as technically attractive opportunities, both having recently completed significant basing and consolidation pattern breakouts. Well, let's get you the big CNBC exclusive, and that's with none other than the U.S. President Donald Trump. CNBC's Joe Kernan sat down with Trump to discuss a whole host of topics ranging from what the Federal Reserve is going to do, Trump's business dealings. Kernan also asked the president about the latest jobs report and the newly appointed Fed Chair Kevin Warsh, and asked him whether the stars are aligned now for Warsh to cut rate given the weak jobs data that we got yesterday. This is what Trump had to say.
Well, he's got a board that maybe is a little bit hostile, and, unfortunately. and maybe a board that wants to do the wrong thing. So I don't know. He's a great guy and a great pro, and I know where he'd like to be, but he has to do what he has to do. I really think that I would love to be able to get back. You know, in the old days, probably maybe before you started thinking about these things, but if you go back 20 or 25 years, when you announced great numbers, the stock market went up. When you announced bad numbers, the stock market would go down. Today, it's the opposite. When you announce good numbers, the stock market goes down, sometimes really way down, depending on how good. The better they are, the more, because they have this phobia, they have this horrible derangement syndrome about inflation. And growth can be good for inflation, not just bad for inflation. And it's a shame. Anytime numbers are announced that are not so good, I wish they could flip it the old way, that when you announce great numbers, because otherwise it's almost like they want to kill strength. They want to kill success. You announce good numbers. I want to, like, you have a couple of countries. India is one, doing very well, but it's at 7-8%. Others, take a look at Japan's numbers. I mean, they're doing very well. She's very good. She's doing a good job, a friend of mine. But they're allowed to go up. We're not allowed to go up. If we go up, they want to kill it. There's no reason we should stop at 4%. We should be at 12% and 13% GDP. And I hate what happens where in the old days we would be, that's how we built the country. Now you announce positive things and they want to bring it down by raising interest rates. And it shouldn't be that way. It should go back to the way it was.
You mentioned that Warsh might not, the chairman has other people on the Fed, obviously. It still has Lisa Cook on the Fed. The Supreme Court ruled on Monday. I'm not really sure exactly whether it was on the merits or whether it was procedure, but I think you said that
procedure.
You're going to take the appropriate action when the time comes. What could you do to get rid of?
Get her off.
How would you do it at this point?
By winning the case. They sent it back, not based on the merits, they sent it back on process and procedure. So we'll start the process and we'll do perfect process and perfect procedure.
Well, we'll keep getting you excerpts from this exclusive interview. But for now, let's invite Adrian Movat, investor, Hong Kong SAR. Adrian, thank you very much for joining in. Good morning to you. Let me begin then with, not about Trump, but what the Palantir CEO, Alex Karp, had to say. And he was actively pushing for custom AI models. He's sort of warning companies against using third-party frontier models like OpenAI, Anthropic, saying they're expensive, they waste money, no value add, and you risk sharing all your data intellectual property. If there is a pivot towards, custom AI models, it will be positive for India and software, but that remains to be seen how it plays out. But Bain, on what's happening with the AI stocks, are you sensing some fatigue setting in, investors looking to broaden outside these few AI names? What is the investment call that you're taking?
Look, I think the AI story seems to have been quite logical in terms of the way the markets played out. So initially you had X7 performing well. So the hyperscalers were the big story, as was those with indirect exposure to the large language model manufacturers or developers, such as Microsoft owning a stake in OpenAI. It then moved to who is providing the infrastructure, and then it particularly moved to the semiconductor space, which really has been the story of 2026, particularly the memory manufacturers, but it's also broadened to the likes of Intel. So you've had stocks more than doubling in the case of Sandex, up some 6 times. Then when you look at the valuations of these stocks, most of them are on single digits next year's multiple. Even an NVIDIA is on 16 times. So the earnings revisions have certainly justified these moves. Now, I think it is understandable that after such large moves in the semiconductor space, that you're beginning to see a fair amount of volatility and probably a consolidation phase, and the market sort of thinking about how long these very high margins are going to last in the semi space. So that all looks quite logical to me. I think the next stage for as we look into 2027 is which are the businesses that are going to use AI to either drive higher revenue and or reduce costs. And I think that's going to be the theme. So it's going to be the theme of monetization, it's going to be the theme of how do we sustain this AI story by proving that there is a broader benefit for companies. Now, whether that is through customized large language models or through, I think, probably much more an open source and a large language model agnostic view to how you use AI, that'll be determined over the next couple of years.
Got that. Adrian, but you see no reason why will this show up in US tech stocks in a big way, you think? The large 7 companies have anyway underperformed in a material way this year. But what's your sense?
So, as I was saying, I think it's all been quite logical. The suspicion that around the hyperscalers spending too much money and a question mark on whether they get a decent return on that is very evident in the share price performance of Microsoft, which is down nearly 25% from its 52-week high. I mean, it's even more extreme in places like China. Alibaba's almost half its 52-week high. Again, a sort of a local hyperscaler cloud computing provider in China, even though their actual cloud computing business is doing extremely well. So I think that the market is quite cynical about certain parts of the AI trade. And the story of this year has been a market that's been driven by a very narrow theme, which has been the semiconductor space.
Right. At some point, do you see the theme broadening out and perhaps come back to India as well? Because a couple of macros, as S. Narain pointed out yesterday as well, have been in our favor. The corporate profits to GDP ratio is at the highest that we've seen in a while. At the same time, our valuations on a 1 year forward are actually about 10% below long-term averages. The underperformance in the Indian market and the recent underperformance of Korea, do you think the scales shift towards India right now? Were there to be some interest in EMs?
So, there's been some pretty nasty bear markets out there in EM, whether it's India, China. I was in Manila yesterday, which is record valuations. So, you had some comments from Lawrence on the technical position in the Indian market, where he was talking about, consolidation setups for more constructive moves. I think that's definitely what we should be looking for now. At the moment, I'm struggling to see the sort of powerful catalyst that would make the FII wake up and think I need to get a bit more money into India. Now, that usually will be something to do with earnings revisions. And at the moment, earnings revisions have still been relatively poor within the Indian market. So if we could see some news that perhaps is better for growth, maybe that could be that the oil price turns out to be significant here, and that helps the sort of pressure on the Indian rupee, perhaps helps the sort of purchasing power of the Indian consumer. These are the sorts of things to look at. So I think this is more a time for doing your homework, looking at companies very inexpensive relative to their long-term trading history, and maybe start to patiently accumulate those rather than assume that you're going to get sort of strong performance out of the market near term.
So India lacks a powerful catalyst that will make the FIs wake up and invest in India. So does India continue to underperform as things currently stand? And if you had $100 to invest in emerging markets, how much would you allocate to India?
So I would, as I said, perhaps sort of looking for a few things to accumulate at the moment. It would still be an underweight of India relative to the benchmark point in time. I think to me, perhaps the Indian IT companies are going to be the bellwethers here, because if the Indian IT companies can prove that they can use AI effectively, that they can be constructive towards their customer base, then that would probably be a powerful signal. At the moment, the market's very cynical about that, though.
Adrian, what about software companies? As market is working through all this debate around these large language models, etc., does it reduce the fear that all these large language models will kill the software industry? So maybe at the margin, it's a bit of a positive for the software sector?
I think the entry point, the selling point that these companies need to make is around security, cybersecurity, the protection of data. So, I can think of quite a lot of anecdotal examples of friends who are working in large corporations where their access to large language models is very restricted because the company is cautious about cybersecurity, cautious about leaking out confidential information, damaging to their IT infrastructure. And that, to me, is where the Indian software companies be focusing, giving companies the reassurance, giving them the controls around artificial intelligence processes that give them the comfort. That would be the angle that I'd be pushing.
So you're saying that's the edge that these companies have in this changed environment?
That's the edge they need to prove. It's not clear that they have that edge at this point in time.
But if security, trust, etc. is the edge, I mean, they already have it, Adrian, isn't it? I mean, they work with some of the largest Fortune 500 companies. They're deeply embedded. They worked with them for 20, 25 years. And on-premise, off-site. So that already is there, I assume.
Look, I agree with you in that observation. It's interesting. It doesn't seem to be the communication they're coming out to the market with clearly.
I see. Got that. Anything else on which looks out of whack, Adrian, in the world? A lot seems out of whack every day when we wake up. There's so much going on, right? Anything you want to point up? Yeah.
I'm still anxious about what's going on in the Middle East. The Straits of Hormuz is neither open nor closed, and there are some specific shortages of refined products around the world. So I think we've still got to be a little bit cautious about seeing some supply disruption as the inventory levels have been drawn to very critically low points. I don't feel that the negotiations between the US and Iran are going smoothly, to say the least. So let's remain a little bit cautious about that.
Yeah.
Okay. Thank you, Adrian, for a well-rounded interview with us. Thank you once again for joining in.
It just reminded me of when he said the Strait of Hormuz remains closed and open. It could probably be Schrodinger's Strait.
Neither open nor closed.
Neither open nor closed.
All right, let's get to the interactions then. Lined up on the show coming up 8:35. The management of Corona Remedies will discuss the recent stake sale and the road ahead. 9 a.m. Sovilo investment manager Sandeep Agarwal will put the spotlight on the IT sector. 9:20. Shreyas Devalkar of Axis Mutual Fund will be the market master for the day. 9:30. The management of Bajaj Auto will talk about the June sales numbers and the strong strength seen in exports. Following that, we bring you a discussion around Delhi's EV charging station expansion. 9:50. We'll be joined by JP Morgan's Abhinav Bharti to put the focus on the IPO pipeline in the second half of the year. And towards the end of the show, Lata will speak to Saurabh Garg, Secretary in the Ministry of Statistics, on the new IIP series and the other must be data.
Right, we'll take a short break, but a lot of stock-specific action to track today. A lot of the first quarter updates that have come by, so we'll get to it in just a bit. But just to give you a preview, we're looking at Bajaj Finance, Marico, M&M Fin, Union Bank, all of them on the back of positive news flow. Then we have Tata Motors PV, Avenue Supermarts, Punjab National Bank and PB Fintech, all of them that are likely to open in the red. While there are mixed views on both Bajaj Housing Finance and Adani Enterprises, we'll tell you why.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work. is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
Welcome back. Let's talk about stocks. This is CNBC TV 18's list of top stocks for the day. And on our list, a lot of companies where we've got the pre-quarter updates. Let's begin with Ananya on Bajaj Finance and Bajaj Housing. Ananya, good morning.
Good morning. So let me first start with Bajaj Finance. So they came up with strong numbers. The AUM grew 24% year on year and 7.2% sequentially to 5.47 lakh crore. Now at the higher end of its 22 to 24% FY27 guidance. Now if we see historically, the company consistently delivered around 25% to 30% AUM growth. But over the past few quarters, management has moderated its guidance to focus on sustainable growth and maintaining stable asset quality. Now, despite this, the quarter saw record customer additions of 5.1 million customers and a 20% rise in new loans to 16.13 million. Now, deposits remain flat. Sequentially, brokerages remain bullish with Morgan Stanley and JP Morgan maintaining overweight ratings, while Jefferies and Citi continue to rate the stock buy, with the target price ranging from 1100 to 1200. Now, now coming to Bajaj Housing Finance, they reported steady operational performance with AUM growing 24% year on year to nearly 1.5 lakh crore and disbursements rising 33%. Now, following the update, JP Morgan upgraded the stock to neutral from underweight, raised its target price to 85 and placed it on positive catalyst watch. Now, however, the stock continues to trade at premium valuation compared to peers like PNB Housing Finance and LIC Housing Finance.
All right, Ananya, thanks a lot for that. So those are a bunch of stocks that we will be tracking today. But Darshan joins in. He's got updates on Tata Motors passenger vehicle.
So company has reported quarterly volumes for JLR, and JLR remains a drag for the company, and this JLR forms almost 70% of company's total volume. That's the reason we keep tracking Tata Motors passenger vehicle. In Q1, wholesales were down both sequentially as well as year on year. Sequentially, it was down 9%. Year on year, sequentially it was down 17%. Year on year, it was down 9%. If you talk about the retail sales, YY, it was down 15%. Even on a sequential basis, it has seen a fall of 14%. And except the market of UK, all the other markets have seen a fall more than 10%. Volumes were affected by companies given certain reasons. First, supply constraints. Second, there was a fired component supplier. Third, West Asia tensions and planned wind down of outgoing Jaguar models. While volumes are weak, but mix towards Land Rover remains strong, and this quarter it has increased to 81% versus 77% in the same quarter last year. But considering the volumes remain weak, I'm going with red.
Right, thanks very much. For that, well, let's move on and go back to financials. Okay, I think let's just talk about DMart, which also had the numbers. 15% growth, right, Mangalam?
Yeah, 15% growth on DMart, and the street was prepared for a weak set of numbers, which is what explained why the stock was lower in the last two trading sessions as well, in an otherwise fairly strong market. And 15% growth, actually, if you compare to all the other value retail peers, has been fairly soft on DMart. Revenue growth of 15%. They opened 3 stores during the quarter. Their total stores now stand at 503. Year on year, their store addition is 18.5%. So that tells you that, if you just do a basic arithmetic, intuitively there has been a negative same-store sales growth, which may impact their margins in this quarter as well. There are a couple of reasons for that. My sense is that the company, after the fourth quarter, had said that there was some pantry stocking because of the uncertainty that came undone in the first quarter. So that could be one of the reasons. And the second part, between last year and this, we had the GST cut that came by as well, right? So realizations may have reduced. All said and done, even then, it may at best be a flattish sort of same-store sales growth. And the company has announced that they will consider raising funds via issue of debt securities on July 11th as well. Not necessarily a bad thing, but why does DMart need debt is one of the questions that the street may have and may ask of the management. So that's something that may keep the stock under pressure in today's trading session. But I'm looking at Marico and no problems there. For the nth consecutive quarter, it is a solid update that has come in, and that explains why the stock has also been a rank outperformer in the FMCG space. Consolidated revenue growth in early 20s, domestic volume growth in double digits at a multi-quarter high. Value-added hair oils, which was under pressure over the last few quarters, actually has now come back. Growth of almost 20%. Parachute growth in double digit, the highest that we've seen in a long time. And gross margins improved quarter on quarter as copra prices are down 45% from peak. So the company said they expect strong operating profit growth due to lower input prices and strong revenue growth. So across the board, Marico's been doing extremely well. So going for strong, bright green for Marico.
All right, that's about the consumption space. Let's go back to Ananya for more on M&M Finance, PNB and Union Bank. Ananya.
So Mahindra and Mahindra Financial Services, they reported a strong set of numbers for FY27 with disbursements rising 21% year on year and business assets growing 12% to 1.37 lakh crore. Now collection efficiency remained steady at 95% while stage 2 and stage 3 asset quality continued to improve. Now liquidity also remains strong at over 14,600 crore. On the brokerage front, Citi has maintained a buy rating with a target price of 380, while Jefferies has retained its hold rating with a target price of 325. So now coming to PSU banks, Punjab National Bank reported a stable quarter with advances rising 13% year on year and deposits up 8.5%. Though deposit growth remained slightly below management guidance, Citi has maintained a sell rating on the stock with a target price of 103. If we see quarter 4, the numbers were quite strong, but in Q1 FY27, the growth moderated a bit. So, investors did watch out for that. Now, Union Bank of India also posted a mixed but stable update with advances growing 12.5% year on year and the CASA ratio improving to 35%. However, deposit growth remained subdued at 3.5% year on year and declined 1.8% sequentially, making deposits the key monitorable going forward.
All right, Ananya, thanks a lot for that. But a lot of stocks on account of some supply coming in or fundraise coming in. We have Vivek joining in, Adani and PB Fintech. Vivek.
Well, good morning. Let's first start with PB Fintech or Policy Bazar, as it's so popularly known as. So, private equity firm Temasek, the arm of the McRitchie Investments, is looking to sell close to 2.6% equity in the company. They should be able to mop up over 1,900 crores from this particular block deal. The floor price is at almost 5% discount, 4.6% discount to be precise, at 1,604 rupees a share. Now, post this particular sale, the seller will have a lock-in of 60 days before they can sell further shares. The other stock on the radar is a very large QIP coming in from Adani Enterprises. Last evening, we accessed the term sheet. We understood that the company was looking to raise close to 10,000 crore, but we understand that the demand has been quite robust and their book size has been upsized to 15,000 crore rupees from the earlier envisaged 10,000 crore rupees. Now, we understand that the indicative issue price for this particular QIP fundraise is at a 9.2% discount to yesterday's close at 2,883 rupees a share. So that should result in an equity dilution of close to 4%, 3.9% to be precise.
Thank you very much for that. I'm also watching out for HCLTech because the company in the morning just announced a large deal win of $1.1 billion. It's for 5 years and it's an entirely net new deal. And there is an option of extending this deal for the next 5 years. And it comes in from a European company. So Europe outsourcing seems to be opening up. And what I understand is that this is the largest deal win for the company since the Verizon deal, which happened 2 years back. And that was over $2 billion. So it's a large deal win. And I think that provides some confidence for the IT names today. A quick recap then of the top stocks that we're watching today. Stocks with positive news flow are Bajaj Finance, Marico, M&M Finance, Union Bank. Stocks with negative news flow are Tata Motors Passenger Vehicles, Avenue Supermarts, Punjab National Bank and PB Fintech. Mixed view coming in on Bajaj Housing Finance and Adani Enterprises. Well, let's talk commodities now. As always, Manisha joins in with a complete roundup. Manisha, what do you have for us?
Thank you so much for that. Well, I'll start with the precious metal prices because that is where we are looking at the best of the gains. The gold prices gained 2% overnight and we are back above $4,100 an ounce. Silver clearly has been an outperformer, 3% up for in the overnight market, and it's back at $62 a barrel, $62 an ounce as well. we did see the prices decline to 57 on the lower side. Well, the precious metal prices have gained as the US dollar index has come off slightly, and the US jobs data has come in at 57,000 jobs versus 110,000 of an expectation. The Fed fund futures also are now looking at a lower possibility of a rate hike going forward in this year. That's about precious metals, but the crude oil prices also seem to be looking at slight support into the markets right now. They're back at pre-West Asia conflict levels. The commercial shipping through Strait of Hormuz continues to recover. 10 million barrels per day is what we are looking at via the strait. So whether it's about Saudi Arabia, Iran oil, UAE, all of that export seems to have increased. There's one thing that the markets will watch out for, and that is the OPEC meeting on 5th of July. And apart from that, it is about the U.S. non-farm payroll data that comes in today. These are the two things that would set course of direction.
Thanks very much for that, Manisha. So that is oil in focus. We'll take a break. We are back. We have, of course, our guest joining us on the other side. We'll focus on markets, but we also the management of Corona Remedies. Bhavin Bhagat is with us on what's happening with the business, the recent stake sale, road ahead for the company. And, of course, we'll talk markets with our guests as well. Sit tuned.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work. It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
Welcome back. You're watching us here on Bazaar Morning Call this Friday morning. The Gift Nifty indicating a fairly stellar start after a good close yesterday. The IT stocks, will they continue their rally or not is the big question. For now, all things seem to be in place. But let's welcome the first corporate on our show. We do have Corona Remedies, as there was a block deal where CPI Investments and Anchor Partners sold some of their stake in the company. Bhavin Bhagat, who's the CFO, joins in to discuss obviously whether there is more supply of paper likely, revenue expectations from some of the acquired brands of the company, and an update on their international market itself. Thanks a lot, Mr. Bhagat, for joining in. And, that really is one of the concerns, because CPI Investments, who held about 19% stake in the company, have offloaded about 7.5%. Typically, when something like this happens, it points towards a clean-out trade over a prolonged period, over the next few months. Have you heard from them on their way forward, them continuing to hold this stake, or at some point exiting?
Good morning. First of all, thank you so much for inviting me. As far as the Sepia sale is concerned, Sepia plus other shareholders comprising of the Chris Capital stake comprise of 21%, at present. And out of that, they have sold 7.3%. So yes, there is a 14% still block available for them to sell in coming days or months to come in the market. But having said that, we don't find any push in the stock price or any push in our existing structure is concerned.
But is there an exit mapped with Chris Capital's APR investment? Have they indicated by when they would like to completely exit? Because they've made a lot of money. Stock is trading well above the IPO price. So what's the exit map and is the timeline for that?
Of course, they made a lot of money because when they entered our company, the post-money valuation was 2,500 crores. And right now it is almost near to 12,000 crores market cap. So yes, they had made money, but there is no sign from their side for the further sell-off in the market.
You said that there is a 14% block which is still available with them to sell, but that is not likely in the very near future, or is it possible in the very near future?
To be very honest, we don't know about it. We just focus on our business, and that is what we do.
I understand that, and I'm sure, the exit has been fairly well strategized as well, because the buyers are fairly strong. You do have Aberdeen buying, HDFC MF buying, Aditya Birla Sun Life, Invesco. So there are a clutch of strong domestic buyers as well. But typically when there is this selling overhang, it keeps a bit of a lid on the way the stock moves as well. But that apart, since your focus is on business, we had earlier said that, there was a higher employee cost that weighed on margins in the fourth quarter. You said as that pans out and as those employees start to leverage their business, the margin outlook would improve. Could you give us a sense on what your margin targets are? How did the first quarter perform? And by the end of this year, how close to the 24% mark will you be?
So first of all, yes, there was a margin pressure in Q4 FY26 due to the expansion in our field force. It is a matter of divisionalization because of which we expanded. So it is a normal business course of expansion which will help our company to grow further in coming years down the line. Having said that, this margin expansion will cool down in FY27. So the operating leverage will start coming in by the end of FY27 in coming years down the line.
So last year you ended with margins of closer to 21%.
Yes.
What's the plan for this year? What's the target? And your next 4-5 year target is 24%. So does it go, sequentially, logically?
So we have given our guidance in two forms. One in revenue and second in profit after tax or PAT. We will be growing by 15% organically in revenue. Any inorganic acquisitions, whatever we do, will be added in the revenue basket. And as far as the PAT is concerned, we will be consistently growing our PAT by 20% for coming 3 to 5 years. So we have given guidance on revenue and PAT.
So you're
sorry, Bhavin, I think you've also met investors in Singapore, and you've said 24% EBITDA margins, right? Over the next, but that's a slightly longer term guidance, 4 to 5 years.
Yes, it is a 4 to 5 years guidance.
Okay, so from current level to 24% in 4 to 5 years, but 15% top line, 20% profit growth. That is going to be sustained.
And on an organic basis. If we add anything inorganic, it would be added into it.
This includes, this guidance includes the Bayer portfolio, the Vocadine portfolio, etc.?
No, the Bayer and the Vocadine portfolio is not included in our 15% guidance. It would be added. As far as the Vocadine is concerned, the internal revenue was 20 crores. We are expecting 25% growth in the Vocadine portfolio for coming 3 years down the line. So it will add to a revenue basket. And as far as Bayer is concerned, we have relaunched the entire portfolio. So we have launched from the scrap and now we'll build it.
I see. And of course, I mean, the India the business is driven by what you call these engine brands, right? Some 75 odd.
So we have total 76 brands, out of which 32 brands are engine brands. Engine brands are those brands who have potential to cross 100 crores. And these 32 brands contribute 76% of the total revenue, which is growing by 19% since last 3 years.
I see. Wow. You got some... there's no dearth of growth. If that is what is happening, but what is this led by? What specific? Is there a big champion brand which is leading this, or are all these 32 are growing at equally promising? Just give us some color.
Yes. So these 32 brands are growing by almost 2x than how the IPM is growing. Point number 2, we have 2 champion brands named B29 and Myogil, who is in the club of 100 to 200 crores. And the other brands are roaring to join this 100 crore club in coming years down the line.
Right. On the acquired portfolio of Bayer, can you do up to 35 to 40 crore in this year and maybe a little more next year? What's the path here?
It is too early to comment on that side, but having said that, we acquired this Bayer portfolio at a value of 7 CR. And what we are trying to achieve by the end of this year, we are eyeing that we may achieve 25 crores from this brand, and coming 3 to 4 years, we may reach up to 100 crores from these brands.
Got it. Because that's an important one. Brokerages were expecting 35 to 40 crores. You say realistically you can do about 20-25 crores by the end of this year.
Yes.
And
yes.
over the next 4 years, this becomes 100 crores.
Absolutely.
All right.
Sir, you also, explicitly said the organic revenue growth is going to be 15% plus this year, and that's been your medium-term guidance as well. Are you looking at any inorganic moves? Any acquisitions this year?
So we are looking after inorganic side, but it is very difficult to tell you at this moment because it takes a lot of time and pain to identify these brands because you have to see our understanding or the thought process or the philosophy what we have. We don't acquire the brands which are available in the market. We see 3 important things whenever we go for acquisition of any brand. First, a strong brand recall value for that particular brand. The second is the science underlying that brand, which is also most important. And third, which is last but not the least, is the perfect fitment in our portfolio. If all these 3 philosophies are being met, then we go all out for these brands. And yes, we are looking for the brands, but right now we are not sure about what to go and what not to go.
Got that. Just a final question from my end, Bhavin, and this is the question I guess a lot of people would want to know as well. GLP-1, that's all the rage, right? You launched your product in April 2026 through a partnership with MSN. What's the target here for this year? What's the total addressable market? And what are you eyeing over the next 3 to 4 years?
The entire Indian pharmaceutical market is almost 250,000 crores. So, yes, it is too early to comment on a semaglutide of GLP-1. But having said that, we are into race. We are into the top 10 pharma companies out of 35 to 40 companies who have launched semaglutide. So we are one of them and we are into top 10 and we will continue to be in top 10. But about the revenue side, it is difficult for us to give the numbers. But having said that, we are seeing semaglutide not on the first and foremost side, but that is an important brand for us.
Vodakaine you bought from Dr. Reddy's, is it?
Yes.
Right. And you think you'd be able to sort of build it?
We'll double the revenue in coming 3 years.
I see. Was there an issue of, for Dr. Reddy's it being too small, so there was little focus, or was it something else? Obviously you think there's potential, but Dr. Reddy's sold it, so I'm just trying to understand.
So whenever we acquire a brand, we always see that what we can do with that brand. Okay. We never see why the brand has not performed in the other company. But whenever we acquire a brand, we always see that what we can generate more from these brands. And that is what we look for.
Got it. We'll leave it there. Thank you very much for joining us. Good speaking with you. Very, very confident commentary. 20% net profit growth on a steady state basis. 15% on the revenue side. Bhavin, thank you.
Thank you so much. Thank you so much.
Okay, well, I think we're going to take a quick commercial break here. And we'll come back with markets. Siddharth Khemka, Motilal Oswal Financial Services, with us on the other side. Stay tuned.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
Welcome back. I think there's, 11 minutes to go for the pre-open session to kick in. Let's get the big movers and shakers from yesterday, and every day there are many. Hormuz sort of sorts through them and identifies a few names. Hormuz, take it away.
Morning, Prashant. And IT, of course, you cannot talk about that at the start. It's the day that belonged to them yesterday. And all of them, Infosys, TCS, persistent, rebounding after that 3-day sell-off. The F&O side of things as well, and the premiums going up anywhere between 65% to as high as 100% for their most traded options in yesterday's trading session. The 1100 call for Infosys, the 2100 call for TCS, and the 4500 call for Persistent Systems. The volumes were more or less in line with their 20-day average. There was no significant up move barring Persistent, whose volumes were double of its 20-day average. But on the delivery front though, look at the volumes there. The delivery volumes for Infosys at 43% were lower than their 20-day average. For TCS were more or less in line at 47%, and for Persistent too, they were in line at 37%, which is the 20-day average volume delivery volume as well. Now you take a look at Exide Industries. Both Exide and Amara Raja did well in yesterday's trading session. The biggest single day gain in over a month. It was the third straight day of gains for the stock. The 420 call option yesterday was among the most traded. The premiums went up by more than 3x in yesterday's trading session on that 420 call option. The volumes were the highest in a month as well. 2 crore shares were traded. The 20-day average is around 26 lakh shares, and a quarter of those were marked for delivery. So well over 50 lakh shares for delivery. That too was 5x its 20-day average, and gaining around 15% so far this year, is also closing in on its 52-week high, which is at 431. And lastly, Zensar, the smaller IT names were the bigger outperformers yesterday. The biggest single day gain since January of 25, and the volumes were the highest since November of 2021 yesterday. Close to 4 crore shares were traded. The 20-day average is only 7 lakh shares. 5% of those were marked for delivery, so around 20 lakh shares for delivery. That too was almost 7x its 20-day average. There still remains below its key moving averages, those Zensar. The 50-day moving average now on the upside is at 490. And I wanted to highlight this simply because the stock has declined in every single month since the start of the year, and it is only now in July that it has gained over the last couple of days. And the stock, despite this brief move, is down around 33% so far for the year.
All right, Hormaz, thanks a lot for always putting some of those stocks and their delivery data up for all of us here. Let's get in an important comment that is coming from the Union Petrol Minister Hardeep Singh Puri, who's ruled out a fuel price cut for now. During an interaction with the media in Delhi, he said that there is a case for a cut only if lower crude prices hold for the next 2 to 3 months. Let's listen in.
The crude that the petrol and diesel that you buy at the dispensing station today, that crude would have been obtained 2 months ago, because you float a tender, you buy the crude. So it's bought either at the price, it has to be bought at the price available then. So 2 months ago, or whatever the representative, 6 weeks or 3 months, or I don't know, then the price was not this price, it was higher price. The cost of insurance freight was also that price. So today that crude is being sold. Customers, it wasn't raised, but the oil marketing companies were losing. Now, if the question is, when will you bring prices down? Well, as I said, now they are still carrying the stock which was bought at a higher price with higher insurance, higher freight rates. If this persists next 2-3 months, then that would be a legitimate question. But, that's hypothetical. I won't get into that case.
All right, at least for now, it doesn't look like there is going to be a retail fuel price cut because companies are sitting on high-cost inventory. So we'll have to wait to see if there is a sustained decline or prices stay at these levels for the next 2 to 3 months before we can expect any move. Siddharth Khemka, Motilal Oswal Financial Services is now joining in. Siddharth, thank you very much for joining in. Yesterday, we had a big move in names like an Exide, Amara Raja, as lead prices hit their lowest levels since 2025. So it's positive for battery margins. And these are companies doing well. So Exide's had a good run in the last 3 months. Are you bullish from here on?
Hi, good morning. I think you look at both of these stories, Amara Raja as well as Exide, while the traditional business that sees the ups and downs, the auto cycle recovery is there. But I think the larger story is the battery energy storage, where they are getting in the EV batteries, the lithium-ion batteries, and both of them have done their tie-ups and the manufacturing is likely to begin. So I think while the near-term growth may be hinged to the auto cycle, but I think FY28 onwards, the growth recovery in both Exide as well as if you look at Amar Raja, I think we are seeing a strong earnings growth driven by the EV batteries, the lithium-ion batteries, as well as the demand from the BESS segment. So while again there are sentiment-driven approach, I think if you look at both Exide, which continues to trade at a premium valuation compared to Amar Raja, we like both the stocks, but purely from a valuation perspective and on a growth perspective, we believe that Amar Raja is kind of better positioned while the Exide that continues to do well.
Right, so you think Amara Raja is better positioned even as Exide continues to do well. What did you make of the quarterly updates that came in from both DMart as well as Marico? Marico, the stellar run continues.
Yeah, Mangalam, I think that's one FMCG company that continues to surprise the street on the positive side, continuously coming out with strong business updates and numbers. I think the domestic business has seen further acceleration, delivering double-digit volume growth, and the volume growth is now multi-quarter high. Q1, we are expecting the consolidated revenue to grow at early 20s, driven by the robust, broad-based performance across its core digital as well as international business. Our overall view continues to remain positive on Marico, given its growth aspiration. We are penciling in a 12% revenue and around 19-20% EBITDA CAGR over FY27-28. And given this strong growth trajectory, diversified revenue streams, we believe that the premium valuation could continue, and we have a positive view with a buy rating. Current target price is about 950, but I think there would be even further upside if the company continues to deliver this kind of steady growth.
Okay, that's on Marico. Any standout update that you heard from the banking NBFC space so far, the stock to really watch out for?
So I think Adima, Bajaj Finance on this high base continues to again deliver steady numbers, AUM growth of 24%, and new loans grew about 20%. I think that is something that is a stellar number from a large cap like Bajaj Finance. And I think Q1 numbers will be very standout number for Bajaj Finance given the current environment. The company is aggressively using the AI-led transformation in the industry, which kind of clearly is enhancing its productivity, improving the customer experience, as well as materially reducing costs. I think growth will be there across businesses, and credit costs are likely to moderate. And that will be a big positive for Bajaj Finance in the large cap space. That is what we believe.
Okay, so that stay on. Need to slip into a very short break. We'll come back. We'll get the pre-opening rates. We'll also be joined by Sovilo investment manager Sandeep Agarwal to put the spotlight on the IT sector. We'll connect with Shrikant Chauhan and Mitesh Thakkar for some technical trading ideas.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
Welcome back. 15 minutes for the market to open. Pre-opens, obviously, early days settling in. We're just trying to get to some of the numbers that have come by. We'll obviously continue our conversation with Siddharth Khemka. Sid, overnight we also got some strong updates coming in from the likes of Bajaj Finance, Bajaj Housing Finance as well. The AUM growth about 24%. Both Bajaj as well as Finance and Housing Finance showed AUM growth of upwards of 24%. And then you had decent numbers coming in from M&M Fin as well. Anything in particular that stands out in the NBFC financial space for you from the updates?
So yeah, definitely, Mangalam. I think Bajaj Finance we just discussed that clearly stands out. Bajaj Finance, although the numbers are good, I think they're showing some recovery, but valuation-wise, we're still not that comfortable. Hence, we have a neutral view. I think Mahindra Finance, M&M Finance, that has again kind of shown a strong growth. M&M, if you look at, they've kind of stand out in the tractor sales that continues to do well, and even M&M Finance with a strong disbursement growth of 21%. I think that is pretty strong, and we believe that this could be another standout numbers in this current environment. However, again, I would say that given the current environment of a weak monsoon, we would prefer a much more diversified player like an L&T Finance compared to an M&M Finance. But nonetheless, I think good numbers coming in from some of these mid-sized PSU banks yesterday. Today, I think some of these NBFCs coming up with strong numbers. So for the financials, I think this is set out to be a strong Q1, which should help the market sentiments also.
Right. The other thing that could help the market sentiment is the rupee as well. Opened fairly strong versus yesterday's close of around 95.35, has now opened at around 95.2, swiftly around 95.25 as well. So rupee's been fairly contained, and that's reflecting in the kind of moves that we've seen in the market and flows as well. Sid, we'll come back to you in just a bit. We have Mitesh Thakkar as well as Shrikant Chauhan joining in. Mitesh, how do you feel this Friday morning after a closure above the 100-day moving average and, the GIFT Nifty indicating 150 points on the upside?
Good morning. So, past 2 days, the view was that we kind of hit the lower end of the range, which is 23,800, and we should now head towards the upper end, which is 24,300. I think the opening today morning would be around 24,300, 350 zones. I think I would want to wait and watch. In case we don't decline post the opening, I think good chance that we will see the Nifty head towards 24,600 in the near term. In case we start to decline, then I think, as we get below 24,270, 250, you might want to take some profits on the long positions. But in case the gap up sustains, there's a good chance that we'll head towards 24,600 and eventually even break beyond that. So overall, it's a positively biased view. Majority, the indicators on the stock indices as well as Nifty and Bank Nifty are positively shaped. So my belief is that there's a higher chance of us heading on the upside.
All right. We also have Shrikant Chauhan with us. Shrikant, do you see the Nifty, would it make sense to chase the gap up, or you wanted to moderate a bit?
Good morning, Mangalam. Good morning, everyone. So yes, in case if there is any minor decline during the day, then there we should look for taking some long bets. The way the market yesterday closed above the important mark of 24,150, 200, we can expect gradual upward activity towards 24,600. That's my view. And today, if there is any correction, let's say close to 24,300, there we should look for taking some long bets. Eventually, as Mitesh said, I am also of the view that market is preparing to cross the level of 24,600. Yesterday, we saw some pause in Bank Nifty, but again, we can expect upward continuation and the next possibility of hitting 59,500 or 60,000.
Okay, let's talk about stocks then. Shrikant, what would you go with?
So at this level, technically, we like Bajaj Finserv, which yesterday closed around 1855. There we are expecting move towards the levels of 1920 or 1930. Here we should look for adding long position at current levels with a stop loss close to 1825. The other stock on which we are bullish is Axis Bank. And there also we have bullish view. Currently it is around 1365, 1370. But the next possible levels are 1425, 1430. So at this level, it's a buy with a stop loss close to 1330.
And Mitesh, what would you go with this morning?
So I have more of buy calls today. Adani Ports, which made a fresh swing high. That's a buy with a stop at 1860 for a target of around 1940. Also a buy on Britannia, which I would recommend buying with a stop below 53.25 for a target of around 54.90 to about 5500. Dalmia Bharat Cement is the next stop, which is suggesting a reversal after a decline. So that's a buy with a stop below 1720 for a target of around 1800, and one sell call. Bank of Baroda, I think, gave a very negative pricing volume action yesterday. A lot of bearish crossovers on the hourly and 2 hourly chart. So that's a sell. Keep a stop just about 266, look for targets of 245.
Thank you, gentlemen. We'll connect with you for the 9-10 calls. For now, let's get in Sandeep Agarwal, Fund Manager, Sovilo Investment Managers. The IT stocks have been under pressure from the start of the year. The index, the Nifty IT index, is down nearly 30% at a 3-year low. And the valuations of many IT companies are now down to the lowest level that we've seen in many years. Large cap IT is trading at 13, 14 times. So very close to trough levels. Where do we go from here? Yesterday, we had a rebound. Sandeep Agarwal, Fund Manager, Sovilo Investment Managers, is now joining in. Sandeep, I remember you were bullish on the IT stocks once they started correcting. You thought the correction was overdone or done for now. But, every month when we look at the index, at least in 2026, it's been lower than the level that it was a prior month. Where do we go from here?
Hey, hi, Rima. Good morning. Thanks for having me on the show. So, Rima, since March, we have turned positive, and from there also, most of the stocks are down 10 to 15%. But let me tell you, Rima, this in last 25 years since I'm tracking this sector, I also have done the same mistake, and I see today also most of the analysts and people who are making a view are going through that challenge. They are confusing the disruption with the cycle. See, these are two different things. Disruption is one and cycle is different. In past, what has happened, all disruptions, there was never a change of in the effort count. It always used to go up with a pause. And because we are in the third layer of the cycle, that is, we don't make the product, or whether it is hardware or software, neither we use the product to generate or commercialize it. We are the third who service the product. So we are basically customer service partner of the whole ecosystem. So we always get impacted the last, and we also recover the last. Unfortunately, this cycle cannot change just because there is a change in technology, there is a change in disruption. And this time also same thing is happening. People are confusing the disruption with the cycle. Cycle will play in the same way. Initially, the hardware of the innovator will gain in a big way, which we have seen in NVIDIA and AMD. Second phase, the people who use that technology and make commercial use of it, like the Anthropic's group and all the AI players, they will make a lot of money for next 10, 15 years. And once they start commercializing, after 16 to 18 months of lag, we will come and service those clients. So when the enterprise AI gets adopted, our role will come. So the cycle doesn't change this time also. And that is the reason last 14, 15 months when we have a view 50% correction at index level. And we turned positive since last 1.5 months. And we have actually added quite a bit of weight in the sector. And I'm very positive on the sector now. Again, remember, my view is it is a lower growth for longer. But these valuations are not justified for even the lower growth for longer. I remain cautious still on the ER&D. I still believe there is a lot of growth in the ER&D space. So I will not buy any ER&D stock, but I will buy the traditional IT services stocks with a preference for the lower and mid-sized companies which are at very reasonable valuation. And also some bit I will add in the large cap. That is my view.
But with large cap, when does the cycle turn? You said that the Indian IT comes in the third level of the entire technology cycle. The first beneficiaries are the NVIDIAs, second will be the Anthropic OpenAIs, and then come the service providers like Indian IT. Where are we in the cycle? Because at least as of now, we haven't seen any signals which suggest that the application layer where Indian IT comes in is benefiting.
Rima, no one knows when it turns. I will tell you, post-COVID, when market was 7,000 and all these stocks were like, have corrected 60-70%. That time, when we did channel check, we got good filler that demand is coming. And, when we were pushing initially, no one was believing. And when we were saying positive, the stocks were down 5-10%. And this time also, it will be no different. My view is that, large part of deflation in the efforts has been priced in. So I think worst will be this quarter. Maybe this will be the inflection point of the turnaround. And from next quarter onwards, I don't see any decline in growth for any of the companies. barring one or two which have internal issues for a long time. I will not comment on them, but otherwise most of the companies will see growth from this quarter or maybe next quarter. And once that happens, and this, remember that this cycle, I'm very confident it is a profit growth cycle and not a revenue growth cycle. So growth will be 6-7% for the large cap, and for the mid well-run companies 10-12%. But profit growth will be much more substantial in this cycle, and I think stocks will make good return from here. That is our view, and we have substantially increased our weight in the PMS also.
Right. And Sandeep, hi, morning. Good to see you again. So for regular viewers who are watching, right, is what's the way to get exposure? You're a specialized. You do this for a living, so maybe give money to you. But if they want to do it themselves, buy a IT ETF or something, or buy 2-3 stocks. What's the best way?
I will strongly recommend to buy, IT ETFs, and I'm reasonably confident. See, I will not be able to say that whether they will fall from here 5-10%. I cannot give that call, but I am reasonably confident that if you do the numbers, the EPS has to grow by 45-70% in next 3 years from here, in worst case scenario. So I believe that at same multiple also, these stocks will give you 45-70% return in next 3 years, which is anywhere between 12 to 20% CAGR, which is very good return, and there will be some re-rating also. And
if one were a bit more aggressive and wanted a bit more concentrated exposure, 3 names which you think will do the best position.
I will not give you a name, but I will say wherever traditional IT services where multiples are reasonable, you can buy them. Avoid ER&D at any cost. I think ER&D is still too much overvalued. There will be lot more correction in ER&D space. So I'm telling you what not to buy. What to buy, you can buy anything, you will make good money in the traditional services side.
Saying that ER&D companies are overvalued. Now, HCLTech, after a 50% correction from the top just in this year itself, is now closer to 20 times, 19 times forward multiple. What would be the appropriate valuation multiple you will assign to the ER&D companies, particularly if you want to specify by HCLTech?
I will not specify on KPI, but let me tell you, you should go and see how EPAM has lost market share to the Indian ER&D companies post the Ukraine war started. And from that, you will get clue that, lot of demand, lot of market share gain has happened. I don't know whether that market share gain is permanent or not. Assume that it is permanent, then also at this base, growing at, significant rate will be tough. If, God forbid, some market share is lost again, once, there is some peace there, then obviously, these companies are extremely overvalued. Let me put it this way that, good correction has happened. So my call 15 months back was that IT services should correct by 50% and ER&D by 70%. IT services has corrected by 50%, ER&D has not corrected by 70%. So I will wait at least for 20% more correction across ER&D, and I am not calling out any name on that.
All right, another 20% correction on ER&D is what your call is. Sandeep, just one word finally. You said traditional IT companies is something that you like already. Would it be across market capitalization, or would you bet on only large caps right now?
No, across market capitalization, IT services across market cap peg ratio close to 1.5, 1.6 is where my comfort is. I will not buy company where, last 10, 15 years there has been some or other issue and they have not done well, because those are very, very internal issue, although they may also do better. But I will not buy. Other than that, the top 2 IT companies I like, and I like, few more names, smaller ones. And I think, there's too much of pessimism. If you do the number on Excel, and I'm sure some analysts someday will do that number, and when they do that number, they will be shocked that, the stocks are really, really massively undervalued.
Yeah. But what a change, right? It used to be buy ER&D, that is where the growth is, ignore everything else. And it's now completely flipped, right, Sandeep?
Yeah, so, because the valuations have gone through the roof, and I'm sounding caution for last, I think, 4, 5 months, 6 months that don't buy ER&D.
No, you've been... You've been cautious, but I'm just saying,
So, Prashant, ER&D will grow at a 2x rate of IT services. That is given. Yeah. But then also the multiples don't justify.
Got it. It's possible to overdo a good thing. I guess that's what has happened with some of the ER&D companies, as you're pointing out. Thank you very much, Sandeep. Great speaking with you. Appreciate you joining us as always. I think the IT index at the end of the pre-open session is up about 1.5%, actually 1.9. So it's another 2% pop. So if you end with 2%, you're going to end with flat, zero change for the week. Because 6% lost 3 days. Yesterday 4%, today 2%. You wipe the slate clean of any losses, at least at the index level. We've got market open coming up. We look at the Nifty, we look at the other indices. And then, of course, I think IT will show up on the heat map, the Nifty heat map, which we will refer to. 24,340, we're up about 0.6. The Nifty Bank is up 0.2. The mid-cap index, small-cap indices are coming up with gains as well. Small-cap index is up 0.4. The mid-cap index, I think, should be up about 0.25% or thereabouts. So that's the change. 24,330, 150 odd points higher once again, exactly in line with what the GIFT Nifty was indicating earlier today. The Nifty 50 pack and how that's opening up. So do we see a lot of IT names? Yes, we do. There is HCLTech, Infosys, TCS, Wipro, all starting on the positive side. There's Hindalco, which is coming up, Bajaj Finserv, which is coming up, and Tata Steel, which is coming up as well. So there are a few, at least Tata Steel, which is a metal name, and of course Hindalco as well, which is a metal name, which is coming up. Bajaj Finserv and Bajaj Finance, perhaps also the quarterly numbers. Tata Motors, passenger vehicle, Adani Enterprises, Mahindra and Mahindra are some of the losers, but they're far and few. It's largely 40-plus names which are starting in the positive zone this morning. PB Fintech, of course, that block going through, and it's down about 6% It's a large 2.5% block which has changed hands. Rima.
Well, it's a solid start to Friday. The Nifty is up 0.6% today, 150 points above 24,300. Now the weekly gain for the Nifty and the mid-cap index stands at nearly 1%. On the gaining side, as we pointed out, it's all IT. So IT continues with the rebound from yesterday with HCLTech, Infosys, TCS. HCLTech, the one that won a very large $1.1 billion 5-year deal, net new. That's a stock which is racing away with a 4.5% gain. But the other IT names also up nearly 2%. So large cap and mid cap IT participating. The other pocket of strength is the other metal names. The Nifty Metal Index will also come up for your new screen. As we highlighted, we have seen an easing in the dollar index price, now below 101. So that's providing some sentiment uplift to the metal names. And commodity prices overnight too, as Manisha was pointing out, are slightly higher. Consumption, that's been a pocket of strength this week. So you've got names like a Nestle. Eternal is up nearly 1%. That's rallied 10.5% so far this week. You've got Nestle 4% up this week. HUL has moved up 2.5%. So consumption names are higher. Avenues, Supermarts will come up for you on your screen. Little disappointing quarterly updates, and that stock has taken a knock of nearly 4%. While on the flip side, Dabur numbers are good, but the stock is only up, is on the flatter side. Bajaj Finance, Finserv will come up for you on your screen. Banks are lagging today. Well, the Nifty Bank is not participating at all. It's flat on the Nifty Banking Index. SBI is a bit of a problem. Axis Bank has no gain. HDFC Bank and ICICI Bank will also come up for you on your screen. HDFC Bank is up half. ICICI Bank also up 0.5%. But on the whole, the banking index is on the flatter side. Adani Enterprises under pressure on the back of the QIP. And even a couple of these auto names, which had a good run earlier this week, are cooling off a bit. So Tata Motors, passenger vehicles, M&M in the red now.
But the stock of the moment right now has to be PB Fintech. The large trades happening, the stock down about 6.5%, serious volumes out there. We do understand that Temasek is the seller. Trade has happened, our team has flashed that, and the stock, where it goes from here will be extremely crucial to track. Avenue Supermarts continues to see some selling, down about 4% post their numbers. But if you look at the broader end of the markets, a lot of stocks that saw a big surge yesterday are continuing to start fairly well this morning. EKO Lighting is one of them, has a serious volume backing that stock right now. IFGL Refractories as well. The stock is up 18% this week. Daily volumes crossed in the first few minutes itself. And Waterways Leisure, this was the Cordelia Cruises, opened week, day before yesterday when it listed. Yesterday was up around 10%, and this morning itself, Waterways Leisure is up 8%. So it's across the board, decent gains coming by for the small cap index. And a couple of these other consumer names which are doing extremely well too. AWL Agribusiness, which is basically the erstwhile Adani Wilmar, which is up around 4.5%. We are seeing some traction in names like Imami as well, which is up 3%. It's the rub off of Marico's update that has come by on the entire consumer space, though Marico is seeing some profit booking after a decent performance because the stock has been an outperformer itself. Kalyan Jewelers is the other one, which is opened about 0.75% higher. The street is expecting good updates coming in from the jewelry pack too. But if you look at the large caps, once again, it is HCLTech, which is the top Nifty gainer. IT continues to do well. The Nifty Bank, so long as it holds the 200-day moving average of 57,200, no real problems out there if the IT index continues to take it forward.
I think I just want to highlight, just a quick 2, 3, 4 names. Hitachi, let's just put this up and let's have them at the bottom of the screen as well in terms of the, changes which are coming through. Hitachi is down 7%. I mean, actually, the big cuts are coming through in these transformer companies. There is Hitachi down sharply. There is GE Vernova, which is down sharply. And I think there is CG Power, which is down pretty sharply as well. GE is down about 9%. These are very large cuts. CG is down about 6% And let's put the news out, we'll have more on this one. The news simply is that the government of India has given a 2-year extension to Chinese transformer companies to be able to sell to Indian state, to the government. Power Grid and others, I mean, state discoms, etc., will be able to buy transformers from 4 Chinese companies which have got manufacturing presence in India. But these companies are very, very large. They're some of the largest transformer companies out of China. So the fear is increased competition and, of course, pressure on margins as well. So that is the news. Now, let's bring in Vinny, who's got more details on this one. Vinny, take it away.
Hi. So, as for the latest update, there are these 4 Chinese companies that have gotten this exemption. TBEA Energy and other 3 more companies like Takia Electric, all of them have gotten an exemption. Now, obviously, do not forget in Feb 2026 earlier, the approval is only for TBEA for reactor category for 1 year. In this also, there's a condition that comes in that locally made in content should be minimum 50% for this as well. So, there is an impact that comes in for these transformer companies. We also have a note that's coming from IIFL on this front as well. They said that the move was not expected, and especially now that the domestic pricing, this becomes a concern. They see the speaking out, increase in terms of Chinese competition that comes in for all of these players as well, the transformer players, and obviously more competition comes in, means in terms of a pricing concern that comes in here as well. And that is why all these stocks are seeing a negative downtick today in the trading session. Any of the names of the transformer front are seeing a sharp downtick. Siemens Energy, GE Vernova, T&D Transformers and Rectifiers, World TAMP, all of them are down in trade.
Thank you very much for that. And just to put it in context, this correction that we're seeing in the stock price comes on the back of a very large up move. Just 3 years back, a GE Vernova was in the 200 rupee range. Now that stock price, it'll come up for you on your screen. I think it's closer to 4,500 after the correction, 4,400 on GE Vernova. A 3-year chart from 200 rupees to 4,400 after the correction. Hitachi Energy was closer to 4,500, and now it's closer to, I think, 31,000 post the correction. They've been multi-baggers, and now on the back of the possibility of increased competition, we are seeing a correction. In fact, we've got the perfect guest now joining in, Shreyas Devalkar, Head of Equity Axis Mutual Fund. Shreyas, I can see in the Axis Midcap Growth Fund, you have an investment in many of these T&D companies, and you're playing the entire capex cycle, and not just GE Vernova, Hitachi, Apar, Cummins, all of them. Do you want to weigh in on this particular news? And there are also concerns of the valuations. So can you make the case for fresh investments in these companies at this price?
Thank you very much for inviting on the show, and good morning to everyone. As far as the power or even overall cat food space, as you have highlighted, there is a structural growth story in this. But in the earlier session, you were also highlighting that, yes, this stocks has been multi-bagger and the valuations are very high. So any such news definitely bears some pressure on these stocks. In my judgment, if you see the demand supply of transformer is trouble not only in India, worldwide. Some of our companies in India actually got orders from US despite a tariff, right? So this space is really tight in terms of demand and supply. Having said that, because of high valuations, definitely any news which may be construed as negative, the stocks may react. As far as our positioning in most of the funds is concerned, we are positive on entire capital goods space, especially the mid and small cap oriented funds. And when I say capital goods, it is more to do about manufacturing. So it is whether it is auto ancillary. They are also having a lot of manufacturing through non-auto businesses. So some of them are in EMS space, some of them are in in defense and so on. And likewise in capital goods, obviously the lot of exposure is there in the power, and obvious reasons are everyone knows it is about renewable, it is about increasing power demand worldwide and in India as well. So that long-term story continues, but because of the valuation, there may be corrections.
Fair enough. But if I can see in your portfolio, particularly in this mid-cap growth fund, you increased your holding in these companies just in the prior month. You were anyway holding on, but you added on. So you are comfortable with the current valuations to add to the current positions. I get the correction bit, but at this juncture, you're comfortable adding.
We generally take a view based on the merit of that particular segment. Probably post the Iran war during February, March, that kind of time period, we had a view that the market may reward more of the manufacturing segment because of the global disruptions which are there in the supply chains, and accordingly across manufacturing, especially in again a mid and small cap oriented schemes, you must have seen increase in the manufacturing space and not a particular segment.
Right. Shreyas, I remember very clearly the last time we spoke, you had started to get constructive on the staple space. You said relative underperformance, low base, and, increasing improved outlook should help your cause. The last 1 month, these stocks have done extremely well. The updates are now coming in, the likes of Marico, etc., growing fairly well as well. Would you continue to hold on to your bullish call on the staple space?
It's more to do with the consumption space, not only staples, and especially the changes what you have seen since June. So two big changes, in my opinion, which were pro shift towards the consumption part of the economy. Because manufacturing, for multiple reasons, repeatedly got re-rated because the consumption space was failing to deliver. And when I say consumption, it includes the financial services as well, because part of financial services growth is retail credit growth driven. So in this entire space, there was a disappointment for a long period of time now. Almost 2 years to 3 years or so. While currently there are positives, are a couple of them. One is nominal GDP growth improving. Whenever nominal GDP growth improves, the headline numbers start improving, and that gets reflected in the quarterly previews what are getting released now, that you may observe that. Even the retail credit growth, what we are witnessing upwards of 15%, is partly because of that, partly because of from bond market to banks, etc. But partly it is because of that. So this trend, which is helped by nominal GDP growth, is in favor. However, we as an investor are also looking at the margin impact, because there are some segments or certain segments of this consumer space where the price increase is not sufficient to counter the raw material price increase. So that is one. And one view we are also taking that it is also, we have to look at 2-3 quarters ahead, because already these commodities have started falling and you are sitting on a price increase. So how much impact it will have on the margins 2 quarters down the line. So this quarter margin may be washed out for someone because of the raw material impact. So this holistic picture we are taking, and when you are talking about FMCG, I'm just broadening this conversation to entire consumption basket, including retail credit growth driven banks and NBFC, including the FMCG, autos, and many of the consumption segment of market. So one, as I said, is nominal GDP growth, and the second is the coordinated efforts of both central bank and central government to bring in the FII flows, especially in the bond market. So these were the two main triggers for this.
Shreyas, across the board, you're heavily invested in financials. You have an exposure to mid-cap banks like Federal, large-cap banks like ICICI, and across the board, even in NBFCs. Is this the time to double down on financials? Would you look to further increase your weight because credit growth is picking up, FCNRB deposits coming in is a positive, or are you comfortable holding on with your current weightage?
Already, as you have seen, that we have increased, and it is not now, we have been increasing since last 6 months in this space. So both these as well as part of consumption-oriented stock, because they have underperformed a lot over last 2-3 years. Absolute valuation of some of the consumption-oriented stocks, apart from banking, may not be as attractive, but there is a case for them also to deliver, because repeatedly market has shifted to manufacturing because there is a delivery, while this part is getting ignored. So that's where you would have noticed that in this calendar year, there has been shift across the portfolios. Though you might have observed, we are adding some of the manufacturing stock, but more shift in the portfolios has been towards the consumption oriented, because manufacturing we have added in 22, 24 as well as 25.
So if you have to rank the themes, consumption at this point, consumption right on top, then would be manufacturing and then banks, or rank it for us?
As far as large cap oriented funds are concerned, that is the case.
Got that. When we were chatting with Sanjeev Prasad of Kotak Institutional Equities, he said that India loves a narrative till it doesn't. And he gave the case of railways, where everyone was investing heavily 3-4 years back, and now no one's even talking about it. Do you think there is a narrative in the market right now which is not backed by fundamentals?
Good point to raise in this context is what narrative we may talk about, because every narrative works in the market at a valuation, right? So either it is backed by the fundamental or backed by valuation. So generally what we observed is at a particular valuation, the narratives, if it is backed by incremental delta, whether it is sufficient or not, then generally that works. So the case in point is the financial services, or lenders, I would call it out. Now lenders got derated for reason, right? So ROE of some of the leading segments of private sector bank actually got compressed from pre-COVID level till now, for various reasons. One can get into the reasons, but point is there was a reason why it got derated. There was also a reason why there was a deposit growth slowdown. There was a credit growth slowdown. Now from there, incrementally, if you notice, the credit growth has inched up, right? So there is a positive movement in that. So at this point at this juncture and this valuation, this narrative one may back now, because everything other has to be backed by the fundamentals. So we'll see over next 2-3 quarters how it shapes up, whether numbers are resilient. Because if you see on the consumption space, which we spoke about, even the auto numbers, despite all the troubles the economy have gone through, they are not so weak. So they have weakened from their peak, but then they are not so weak. So that there is a resilience which economy is showing.
Okay, just one final question then. Again, just referencing one of the interviews that we had, yesterday. So S. Narain of ICICI Pru said that mid caps are most expensive now relative to the large caps. So he sees more value in large caps and small caps right now. Would you concur, differ? If yes, why?
I would go into the segments of those, and that's where I highlighted large cap oriented funds are placed in this manner. Because large cap, if you see the weightages in the large cap indices, they are more towards the bankings, the FMCGs and the autos, and which are broadly the B2C spaces, right? So in that context, yes, the large cap are cheaper and they are reasonably priced, if not cheaper. So that's where the large cap has advantage. And if the way I highlighted that, if narrative along is backed by the numbers in all these three segments, then there is a case in point to make good money in the large cap. When it comes to mid cap, now in mid cap and small cap, what are the spaces which everyone is playing in that market, not only us? The spaces which are doing good in the mid and small cap are capital goods oriented stocks. They are around auto ancillaries, around multiple themes like hotels and hospitals, etc. They are also a large chunk of the mid cap indices as well as mid cap funds. So all these themes are at valuation where the multiples are not really comfortable. And from that point of view, along with another aspect is if you take 1 year, 2 year, 3 year CAGR returns, again, this is a different better way of looking at the things. If you look at 3 year CAGR of large cap versus mid cap versus small cap, even today, large cap 3 year CAGR is 10-11%, while mid cap and small cap is 20%. If you take a 5 year CAGR, even in that case, it is 11% versus 17%. Though in last 2 years, the returns are not good. And when we say that mid cap and small cap did well, the absolute return there also were not as high. And because of this valuation difference, despite those companies doing good, the absolute return at the category level or at the index level, that has not been very high. So the valuation remain high. So in my judgment, the risk reward would remain good in the large cap because of the thesis which I just discussed.
All right, Shreyas, thank you very much for that. Good speaking with you. Appreciate your time here on CNBC TV 18. So that's the perspective as far as markets are concerned. We have the Bajaj Auto management now with us. So there's lots to talk about, right? There's the, where should we start? I think there is the sales numbers for the month of June. There is the electric policy electric vehicle policy in Delhi. But of course, there is also the ongoing buyback. I think the buyback, of course, is something which wraps up on the 7th. Rakesh Sharma is with us, Joint Managing Director at Bajaj, who's with us. Rakesh, good morning. Great to have you with us here. Thanks very much for joining us. So let me pick with the number 2 point, which is the Delhi electric vehicle policy. You know, the general consensus was that this has been brought forward, and I mean, you know, the pace at which it has been done perhaps took people by surprise. So just give us your views in the context of Bajaj and what Bajaj, you know, the size of the market which Delhi is for Bajaj, and how you're planning for this transition.
Good morning, Prashant. Well, I wouldn't say that it was a surprise, because the industry was in dialogue with the Delhi government and also the Ministry of Heavy Industries for some time, and a draft had been circulated with opinions asked. So it was not a complete surprise. It's definitely a very bold move, particularly because it is very handsomely supported by subsidy and scrappage incentives, etc., which will be persuasive for the customer. But having said that, you know, Delhi is a very large city with vast distances. And in such a market, that what happens is that there is a lot of different types of use cases. There are personal use cases, there are commercial use cases, as you know, gig workers. Three-wheelers is almost entirely commercial. There are people who have high-frequency travel within limited radius, and there are people who have low-frequency travel across long distances. Commercial people travel 120 odd kilometers, 12 hours to make, you know, the money that they need to make. Now, a singular approach, which is entirely based on only electric, may not serve the purpose of all types of customer segments. And our position has always been that it is very, very important to define the standards of emissions and the environmental burden. But then one must be technology agnostic and actually use the multiple technologies which are available. We are very fortunate in India that we have a very good CNG network which the government has supported. We have got the upcoming ethanol blending, higher blending of ethanol and gasoline, which assuages a lot of the concerns. So balancing, you know, the environment issues, the society or the customers, particularly the bottom half of the pyramid customers' needs, the foreign exchange requirements, energy security, balancing all that requires we feel a multiple approach.
You would have
when it comes.
Yeah.
And
So one of the Rakesh, so one of the changes, right? Actually, surprise. You said it's not a surprise. One of the surprise, I think, which we can clearly say, and many have told us, is that there's no mention of hybrid, which was, and I think, so that's what you're hinting at, that perhaps that would have worked better for all the use cases.
Because see, OEs will adjust to it. You know, a company like ours already has 30% of our domestic revenues are electric. You know, we are at the forefront of the electric development. So I'm not making these comments from a parochial way, but if one has to really balance all these issues out, then we must use the array of options which are available to us and have a solution drawn from that. But banning everything else in preference to just one approach may not serve all the purposes in the longer term, is what we felt. But of course, we are at the forefront of electric. We are now a profitable electric company. I think with 30% share of our domestic revenues, it's probably one of the highest in the automotive industry. We will adjust to it.
125. That I mean, so just give us which is your product in that particular segment. But you said, I mean, Bajaj is a large company and lots of focus on EV, and you will adjust and make the necessary changes. Point taken. But you know, the thing is, will other states follow and take Delhi's example in the same way they've taken? We don't know. We don't have answers to it. But how large is Bajaj's exposure to the market, the Delhi market?
Well, I would call it exposure. I would say it's an opportunity, first of all, because as you know that we have not been in scooters, and 40% of two-wheelers, for example, in Delhi are scooters, and this is all new business for us. Three-wheelers, we have 100% market share with a very good network and connection with the users over the years. It stacks up to, Prashant, between 2 to 4% of our all India sales. So that's the thing. But yeah, this kind of a thing, as long as it's, a more holistic approach, obviously should be taken in some other cities also, because almost everyone is suffering from a similar situation like Delhi is. The degrees may be slightly different.
Mr. Sharma, morning. Rima here. Let me get to the June monthly sales numbers and the way ahead. Now, June was overall strong, 28%, but that was driven by an extraordinary 49% surge in exports. Domestic sales were 11%. So going ahead for domestic sales, considering that the upcoming months are also lean periods, can you sustain a double-digit revenue, monthly run rate on domestic volumes and exports? Can you continue with this blistering pace? Can that 2.5 lakh units push to 3 lakh units?
Yes, actually, we were hampered by supply chain issues, both on the availability side, which is there were interruptions because of the availability of manpower across our vendors and some of our plants as well, and logistics for exports, the shipping opportunities declined. So I would say exports should have been in an ideal situation closer to 300,000 units rather than the 250 odd which we have recorded. So we have got an unprecedented amount of spillovers now continuously because of the combination of supply chain and logistics issues. So these, as I speak, at least the supply chain side is getting resolved, and we are hoping to see a much better July. But yes, concerns remain on the logistics side because the shipping opportunities have become less, and there is obviously now there are a big build-up at the ports across industries. It's a very, very important issue to manage. But yeah, we are, if you take the spillovers, etc., we are businesses pointing towards between 250 to 300,000, which continues this growth rate for at least a couple of months, which we can
and domestic
see.
Okay. So
the domestic business should also continue. July, as you yourself said, is a very, very lean month. August onwards, it starts to pick up a little bit, and of course in September. But it's a very, very busy quarter for us in quarter two because there are many new launches lined up, and I think that will sparkle the business for us. And we are finally hoping that there'll be some unlock in capacity in our electric three-wheelers and the Chetak electric scooters, which also could have done, I would say, about 10% or better, but got sort of restricted because of the supply chain issues.
Right. You said you could have done 10% better. So do you have, as an aside, a target on Chetak? Where does it go by the end of this year on a monthly basis? You're doing about 40,000 with increased capacity here. Do you have a market share target and a monthly run rate?
Well, a lot depends on how the customers respond to the gradual easing off of subsidies. But the trend, as you can see, is very, very positive in favor of electric because gasoline prices have increased, and the maths just supports adoption of electric scooters at a much faster rate. And so we think that will continue. We are taking all measures to progressively double our capacity, which is right now 50,000 units per month. We are looking over a period of time to double this capacity because we think that this segment is set to grow very fast.
Right.
Do you see margins ticking up in Q2? Because crude prices are back to what they were. Commodity prices have eased. Exports are doing very well. You have already taken price hikes. Q2 margins should be better?
Well, the margin story is actually a mixed one because you're right, there was some inflation to a combination of forex cover at price increases, about 1.5–2% price increase, which we took last quarter. We were able to mitigate that. But going forward, there is a lot of cost side inflation in things like aluminum and electronics, as well as polymers. The markets don't respond so quickly to the ups and downs of the oil prices, but there is also the manufacturing side issues in West Asia, because it's creating a demand and supply situation. There is this whole suck up which is taking place on the AI side, which is driving up the cost of electronics. And we are looking, our outlook is that there is going to be strong inflation this quarter. We've already taken mitigating actions. We have sort of covered up at least 50% of the inflation, so we have to see how it progresses. But on the support side to the margins, yes, you're right that exports is a very, very strong story, which is continuing to unfold for us, though the exchange rate has now stabilized. And the premium end of our businesses are doing well.
What could the net basis point sort of impact be on your margins over the next couple of quarters, if we had to get down to that?
See, it is not that we drive to a certain precise number, as I've been saying at your show, that ultimately when we have to see how the chips fall down, because it's a story of the mix. Now, individually, we are seeing, progression in our margins, improvement in our margins, which might get a little bit thwarted because of the inflation, which I just talked about. Right. We have to see how the inflation unfolds. But ultimately, it depends on how fast the electric business grows, which is less than the corporate profitability. We have to see how much of the exports opportunity we can supply, unlocking supply chain, which is above the corporate profitability. And when we put all this together, then we will get a margin view.
Yeah. Rakesh, I don't know how you will respond to this one as a stock market question. The buyback is on, promoters are not participating. It's a signal that the promoters believe the intrinsic value is above 12,000?
Well, you'll have to ask the promoters that question. And yes, once the whole buyback is closed, we will certainly put out a detailed note on how it has gone.
Yeah. Fair enough. I mean, will we see a more? Will you put out like a buy policy as well, like a more structured policy on buybacks? I mean, capital allocation framework in that sense, Rakesh, or will this be opportunistic?
No. We've already got a policy which is there, and it is in practice, and that policy says 90% of our given a certain level of cash reserves. 90% of our profits are distributed through a combination of dividend and buyback. So it's pretty spelled out pretty much in detail. And it's been in practice, I think, for over the last couple of years. So no change in that.
Yeah. No, I'm just, fair enough, got that. You're the promoters not participating, which means you're leaving a fair bit on the table in that sense, which is, I guess, a sign of confidence. I guess should be read as a sign of confidence for investors. Thank you very much for joining us. Good speaking with you, and appreciate your time here on CNBC TV 18. We'll take a quick commercial break here. Well, we'll stick with autos and two-wheelers and four-wheelers and that space basically. And the discussion has been for the last couple of days around Delhi's EV policy, and this time we focus on the infrastructure which is needed to make all this possible. The charging station expansion. So. We've got, two gentlemen joining us on the other side. We've got Virendra Goyal from Tata Power and Chaitanya Kanuri of WRI India. Stay tuned. Welcome back. 160 points on the Nifty is what we have. 24,333. Chaitanya Kanuri is Director, Electric Mobility and Batteries at WRI India. Virendra Goyal is Head of EV Charging at Tata Power. Thank you very much, both of you, for joining us. We had the Bajaj management with us. I trust you caught some of that conversation. We started, of course, with the EV policy and, of course, where Bajaj sits in the middle of all of it. But the infrastructure, the charging infrastructure, right? So let's get down to brass tacks in that sense. Virendra, how many charging stations do we have in Delhi?
So in Delhi, Tata Power has roughly about 900 charging points. We support large, bus depots, plus there are public charging stations deployed in various public locations like hotels, malls, residential societies. And there are always charging stations in pipeline. So roughly about 50-60 new charging stations are in different stages of completion. And it is an ongoing activity. New charging stations continuously keep getting added up.
How many do you add a month?
See, it depends. There is also to do with seasonality, but on an average, we add about 500 to 600 new charging points, new chargers rather, every year. It also, it is also to do with the demand. Like for the last 3 months, all of us are seeing there is a surge in the electric vehicle EV sales. If you look at the car sales, has got doubled up, which will naturally give a push for higher charging infrastructure deployment.
Yeah.
But on an average, we deploy about 500 to 600 in a year.
Yeah, got that. And and this maybe this question is more appropriate for Chaitanya, but in your opinion, how many charge? What's the total size? Tata Power is 900, and you add 500 to 600 every year. What's the total charging infrastructure in Delhi, if you have that number?
I may not have readily, but I'll tell you, there are various segments on which charging infrastructure is calculated. We have deployed about 12,000 home chargers in Delhi. So, which are like a private charger to every EV owner. So, all put together, Delhi should have about 25,000-30,000 charging points. Tata Power would have about 15,000 of them.
Yeah. Okay. So, you would have about 15,000 in total. So, you're saying 12,000?
Including the home charging, we would roughly have about 15,000 charging points.
I see. Got that. And you're saying 25 to 30,000 in total in Delhi? Should be.
In Delhi, it should be there. Yeah,
okay.
Yeah, easily.
Okay. And this includes both public and private, everything, all industry, everybody.
Public, private, everything, buses.
Yeah, got it. Chaitanya, come in on the conversation. If you want to add to these numbers and just the scope of it.
Sure. So I think in terms of public charging itself, again, the data is really all over the place a little bit because there's no centralized way of collecting the data beyond voluntary sort of inputs from charge point operators as well as the discoms that are setting up charging. Public charging, I think as per the latest figures, is around 2,000 charging stations. But again, a lot of the stock would be private because two-wheelers, four-wheelers, all of these do charge in their homes and in workplaces as well.
What is the requirement? Now, that is the more critical. If you've done any mapping, if this policy is to roll out, what is the requirement, Chaitanya, in your opinion?
So, in India, currently, I think various studies show that we have about one charge point for 135 or up to 200 EVs. So anywhere between one public charge point for 100 to 200 EVs is the current figures as per various studies. If we look at global best practices, we have again a wide variation between countries. You have China, which has around one charger for every 10 EVs. You have the US, which is one charger for every 33 EVs. One of the best figures in the world is the Netherlands, which has one charger for every 5 EVs. But then those are slow chargers. So it also depends on the type of chargers you're deploying. There is no one optimal ratio, but globally, globally it is agreed that I think anywhere between one charger for 10 to 20 EVs is considered ideal. But again, this depends on whether they're fast chargers, slow chargers, and how much of the share is home charging.
But our ratio is, you said 1 to 100 or 1 to 200, or we don't know?
It's between 100 to 200 right now, depending on various figures and various studies.
Okay.
So it's a bit of a variation.
Right. So it's a long way to go, right?
We do have a way to go. In terms of numbers, yes, but I think more importantly also in terms of siting, especially when it comes to public charging, where are you siting your public charging so that it is allowing access to the maximum number of EVs, as well as ensuring that these charging stations are operational, because the first generation of charging stations, many of them are not as operational today, may not be as reliable for EV users, which feeds into that sort of charging anxiety or range anxiety.
If you're in touch with the government in Delhi, Chaitanya, what is the plan by the time this rolls out, right? What is the plan? What is the government thinking? What will this number go to? From 25 to 30,000, as Virendra said. By the time we hit rollout, what do you think that number will be from government's own estimate?
I don't think the government will have an estimate for the private charging, because private charging will really grow based on the demand that comes from private users. On public charging, however, I think the government is planning to go up significantly over the next 5 years, primarily through a lot of governance inputs. They're trying to set up everything under the Delhi Transco Limited and having a sort of streamlined single window process to actually ensure that private operators can also come in and set up charging in a timely manner.
I see. Virendra, the number that you said, right, 25 to 30,000 charging stations in Delhi, what is the share of government in this?
See, the large part of the charging points would be private, which would be essentially home charging, catering to 80-85% of the charging need. So today, I think instead of putting a number to the charging infrastructure requirement, it is more towards creating a reliable charging infra. See, in India, the primary charging will continue to be supported by home charging. And if we look at this policy, the policy covers a mandate for new buildings to create charging infrastructure. It has covered discussion with RWA, societies, workplaces, which is primary place where EVs get charged.
But Virendra, in a case like Delhi, right, in many, RWA is, yeah, there are, but it's more, there are older colonies, it's a much different situation, very different compared to what the situation in Bombay, right? So
this situation is there in all the major metros in the country, and that's why Tata Power and including OEMs, I would say, has created something called a community charging, where consumers don't have dedicated parking. There are community chargers which are created inside the RWA, which caters to the occupants of that particular society. It becomes like a common infra created inside the society at a common parking. And that caters, and it is working fantastically well in major cities like Mumbai, Pune, Delhi, Gurgaon, Bangalore, Hyderabad. I think that will continue.
Yeah.
Plus, we are seeing a very good traction from the workplace charging also. Corporates are taking active part. They are getting charging infrastructure deployed. Many of them are also, rolling out policies for their employees to adopt for electric vehicles. So that also, because an employee spends about 6 to 8 hours in the workplace, and that's an ideal time to get an EV charged.
Yeah, this incentive for charging stations, Virendra, the Delhi government will provide. This is to, I mean, say for example, Tata Power is setting up. It'll be to the consumer, it'll be to the company.
See, as of now, the policy did not speak about the incentive which it will provide, but generally it is both sides. There are there are incentives which are provided for setting up charging infra. There is already a Ministry of Heavy Industry scheme which covers charging infrastructure under PME drive, and there is an outlay of 2,000 crores, which gives subsidy of up to 70% on upstream power infra for private locations.
Okay.
Although
I know the numbers will vary, Virendra, but just leave us with what is the cost of like a average in a okay-ish, not too tough location to set up a private charging point, and what is the cost of setting up a public charging point now?
It would vary from a lakh of rupee for a slow charger to about 20 lakh rupees for a 100 kilowatt charger. Maybe, it varies from location to location because the cost of upstream infra differs for each location.
Got that. Thank you very much for joining us, Virendra. And it's a discussion which we will keep having once we have more clarity on the incentive scheme in terms of how it operates as well. Chaitanya, thank you very much for being here on CNBC TV 18 as well. I think we will sort of continue to discuss this. But I think the capital market space with all these issuances, I think, is also going to be in focus, Rima.
Well, indeed, we've got so many large issuances on the pipeline. There's Jio, NSC, PhonePe, SBI, AMC, Zepto. So let's get in Abhinav Bharti, Managing Director, Head of India, ECM, JP Morgan. Abhinav, hi, morning, and great having you. This is Rima here. So would these 4-5 large IPOs together approximately rake in more than $10 billion? Is that the correct assessment? And what's the pipeline looking for H2?
Thank you, and morning to the entire CNBC team. Yes, you're right. I mean, there are some large IPOs lined up for second half of this year. Without going into specifics of each, I would say, we are tracking close to about 7 to 8 IPOs that could raise $1 billion or more second half this year, which cumulatively between them should easily add up to a number between $10 to $15 billion. You add the rest of the pipeline, could we be on track to do another $20 billion IPO year? I think the potential is very much there.
Okay. Will the sequencing matter? Who comes out first? Or do you think the appetite is large enough for all of them? And would this be the most that we've raised in 6 months in the second half of the year, the best performance, half yearly?
Number one, I would say the last 2 years have shown that the depth of the market in India has now exponentially increased. So I'm not so worried about the sequencing. The market depth is deep enough to support multiple large offerings at the same time. Remember, there will be secondary market activity in terms of blocks and follow-ons that will continue alongside. Your question on largest second half, potentially yes, although last year also came very close to these numbers. If you parse the numbers, I think for the year as a whole, we raised about $68 to $70 billion. And till at least early May, till Operation Sindoor got done, we had only raised about 9 or 10. So nearly 60 billion got printed in 7 to 8 months. Something similar could be seen, or maybe not to the same extent, but yeah, close to similar levels this year as well.
But this is still a fraction of the kind of money that's being raised in the United States itself, right? Even if we get to $20 billion, SpaceX itself was, $87 billion. You throw in what Alphabet raised at $85 billion, Cerebras and so many others. When you speak to your foreign counterparts and talk to them about the Indian IPOs, which are upcoming, considering just how small they are in comparison to them, do they find mention? What is the interest level like?
One of the big takeaways that we have seen this year, and especially coming from not just US, but even in Europe as well, is that the fact that the deals are continuing to work well, have made money for investors. The appetite to, continue investing in primary capital and primary paper has increased much more. There is still more depth out there in the West. Anything which is $1 billion plus in size, honestly, flags across almost all global screens. To that extent, I mean, some of these large IPOs, as we have started, filing and the initial conversations with investors have started, everybody has come back saying, yes, these are on their radar. These are names which are of relevance for them to evaluate. Nothing between, their larger deals. So I would say the interest and focus from global investors for offerings of these size remains quite high, even despite what is happening in the US and other markets.
There was, I think, JPM only which pointed out that apparently the green shoe option of SpaceX, if the green shoe was a IPO in itself, it would have been the 6th largest IPO ever.
Wow.
The green shoe option of SpaceX. So, and I think there are it's just incredibly large numbers we're talking about. Trillion is the new billion. What else to say? Abhinav, where is there most excitement? Which sectors do you think are investors most excited about? I mean, or is it going to be very, company to company? And what's your sense?
Well, right, Prashant. Look, company to company, of course, remains, and that's the beauty about IPOs. That it's the individual opportunity that excites investors and the ability to play that, not just the sector thematic. But if I were to really look at which has a long-term thematic, consumer tech, healthcare. These are the names that you would see raising a reasonable amount of capital going into the second half of this year in India. And all of those score pretty well and high on investor radars.
I see. Just talk to us a little bit about the secondary market, the blocks and the sales and the promoter, the investors. I mean, that's in full flow, right?
Indeed. And look, the fact is, you need that circulation of capital continuing because at the end of the day, investors who invested in the private stage do need to find capital or exits out and be able to recycle that capital. The fact that the secondary markets are continuing is an important aspect of that. In our view, this year has been slower than the last 2 years. If you really look at half year, we've only done about $10 billion in block activity. Each of the last 2 years was 30 billion or give or take in just the secondary market ABBs. So there's a long way. Maybe we remain not touching those $30 billion kind of numbers this year. But yes, you will continue to see that part of the market also remain fairly active.
No, absolutely. And it's I think it's a slower year. I guess that's why we've got you, Abhinav. It's a busy year.
I mean, the way I see the prognosis for India going into second half of this year is pretty strong.
It's pretty strong. I just hope all that money that churn, it comes back. It churns back and rotates back into the secondary market or IPOs, etc. But just a quick word. What's the number you think we should expect this year in terms of these sales, secondary sales?
Okay. So look, I'm tracking close to about another $35 to $40 billion worth of paper that could come to the market second half. Nearly equally split between IPOs and follow-ons/blocks is how I would put it. That would take the full year number again closer to 60 billion. Last 2 years were closer to 70. So very much in line with what we have seen in the last 2 years. And again, reinforcing the fact that the depth in the Indian market continues to remain pretty high as well as liquid for investors.
Okay, I think we need to change that flash. It's 60 to 70 billion dollars of the total fundraise. So IPOs, blocks, offer for sale, all put together this year, FY27 could track 60 to 70 billion dollars. Abhinav, thank you very much for joining in, and apologies for making you wait as well. Appreciate the conversation today. We will get into a break. On the other side, Manisha will join in to talk commodities. Stay tuned.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
Brian for
Welcome back. Let's talk commodities now. Manisha is joining in as always. Manisha.
Thank you so much for that. I have focused on silver today because we've seen the prices gain up by 3% overnight, so much so that we are back above $60 an ounce yet again. For the week as well, it's 6% on the higher side. On a monthly or on a YTD basis, we still are trading in the negative there. But year on year, silver prices have, remember, gained 70%. Take a look at what we've done in sense of silver prices in this year. We did see an all-time high of $121 an ounce. That was in month of January. June has seen a low of 57, so more than 50% of a correction coming in. Currently, we are just about holding $60, $62 on the higher side there. The support for the silver prices has been on. Remember, this is the 6th straight year that we are looking at a global deficit. The demand from solar, EV and AI continues to be quite strong for silver, and the deepening production deficits. We are almost estimating a 46 million ounces of a deficit in 2026. So the markets believe as and when the profit taking is done and there is consolidation in prices, those are perhaps accumulation level coming in for silver. But the silver imports into Indian markets already have seen a very sharp decline. That is January, 747 tons. That is when we saw ETF demand at a record highs as well, and silver prices hitting record numbers too. And then Feb also saw very strong imports. And after that, you can see a very steady decline come in for silver. It was in the month of April that the government put in that import duty hike from 6 to 15%. And at this point in time, there are import restrictions on silver, whether it is in jewelry form, bullion, powder, granules, and that has led to a 3-year lows in sense of imports of silver in the month of May at around 47 tons. Now, we do understand that there is a decline in jewelry and investment demand for silver, but as far as industrial demand for silver is concerned, that is pretty inelastic. And also, India meets nearly 80% of its demand via imports. So the kind of volatile moves that we are looking at and the import restrictions on silver, that is a bit concerning going forward. As of now, even as we are trading at around $62 an ounce in the international markets. For the Indian markets, we are trading at a premium of around $5 to $8 an ounce. So that's the kind of divergence or a disparity that you're looking at in the international markets and the Indian markets as well as far as silver goes. I want to quickly take you through on the silver price forecast going forward from here. As I've told you, we've seen a range this year between 120 to 57 on the lower side. Bank of America believes that we could be looking at higher highs, all-time highs at 135. 85 to 100 of a range is what is Goldman Sachs putting out. And then you have 110 from Citi. JP Morgan believes that you could be looking at lower prices, but much higher from where we are trading right now. We are at 60 right now. So all of these forecasts in that sense are still on the higher side. And then you have Commerce Bank, HSBC as well, believing $75 an ounce is what could be an average price for silver for this year. TD Securities is quite bearish at 44. So another $20 down from here as well. For the Indian markets as well, you have Anand Rathi talking about 3,25,000. We are trading at 2,40,000 right now. We've seen a low of 2,17,000 as well in this week itself. Motilal Oswal at 320, Mirai at 240, and 3 lakh is what Axis also believes we could be looking at. Last year, same time, prices were at around 1,20,000. We've seen an all-time high of 4,20,000, and from there, this is an average that we're looking at for silver prices in this year now.
Thank you very much for that. On the other side, Lata speaks to Saurabh Garg, Secretary in the Ministry of Statistics, on the new IIP series and other MOSFI data.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
Jimmy?
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
Welcome to It's the Economy. India's Ministry of Statistics, or MOSPI, has been on an overdrive, updating all the data series. We now have a new GDP, CPI, IIP series, all of them updated with new base years. Now, the new IIP series was first put out on June 1st, and then within a month, it was revised on June 29th. Why? Because in between, the Commerce Ministry released a new price index called the Producer Price Index, PPI output, which will eventually replace the Wholesale Price Index, the WPI. Now, MOSPI is using this new output PPI series to calculate the IIP, the Index of Industrial Production. Hence, the revision. To understand more about the new IIP series and other data, I have with me none other than the Secretary of the Ministry of Statistics himself, Dr. Saurabh Garg. Dr. Garg, thank you very much indeed for your time. Sir, let me start with my confusion about the IIP itself. Initially, we used to be under the impression that IIP counts how many more televisions were produced, how many more computers were produced, whereas the GDP or GVA, gross value add, counted the input price and the output price of the product and looked at the value added. That was the basic difference we thought between IIP and GVA. Now you are deflating IIP also. So now IIP will also be calculated like GVA?
So let me first clarify that IIP is an output measure only and doesn't calculate value and will continue. The older series was an output value and the new series is also only an output value.
Okay.
The difference is that in the older series, most of the items were based on volume considerations. But even in the older series, we had around 107 items, or 109 items of the 407, which accounted for 19.2% of the total weight that were measured on the basis of value. Okay. In the new series, there are 234 out of 463, as you can see, which comprises about 36% on the basis of value. Okay. And the reason why we need to take into account certain items on value are primarily because of three reasons. Number one, where the products are not homogeneous, they are heterogeneous in the same item category, that's one. The second, where there is widely different quality differences between products produced in the same category. Okay. And the third is a set of products whose production cycle extends to more than a month. So therefore, during the period, we have to consider a work in progress for a number of items. So for these three items, even in the old series, we did have around 19% value-based, and in the new series, it's 36%. In the old series, for these 90% of the values, we use the WPI to deflate them so that we are actually in the IIP only reflecting the output or the number of quantity that we are reflecting. In the new series, because it's 36% of the total weight of the products is on value basis, we have now switched to the PPI, which internationally is considered to be a better measure than the WPI when we are talking about ex-factory gate. So I think conceptually there's no difference between the two series.
Okay. Yeah, no difference. In that case, will you be, when you're calculating GVA, will you now, the Ministry of Commerce is giving us this PPI output and PPI input on a trial basis. So will you be recalculating all the GVA also of the last 3 years? And if yes, by when will we get it?
We had mentioned earlier that we would be switching from a WPI to PPI. And I think that's a work in progress. And within the next few months, we hope to be able to use the output PPI to deflate the GVA also on an output basis, because it requires a substantial calculations and a validation and a check on the data. So that work is going on. I won't really like to commit on the time frame, but it would be within the next few months. Secondly, as far as the input PPI is mentioned, since it's a new index, it's a trial index, and we will study that data and then take a decision on that.
Okay. So will the new IIP also impact the GDP? I mean, we are going to get the next GDP number on August 29th. At that time, August 29th or 31st, whichever is the last working day.
Yeah.
You know, if you include this new IIP, will the previous GDP and GVA numbers change?
So we are looking at, as I mentioned, we are looking to incorporate the PPI in this the GDP calculations, and the IIP doesn't get directly reflected into the GDP or GVA. The IIP also uses the weights which are based on the national accounts. So in any case, the IIP is the causality, if at all, I would say it goes from GDP to IIP rather than the reverse.
Okay. Okay. So let me then come to the, this PPI series which the Commerce Ministry is releasing. I know it is unfair. It is a Commerce Ministry product, but you are going to use it, you said. Now, when you look at their services PPI, they have 7 indexes, right? 2 of them are on banking. I have not understood why they are different. Why should there be 2 banking PPIs? And then there is one for insurance, one for securities transaction and pension calculation. Now, first of all, what is the difference between the 2 banking? And will it start reflecting in August 29th or by the next GDP number?
Yes, so one is a banking services price index and there's a banking services contribution index. Okay. So what is really relevant is the price index, because price index has both, it deflates both the direct services which are offered and secondly, which are offered as an intermediary. Both are accounted for in the price index. The difference in the contribution index is the fact that while there is no difference between the direct services offered, in the indirect services or the intermediation services, the weightage for the different intermediation services also adds on to it the growth of that particular intermediation service between the last year and this year. And it gives an indication of the contribution that intermediate service is providing in the total value of the output that the banking industry is providing. So as far as GDP is concerned, where we are bothered about the price differences rather than the overall contribution that it makes to the revenue or the profits of the banking services, which the contribution index provides, our focus is on the price index.
Got it. So, but if you looked at the 7 indexes, most of them are on finance. One is banking, insurance, securities, transaction. Can we get those 7 items up again? And then there is, of course, telecom and transportation. But when you look at our GDP, there is a lot more services. Only one item, finance, real estate, etc., includes banking. Then there is trade, transportation, broadcasting, etc. Then there is professional services. None of these is available. How will you deflate that? You will continue to use CPI?
Yes. So on this, there are 2 things. One is that PPI services is essentially looking at it from the producer's point of view. In most of the services, the consumption is at the time of production itself. Unlike in goods, where there might be some logistical differences involved or logistical issues involved, there would be trade margins and there would be transport, etc. In most services, that really is not the case, except a few. So as a starting point, the Ministry of Commerce and Industry has brought out this services index, which covers these 7 services. Based on one is on data availability, number 2 is on the need for a separate PPI services, which is substantially different from the CPI for that particular service. And third, on the frequency of the data availability, this PPI services may get worked upon, expanded, improved as we go along. So as a starting point, we are at these 7 services, and let's see how we proceed based on need and feasibility.
Okay. There is no chance that all this will be merged into the MOSPI. It makes more sense for the Ministry of Statistics to handle WPI also, isn't it? Or PPI, as the case may be. But it's going to continue with 2 different ministries?
I think there are advantages on either. You can talk about both the advantages and disadvantages on either it be. But I think it's in Ministry of Commerce and Industry, we work very closely with them, and I don't think there's any problem in that.
Okay, fair enough. No, I was just asking because you all seem to be the professional statistics, unit. The other thing is, you all give IIP on 29th, GDP on 30th, CPI on 12th or 13th. Can the data be given together? That makes, that helps, rather than giving data all through the month. Every week there's something coming. And any chance that we should be able to get IIP and CPI together?
A lot of this depends on when the data is available and how fast we want to do it. For example, CPI we bring out within 12 days of the end of the month, which internationally is among the fastest that the inflation numbers are out. For industrial production, and CPI is based on our people. We have people on the ground who go week to week, day to day in the previous month and collect the data on tablets, which gets uploaded into our platform on the cloud, and we are able to do that processing so fast. For IIP, the data comes from the factories. Okay. The factories obviously need time after the end of the month to upload that data, and then we need to validate it and then check it and then compile it. So there is a difference in the method of collection. It would not be, I think, wise for us to delay CPI to ensure that we meet the timelines of IIP. And IIP, if you remember, we used to bring it out 42 days, yes, which timed well with the CPI of the next month, but it meant that we got the IIP data 42 days later. That's right. Now we are doing it within 28 days, which again is extremely quick. Okay, so I think the balance would be between doing it quickly and then trying to get all the data together. Okay. And I'm sure it helps you to analyze each piece of the data separately in any case.
All right, fair enough, fair enough. I was just wondering if we could, that system also had its advantages. Very quickly, sir, out of time, just one question. Because the PPI services index, which the Commerce Ministry released, is actually showing a fall in prices in banking, insurance, and I think even in securities transaction, it is falling. Now, that gives the impression that the GVA will be revised higher in the months to come. Is that a good guess?
So it depends, number one, on the weight of that particular service. What is the weight in the overall GVA? So that will determine what is the impact that would happen. And second is GVA is, we are calculating based on the input and output difference. So I think it's too early to really comment on what would be the impact on the overall GDP because of a price deflator being slightly low in one set of area.
Okay. Yeah, fair enough. It's only one element, but it does look like there is an upward bias. Dr. Garg, we have lots more questions, but you all are going to give us, for the first time, a services price index, a services production index as well, ISP, on July 14th. I'll take a rain check from you, literally, and ask you those questions after the ISP is released. Thank you very much indeed for your time.
Sure. Thank you. Happy to be here.
Well, that, I guess, clears a lot of doubts for those who are looking at this data very carefully. Wrap up on this edition of Bazaar, and after the break, Chartbusters.
जिंदल साथी सील है तो असली स्टेनलेस स्टील है
तो जब भी आप स्टेनलेस स्टील पाइप्स एंड ट्यूब्स खरीदें, जिंदल साथी सील जरूर चेक करें।
Jindal Stainless, India's leading producer of stainless steel.
Concerned about the market dip?
Yeah. Last time this happened, I just stopped my SIP. I don't want to lose more.
But let's get an expert opinion. We have Rakesh who's joining us.
The market has dipped, and that's exactly when your SIPs work the hardest for you. The biggest mistakes that investors make is stopping when they should not. The whole idea of SIP is when the market dips, you're buying more units of the mutual fund with the same amount of money. And that's how the rupee cost averaging works. Stay invested, stay disciplined.
Absolutely. Sip on your coffee. That's the spirit. Let the SIP do what it's supposed to do.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
We are over, Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
जिंदल साथी सील है तो असली स्टेनलेस स्टील है।
तो जब भी आप स्टेनलेस स्टील पाइप्स एंड ट्यूब्स खरीदें, जिंदल साथी सील जरूर चेक करें।
Jindal Stainless, India's leading producer of stainless steel.
The rebound in IT stocks continues for the second straight day. Gains led by HCLTech, which is the top Nifty gainer today. The stock up nearly 4% as it announces a near $1 billion AI deal with European Fortune 50 company.
Hindustan Zinc is one of the top gainers on the metal index on the back of its Q1 business updates. The refined zinc production grows 6% in the first quarter, while that of saleable metal is up 4%.
A large block deal sees nearly 2.5% equity worth 1750 crore rupees change hands at 1600 rupees for PB Fintech. The stock down 7%. Private equity investor Temasek is likely to have sold stock.
Avenue Supermart is under pressure, down nearly 5% after a weak business update for the first quarter, which shows addition of 3 stores and revenue growth of 15%.
Union Bank registers 3% deposit growth year on year, while CASA ratio contracts sequentially in the first quarter. The stock lower. Well, after a rebound in yesterday's trading session, the IT stocks continue their up move, and that's reflected in the frontline index as well. You're watching us here on Chartbusters. We come to you live from the CNBC TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Vinny Motiwala. We conquered the 100-day moving average on the Nifty yesterday, and now as we speak, 24,350. So good gains on the frontline index. From the word go, we've been seeing gains. The Nifty Bank, which hadn't participated yesterday, is not a big participant today either, but is neither a deterrent because it's holding above important levels of 58,000 and more important levels of the 200-day moving average, Vinny.
Absolutely, Mangalam, but still we've picked up some bit of a momentum, and that momentum continues, right, for today's trading session as well. And obviously, we're seeing good moves even coming in on the broader end of the market. That is something that we're keeping an eye out on. But also, let's bring on board our guests for today. First, we have Nagraj Shetty for a technical check in terms of the market as well. Nagraj, good morning. Thank you so much for joining us on the show. In terms of levels that you're keeping an eye out on for the Nifty as well as the Bank Nifty today.
Hi, good morning, Vinny. Yes, after moving into a range-bound action over the last 2 weeks, Nifty finally broken above the important hurdle around 24,200, 250 levels and trading currently higher. Technically, this is significant. The market was moving in a choppy movement over the last couple of months, and the momentum has back to shifted on the upper side. This is positive indication. I'm expecting Nifty to move towards the next hurdle of around 24,500, 600 levels in the quick period of time. And the Bank Nifty has been showing some consolidation in the last 2 sessions because the Nifty IT and Metal has taken the leadership in the market. I think the overall chart pattern is banking sector is still positive. This consolidation phase is just a preparation of a base for the breakout for the banking sector as well. From here onwards, I'm expecting Bank Nifty to reach towards 60,000 level in a short period of time.
All right, take that point. Nagaraj, I have to ask you about the IT pack as well. The last session was fairly strong. Most believe that maybe it was just a bounce off oversold levels. Today, there is momentum. It's building. It's 27,500 thereabouts. Still a fair distance away from, the 20-day moving average, which is just where we are right now on the IT index. Do you think it continues and it builds beyond that?
Yeah, maybe 20-day moving average can be surpassed on the upper side. But, Mangalam, that IT stock has been in IT sector, in fact, has been in a sharp downtrend. And normally underlying, whenever in a sharp downtrend, the bounce backs are likely in between. They are just forming lower tops and lower bottoms. I'm not expecting any bigger upside bounce for the IT sector from here onwards. Some more upside is likely up to around 28,500, 28,700 levels, the gap area of the hurdles which made a couple of weeks back. And even though after that, I'm expecting some more weakness to emerge from the higher levels in the IT sector in the near term.
Nagaraj, any individual stocks that you're looking at this morning?
Yeah, I have two stocks. First one is from a gold finance company, Manappuram. Chartically, Manappuram was moving in a consolidation pace, narrow band in the last couple of weeks, faced a stiff resistance around 332, 333 levels. The current chart pattern is indicating a possible breakout of the whole pattern. And one can look to buy at this point of time, currently at trading around 333, and immediate target would be around 355, and one can place a stop loss at 322. Second one is the EMS Limited. The chartically, after a stellar move, the EMS was moving in a consolidation phase. Technically, we call it as a bullish pennant or bullish flag pattern. And this flag is likely to be broken out around 432, 33 levels at this point of time. The chart pattern is looking positive. I'm expecting more upside. Currently trading around 431.70, 432. One can look to buy at this point of time. And immediate target would be around 452 and will place a stop loss at 420.
All right, Nagaraj, thank you so much for joining in and giving us your views on indices as well as individual stocks. We take a short break, come back, a special conversation lined up for you. The management of Inox GFL to discuss Adar Poonawala's 700 crore investment in Inox Clean. Devansh Jain joins in.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
Welcome back to Chartbusters on CNBC TV 18. As of now, Nifty holding steady at those 24,300 levels. Above that mark is what the Nifty continues to trade at. But let's just focus and talk about Inox Clean. Now, the company has actually secured a 700 crore investment from Adar Poonawalla office. And this is at a valuation of 70,000 crores, underscoring investor confidence in its renewable energy platform. To discuss the roadmap in terms from the renewable energy point of view, what is the strategy here, what are the plans, what are the targets? Let's bring on board Devansh Jain, Executive Director at Inox GFL Group. Devansh, good morning. Thank you so much for joining us on the show. Obviously, in the recent times, you've given a lot of targets for Inox Clean as well. You've spoken about how you're focusing on the renewable energy capacity as well. And now, with obviously this money that is coming in as well, largely an IPP platform, solar manufacturing cell is what Inox Clean focuses on. How was this valuation which you all have gotten? How was that arrived at? Any plans to list in the future for Inox Clean as well now?
Hi, good morning, Winnie. Thanks for having me. I think we're quite excited. It's a opportune moment for us where Adar Poonawalla's family office has invested 700 crores in Inox Clean at a 70,000 crore valuation. Now, this is not the first investment in the group. We've had fairly large investments coming in from CalPERS, RJ Corp, Enam, Akash Bensali, all some over the past 10 to 12 months. And I think these larger investments from very strong institutional backers only reinforces, strongly endorses Inox Clean's integrated renewable energy platform and the long-term strategy which we've set out on, wherein we are targeting about 15 gigawatts of operating IPP capacity over the next 2 years and 11 gigawatts of solar module and cell manufacturing capacity over the next 2 years. This is across 3 continents. This is across India, Africa, and the United States. And I think what really is driving investors towards us, I mean, I won't specifically comment on valuation. Of course, it's been done with third-party valuers. There are multiple bankers which have been involved in many of these capital raises. But effectively, if you look at the scale and speed at which we've been growing, it's probably unparalleled in India, possibly even in the world. Over the past 15 months, we've taken this company from 0 megawatt to now more than 4 gigawatt, literally 4 gigawatt of operational capacity. We've created a very, very large play in Africa, which is just on the cusp of execution. We've taken over a very large asset in the United States, which makes us one of the largest integrated players in the United States. And I think that's strongly resonating with some of the largest investors, not just in India, but globally as well.
We take that point, Devansh. Mangalam here. Congratulations on securing the fundraise and, in your words, the confidence of all these investors. But since it is an unlisted company, right? Viewers here would like to know what your current financials are, because when something which is valued at 70,000 crore rupees, one would like to know what is in it for it to be worth that much. That's point number one. And secondly, while you've gotten the confidence of all these guys, they're not just strategics, right? There is a financial element to it too. So at some point, they will consider cashing out or an exit. So what's the exit route for them?
Look, I'll answer the second part first. I think with respect to the exit route for these guys, I think most of them are long-term investors. Having said that, naturally, at some point in time, we will be filing for an IPO. As some of you may have been aware, we had filed for a confidential listing of Inox Clean last year. But since then, we've completed almost 9 acquisitions, totaling almost 10 acquisitions now over the past 10 months. We had significant opportunities, and hence we thought it prudent at that point in time to withdraw, get a lot of the acquisitions on the book, make the balance sheet much stronger, the business plan much stronger, and then possibly refile for an IPO. So at some point in time, over the next couple of months, you will be hearing on that front. With respect to the valuations, look, I think it's pretty straightforward. It's a sum of the parts valuation. You've got an IPP element to it. You've got the solar part broken into 2 parts, the Indian business as well as the American business. And we know what the volumes are, what the numbers are. multiples are pretty straightforward on the IPP side, as well as the Solar India and the US side. So when you put a 1-year number to it or a 2-year number to it, you can really put together what the valuation of the company is. Frankly speaking, we believe there is a lot of juice left. And I think as we move forward over the next 3 to 4 months, we should be seeing a fairly large bump up even to these numbers, given the ramp up which Inox Clean is currently working on.
Just to get that right, in the next couple of months, you will be filing for the IPO papers for Inox Clean, right?
That should be the broad plan.
And what does the current shareholding look like? How much of that is held by the Inox Group? Is there any other listed entity cross-holding in this? If you could give us a sense of the cap table, basically.
So there is no cross-holding whatsoever. About 95% of Inox Clean is currently owned by the promoters, which is the Jain family and Inox GFL. The cap table primarily includes CalPERS, Autumn Investments, RG Corp, Enam Akash Bhansali, is Madhu Kela, Rohit Kothari, Hero, DLF, some of India's largest family offices, and now other family offices as well.
Okay. Devansh, thank you so much for joining us on the show, speaking with us about Inox Clean. And papers will be filed soon. We'll keep an eye out on that and have more conversations with you on that front as well. So thanks so much for joining in this morning. But on that note, let's shift focus to a special segment where we will get you ideas of profit from Money Control Pro. Jitendra Gupta of moneycontrol.com joins us now to talk to us about the stock that he's been tracking closely. Jitendra?
Hi, thanks. We continue to like Ion Exchange despite a relatively muted FY26 as the weakness appears temporary. The slowdown was driven by project execution delays in the engineering business, and due to West Asia crisis, margins pressure was there because of the chemical segment. Management now expects a much stronger second half as some of these issues ease. Ion Exchange remains a leader in India's industrial water treatment market with strong capabilities in zero liquid discharge, desalination, wastewater recycling. The company is well positioned to benefit from the tightening environmental regulations and rising industrial water demand. Moreover, if you see earning visibility is good, supported by order book of around 2,338 crore with a bid pipeline of almost 9,500 crore. Delayed GCC projects have resumed execution, which should accelerate revenue recognition and support margins recovery. Meanwhile, the fully operational Doha facility, backed by attractive export opportunities, should provide important support to earnings in FY27. The 20-year Oman Boot project also strengthened the recurring revenue and cash flow visibility with execution normalizing. Of course, industrial capex improving and exports expanding. Earnings growth should be better in FY27. At around 21 times FY28 estimated earnings, valuations remain reasonable, and we maintain our overweight rating on the stock.
Right, Jitendra, thanks a lot for that. We take a short break, come back, get you more on the markets, a lot of individual stocks on the other side. Stay with us. Looking good for the market, led by the IT pack. And in that, the top Nifty gainer is HCLTech after it signed a near $1 billion deal with a European company. Rima joins in with all the details. Rima.
Thanks so much for that. Indeed, it's a large deal win for HCLTech, $1.14 billion initially for a 5.5-year term, extendable by another 5 years. And most importantly, this is 100% net new business for the company. So the company said they've signed a strategic partnership with a European headquartered Fortune Global 50 firm, and they will be building an AI-driven operating model for global digital workplace and enterprise networks. So it's an AI deal. It's a large deal of more than $1 billion net new over 5 years. Now, stock, of course, for the last 2 days is rebounding. And even after that, it's down about 30% so far this year. But there was an interesting note that came out from CLSA where they say that HCLTech has been credited with a lot of industry-first initiatives. So HCLTech was the first to flag off deflation related to AI in August of 2024. That's 2 years back at an analyst meet. Secondly, they were the ones to partner with OpenAI in June of 2025. They were the first ones to disclose advanced AI revenues among the Indian IT peers. They were the ones to make that investment in Sarvam AI, and they're the only management, CLSA says, to not penalize their sales teams for proactively passing on the AI productivity benefits to clients because that lowers the deal values. So HCLTech, according to them, CLSA expects HCLTech to maintain the FY27 guidance on both revenues, that's 1 to 4%, and even on margins. And they also point out a seasonality. So they're saying that over the last 8 years, HCLTech has actually given you a 20% return combined over Q2 and Q3. So we are entering a seasonally stronger period, though in Q4 and Q1, typically the stock doesn't do well. According to CLSA, HCLTech could be the fastest growing large cap IT company for the 4th straight year, and it is one of the top picks in the sector with a target price at 1,202. Back to you.
Okay, Rima, thank you so much for that. HCLTech as of now is holding on to gains of 5% in trade. And when you look at the Nifty in terms of that, we are at 24,300 levels. It's been there since we started the show as well. But with that, we're going to wind down this edition of Chartbusters. Thank you so much for tuning in. Up next, your trading hour.
Highly
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormas Fatakia. With me is Reema Tendulkar. And the last 2 days that Reema has been on the show, the IT index is staging a very sharp rebound and is contributing to the Nifty moves today. It contributed yesterday as well. And today we are back above very, very crucial levels.
Well, indeed. And with that, though, we're still up only 1% on the index because the first half of the week was so weak. But it's a very strong Friday. The Nifty had a gap up opening and it's managed to hold on to all those gains. In fact, build a tad bit on it. And the Nifty is now closer to 24,350, a gain of about 170 odd points. I think the only soft spot in today's trading session are banks, particularly the PSU Bank. So you've got a PNB, a Bank of Baroda, an Indian bank. And here the business updates that have come through are slightly lower than analyst estimates. So that's the reason why PSU banks are struggling a bit. But other than that, IT adds on to the 4.5% rally of yesterday with another 2.25%, today. You've got the metal index holding up with a gain of 1% as the dollar index cools off. Pharma is seeing a lot of buying. Real estate is higher in trade. And many of the PSUs too are up and about. But let's talk stocks now. So Hormus has walked over to the big wall and he's going to put the spotlight on the top movers.
There's a weak first half and equally strong second half, if not more. And the bulls are making this thing very clear, is the fact that they want to end the week on a high. And this is despite the fact that the banks are taking a bit of a break, not today, but over the last couple of days as well. The Nifty Bank has not gone anywhere over the last couple of days. So what has led the index higher? IT has been leading it yesterday. IT has led the index today as well. And the result is the fact that despite the weakness in the US dollar seen overnight has also caused a rebound in a lot of these metal names, and the pharma names and the real estate stocks also doing very well in today's trading session. But now that the Nifty is above its 100-day moving average and very important levels of the 24,200, 24,250 levels, there are two important levels that open up on the upside for the index. The first one is the May 7th high of 24,482. That is from where the index reversed course back towards that 22,100, 22,500 levels. And then again comes the April 21st swing high, which is the original swing high from where the index had reversed again, which is 24,601. So 24,482, 24,601, the next levels to watch on the upside for the index. Of course, IT has done well over the last couple of days, but it is mid-cap IT that has been taking the spotlight. Look at Emphasis is up 3%. Persistent Systems was up 5% yesterday, is up another 3.5% in today's session as well. And Oracle Financial too. The only IT stock that is positive on a year-to-date basis is also adding another 2% to its tally today. The weakness in the US dollar index has sparked a bit of a rebound in the metal names as well. Nalco was a big underperformer. Today is doing well at around 3.5% higher. Tata Steel, Hindustan Zinc, of course, not just for the business update, but also because of the rebound in silver prices as well. That's up another 2%. And SAIL has come off slightly from the highs of the day, still holding on to some gains. Take a look at the newsmakers today. HCLTech, you just heard from Reema a few minutes ago about what exactly is keeping the stock in the news. 6% higher now on the stock, extending its gains as we speak. Muthoot Finance, similar to HZL, the rebound in gold prices is causing a rebound here. PB Fintech, after its block deal at one point was down 7 to 8, so there is some buying emerging at lower levels. And Bank of Baroda was down around 5% yesterday, is added another 3.5% to that downfall in today's session as well. Look at the business updates as well from that were reported last evening. Union Bank is down 6.5, but 5 rupees from that 11.5 is of course the 5 rupee final dividend. So it's ex-dividend as well from today's session. So you need to take that into account. Avenue Supermarts, of course, weak business update, so 4.5% lower there. Bajaj Housing Finance has received an upgrade from JP Morgan after its business update. So that's up 3%. And M&M Financial doing well for itself, another 4% in today's trade. And lastly, Pharma as an index did well last week, has done well this week as well. And these are all of these names that are at 52-week highs today. Look at Aurobindo, Ipca Labs, Apollo Hospitals, Torrent Pharma. All of them have extended their gains in the last few minutes, and all of them trading with gains of anywhere between 2.5% to 4%, Reema.
Okay, thank you very much for that. Now let's talk about the financial stocks reacting to the Q1 business updates. Ananya joins in with the details and which ones should be on your watch list today.
So, well, good day for NBFC stocks. All are rallying. Bajaj Finance, Bajaj Housing Finance, and Mahindra Financial Services, while Union Bank is under pressure today. Now, let me first start with Bajaj Finance. Now, it kicked off FY27 with AUM growth of 24% year-on-year and 7.2% sequentially towards the upper end of its 22 to 24% guidance, alongside record customer additions and a 20% rise in new loans. Now, coming to Bajaj Housing Finance, they also reported a steady quarter with AUM growing 24% and disbursements rising 33%. Now, JP Morgan upgraded the stock to neutral from underweight, and target price is set at 85. But noted that the stock continues to trade at premium valuations when we compare it with the peers like PNB Housing Finance and LIC Housing Finance. So, PNB Housing Finance remains the top pick for JP Morgan. Now, Mahindra and Mahindra Financial Services also delivered healthy set of numbers. You can see the stock is also rallying today with disbursements rising 21% and business assets growing 12%. Collection efficiency moderated to 95% from 98% in the March quarter, though it remained stable year on year, if you see, while stage 2 and stage 3 asset quality improved. Now, on the other hand, Union Bank reported healthy advances if we see growth of 12.5% and stable CASA ratio, but weak deposit growth and a sequential decline in deposits appear to be weighing on the stock today.
Ananya, thank you for those updates there. So a slew of banking NBFC updates, all of them have come out. Of course, we are watching out for an update from the big boy. HDFC Bank should be out anytime soon now. But Bajaj Finance, Bajaj Housing, all of them doing well for themselves. In fact, Bajaj Finance is now well over 30% higher from its 52-week high, which was sub 800 at the peak of the Iran war. Now, shares of power equipment makers Hitachi, GE, Vernova, Siemens, all under pressure today after a note sourced from IIFL suggests that India has allowed 4 Chinese-linked power equipment firms to bid for government projects. Vinny is joining in with more updates on this. Vinny.
Hi, morning. So yes, absolutely. This is what we're picking up from the note that's coming from IIFL, right? Where they're saying that Ministry of Finance has this is a grant that is given for 2 years exemption for 4 of these Chinese companies. There was already some exemption that came in for TBEA, which was one of those Chinese players. In Feb 2026 already, the category was around for a 1-year exemption. Now this has become a 2-year exemption. Now there are 3 more companies that are added to that list as well. Nanjing Electric India Private Limited, New Northeast Electric India Private Limited, as well as Takai Electric, which are Chinese companies which are based in India, right? So now what is the main reason behind this? They've also put a condition that there is going to be local made content that comes in will be 50% minimum in all of this as well. So that's a condition as well. Yes, obviously we'll see some bit of an impact that comes in for the transformer power equipment players as well. So all these players, that's why are seeing a decline in today's trading session. Now IIFL furthermore highlights as well that this move was something that they're not expected. TBEA was something that was known, but widely it was not expected for these other companies. Now they've said that the domestic pricing is peaking out, Chinese competition, that was flagged off 6 months back, but there is a bit of a risk that comes in on the sentiment front for this. Do not forget that Indian players also on the transformer side have already announced capex for FY27 as well. They're already working on the transformer capacity as well. So that impact could be a bit minimal. We already knew about TBEA, and this is just an extension that comes in for 2 years. Nonetheless, it's a negative on terms of the sentiment. But yes, long term, because all these companies have already made the capex plan, we'll have to see how it works. And HVDC projects will likely not see a major impact because of this as well.
Thank you very much for that important story. Stocks are reacting. Get into a break. On the other side, we'll discuss the bond markets with Manisha Gupta. Stay tuned.
Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
Welcome to Bond Street. Our guest today is Riaz Tingna. He's partner Grant Thornton Bharat. Mr. Tingna, hi. Thank you so much for joining us here in the studios.
Pleasure.
First of all, let's start where most people start really, and that is about fixed deposits, bond interest versus FD interest. Is the tax treatment identical, or is there a difference that the investors routinely miss?
Well, the starting point is the same. Both of them are taxed as income from other sources, but that's where the similarity ends. Fixed deposit interest taxation is straightforward. You just have tax at the standard applicable rates for the investor. With bonds, yes, some exemptions may be available, but with bonds, there's a little more attention that we need to take. There could be tax-free bonds, there could be listed bonds, unlisted bonds, government bonds where there'll be no TDS, but there's still tax on those bonds, etc. So with bond interest, there have to be some nuances that we have to take into consideration, whereas fixed deposit is very straightforward.
All right. On the TDS front, as you mentioned that one, when does tax get deducted at source on bond interest, and at what rate, what does it work differently for listed versus unlisted bonds?
So the TDS on bond interest is pretty straightforward. So you've got 10% TDS provided you cross the threshold limits. Of course, if they are tax-free bonds or government bonds, there may not be any TDS. But again, you know, for government bonds, if there's no TDS, doesn't mean that there is no tax. You would still have to pay tax along with your tax return. And similarly, you know, the other way around will also work. So if there is zero tax, there's still taxability, and similarly, if there is TDS, does not mean that it's a final tax.
All right. For retirees and zero tax investors who don't want TDS deducted at all, this is the first year of a big change. The familiar 15G and 15H have been replaced by the new Form 121 under the 2025 law. Do walk us through all of that, and how does that work?
Yeah, so this is an important change, but we should also keep in mind the timing. So this new Form 121, which replaces 15G and 15H, is applicable from 1st April 26. So it means that for the financial year 25-26, Form 15G and 15H will still have some relevance. And another thing that we have to keep in mind is that Form 121 is only applicable for resident individuals and HUFs. Non-residents, firms, companies cannot avail of Form 15G or 15H, and now Form 121. So I think I can maybe add one more thing here, is that when somebody is filing a Form 121, they have to take into consideration the entire income and not just bond interest, because only after you take your total income will you realize whether you're eligible for the form or not.
If an investor sells a bond in secondary market before maturity, how is that taxed on short-term and long-term? And what is the holding period that decides it for the listed bond?
Great. So, yeah, there is a misconception that if it's a tax-free bond, there's no tax. That's not true. Only the coupon interest is not subject to tax. But any sale, any maturity or any transfer will attract capital gains tax. In the case of listed bonds, it's very clear that if you're holding it for more than 12 months, it will be treated as long-term. And if you're holding it for a period less than 12 months, it will be treated as short-term. Short-term will be taxed at the applicable tax rates applicable to the investor, and long-term would be taxed roughly at 12.5% without indexation.
But 54 EC bonds, NHAI, REC, PFC, REFC, I mean, I can tell you we report and talk about this almost on an everyday. And these are a favorite for sheltering capital gains. But there's a lot of confusion about what they actually shelter. What is the exact benefit? What do these gains qualify, limits, lock-in investors that investors need to know?
Great. So first of all, the Section 54 EC investments are not a shelter against capital gains for all capital gains.
Okay.
They are only sheltering capital gains arising out of the sale of land or building or both. So that's the first part. Once you are eligible to claim under 54 EC, then you have to make that investment within 6 months, and the total cap is 50 lakhs. One thing we also need to keep in mind is that while capital gains exemption will be available by investing in these bonds, the interest on these bonds are subject to tax.
Okay.
So therefore, one needs to check exactly what is the real benefit out of investing before you take the plunge.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
We are over, Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
जिंदल साथी सील है तो असली स्टेनलेस स्टील है।
तो जब भी आप स्टेनलेस स्टील पाइप्स एंड ट्यूब्स खरीदें, जिंदल साथी सील जरूर चेक करें।
जिंदल स्टेनलेस, इंडियाज लीडिंग प्रोड्यूसर ऑफ स्टेनलेस स्टील।
Current phase Iran.
Well, still 150 points higher on the index, so we've not gone anywhere on that front. So the bulls would be happy for the fact that they're still managing to hold on to those gains. 24,330 is where we stand, but the actual action is in the broader markets. RHI Magnesita, which was a stock that outperformed in yesterday's trading session, was in fact among the top traded stocks on the Nifty 500 in yesterday's trade, is witnessing some profit booking in today's trade, and down around 5.5% as we speak. Thermax is continuing to have a disappointing week as well. That's down another 4.5% in today's session. So not a good day and not a good week, in fact, for Thermax. DMart has extended its losses, now down around 4.75%. So that's not having a good day. But what is having a very good day though is Zensar Technologies. Zensar was up 9.5%, was around 10% yesterday as well, is up another 10% in today's session and has now moved to the highs of the day, 511 on the stock for Zensar. And well, while Aegis Logistics continued to do well all through the week, today Aegis Vopak is the stock that's outperforming in today's session. While Aegis Logistics has seen a bit of a knock over the last few minutes, that's down to the lows of the day, while Aegis Vopak is now up 9% and is at the highest point of the day. But HCLTech is probably the stock of the morning today, and that is a part of the IT rebound story as well. But that has a news trigger behind it that has taken the stock 6% higher. And Rima, well, it's a big deal for HCLTech.
It is indeed, because it's $1.14 billion for 5.5 years, the possibility of an extension. It comes in from Europe, and most importantly, it's a net new deal, which means every year, potentially, you are talking about $200 million plus in terms of revenues. And what I understand is this is the largest deal for the company since the Verizon deal, which was about 2 years back. And it comes in from the European space. So if Europe is opening up as an outsourcing opportunity, because currently majority has always been North America, then comes Europe. So large deals out of Europe is also a big opportunity. So what the company said, they signed a strategic partnership with a Europe-headquartered Fortune 50 company to build an AI-driven operating model for global digital workplace and enterprise networks. Of course, not to forget that the stock is corrected. It's down nearly 30% from the start of the year. But there was also an interesting note from CLSA. It's dated yesterday, where they say that HCLTech has done a lot of industry-first AI initiatives. So the company was the first one to flag AI-related deflation in August of 2024 in an analyst meet. They partnered with OpenAI in June 2025. They were the first to disclose advanced AI revenues amongst the IT peers. They made that minority investment of 10% in Sarvam AI, and they're the only management not to penalize the sales team for passing on the AI-related productivity benefits to clients because it shrinks the overall deal values. CLSA does expect HCLTech to hold on to its FY27 guidance of 1 to 4% on revenues and even on margins. And they also highlight an important technical aspect. They're saying that historically, Q2 and Q3, which is the period that we are currently in, has been a seasonally strong, period for the company. So in the last 8 years, in Q2 and Q3 combined, they've generated a return of 20% on an average. So CLSA believes HCLTech could be the fastest growing large cap system integrator company or IT services company for the 4th straight year. It's one of their top picks. They've got an outperform rating. The target price stands at 12.02. So that's HCLTech for you, leading the gains in the IT pack. We will get into a break. On the other side, Rahul Sharma from JM Financial joins in with his top bets.
Concerned about the market dip?
Yeah. Last time this happened, I just stopped my SIP. I don't want to lose more.
But let's get an expert opinion. We have Rakesh who's joining us.
The market has dipped, and that's exactly when your SIPs work the hardest for you. The biggest mistakes that investors make is stopping when they should not. The whole idea of SIP is when the market dips, you're buying more units of the mutual fund with the same amount of money. And that's how the rupee cost averaging works. Stay invested, stay disciplined.
Absolutely. Sip on your coffee. That's the spirit. Let the SIP do what it's supposed to do.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
We are over, Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे. गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा. आप अपना देख लो.
जिंदल साथी सील है तो असली स्टेनलेस स्टील है.
तो जब भी आप स्टेनलेस स्टील पाइप्स एंड ट्यूब्स खरीदें, जिंदल साथी सील जरूर चेक करें.
Jindal Stainless, India's leading producer of stainless steel.
Welcome back. Going strong for the markets. Persistent has also been recovering after that initial gash on the back of the company announcing that Nagarro acquisition. The stock fell from levels close to about 550 rupees. From levels of 4,800, it came down. And from that 550 levels of a decline, the stock has recovered close to about 450 rupees. So it's still about 100 rupees lower than the level that it was, but it has made a pretty strong recovery. Other IT names that stand out, eClerx is up 6.5%. Coforge, Emphasis up nearly 2.5%. And Hexaware is a stock which has moved up 13% from the start of the year. But let's talk about the futures and options space. Sudarshan now joins in with the latest trend. Sudarshan.
So market is largely higher for second straight day, and what is happening, what is basically supporting the market is the IT pack, seeing a sharp short covering for second straight day. You take a look at the Nifty gainer, top Nifty gainer, HCLTech after the order win. Amongst mid caps also you have major names. You are just talking about Persistent, that also has recovered sharply from day's low. But one concern, minor concern for the market is the banking pack. Nifty Bank has come off sharply highs, but again the positive part, your volatility index, now India VIX is below 12. It's at the lowest levels that we have seen since February of 2026. So basically at 5-month lows. Now come to the options state of Nifty. On the call side, major short covering we are seeing in the call options of 24,200 and 24,100. At the same time, we are seeing put writing at the levels around 24,300 and 24,350. So it gives you a range for Nifty. So now the new range for Nifty has emerged from 24,100 to 24,400. But to move higher above the level of 24,400, Nifty has to remain above 24,300 comfortably. So support for Nifty, I have taken 24,100 and resistance would be 24,400. As far as Nifty Bank is concerned, your 200 DMA of 57,200 will act as a major support, and as far as resistance is concerned, 58,500 would be immediate resistance. What about the stocks from the banking pack? Bank of Baroda not only has given the week quarterly update, but also there is one case has been going on, and that's also is weighing on the stock, and it's sharply off highs and currently down almost 3%. Amongst all the cement packs, one stock is looking very strong is Dalmia Bharat. It's also adding the fresh long, and all the power equipment names have been weak. GE, T&D, Hitachi and CG Power are sharply lower and adding fresh shorts.
Hitachi Energy and GE Vernova. In fact, from the 22nd of June, every single day GE Vernova has ended lower. So 9th straight day of losses now for GE Vernova, down around 20% during that stretch. So not a good outing for GE Vernova. Of course, there's all of these names, be it GE Vernova, be it Hitachi, all of them are up 80-90% this year. So now they are coming off the highs, and you heard from Vinny as well as to why all of these names were down. In fact, Siemens was down around 2.5% at the start of the day. That too has now extended its losses and is now at the day's low. And what is also at the day's low is BHEL, and that's not doing very well for itself as well, is now down 3.5%. So a lot of these capital goods, transformers and power equipment supplier names are not having a good day, having a pretty forgettable day at the office. There you see BHEL, a sharp fall in the last few minutes, down around 3.5% in today's trading session. But well, some interesting technical call also came in earlier this morning, and that was from Lawrence Blanco of CLSA, and he said that while the Nifty itself is trapped within a broad trading range, as you can see that playing out right now, and lacks a clear directional catalyst, the underlying market breadth though remains constructive. And the impending breakout in the Nifty Midcap 100 index suggests the risk appetite is strengthening outside the large cap universe. And he has highlighted that Shriram Finance and Lodha are the ones that stand out as technically attractive opportunities, with both having recently completed a significant basing and consolidation pattern breakout. So these are the two names that he has highlighted a positive view on, Rima, and also spoke about the fact that the broader markets are the ones that are more strongly positioned compared to the index. In fact, he also spoke about gold, and he mentioned that for the first time since peaking in January, gold's corrective phase is showing signs of maturity, with a developing price momentum divergence that has emerged between the lows of the 10th and the 25th of June, and that is suggesting that the downside momentum is beginning to fade, and this creates an attractive risk reward accumulation opportunity. Now on the upside, the initial resistance for gold is between the 4400 level to the 4501 level, where the 50 DMA and the 200 DMA and the downtrend resistance from the January highs, all three of them converge. And in fact, if there is a decisive breakout above that cluster, that could provide some additional confirmation that the correction has run its course and that a new advance is underway. In fact, one point gold had even slipped below $4,000 an ounce on the global market. So there's already a $200 rebound that you have seen from those lower levels as well. So, and I guess you guys also spoke to S. Narain yesterday, and he had a different view on whether you should invest in gold or silver or not.
Well, absolutely. But for now, let's just get in Rahul Sharma of JM Financial Services to find out where we are headed. Rahul, it's been 2 strong days for the markets. We're consolidating. Do you see a breakout above the 200-day moving average? And where do we go from here? What are the key levels?
Yeah, hi, very good morning. So clearly, we've decoupled, at least in the very short term, from the Asian markets. We've seen, markets hold the 24,000 mark and trade above that. Now, 24,500, 24,600 is where the meaningful resistance for the Nifty is. In all likelihood, we believe that, it's a good level to take some profits and sit on the sidelines, because next week onwards we're having the quarterly numbers come in, and there is a possibility that the markets may get disappointed from the Q1 numbers. Just to remind, we've been through a lot of things in the Q1 period when we had the war and the crude oil shock that we all saw. So caution is advised, especially for the next few weeks in the month of July series, especially given the backdrop of Q1 shockers that can come in. However, I think this may be the last opportunity for this calendar year, the last leg of volatility that may come, before which, after which we start a structural recovery from here. So if you zoom out a bit, it seems like September, October, we should see a structural recovery happening into the markets. So the short-term outlook definitely remains a bit of a cautious note for the month of July. However, from a slightly more medium-term perspective, it seems like we should be headed much higher from the current levels and probably test the all-time highs as well by the time we wrap up this year in December later.
You're trying to say we are at all-time highs by the end of the year, Rahul?
Yes, absolutely seems like. So the way the technical setup is happening, we feel that any opportunities, any dips from here could be opportunities to re-enter, and the July numbers that come in, the Q1 numbers that come in, that could be the reason for the markets to provide that kind of an opportunity from a 6-month perspective from here.
The music to the ears for those who lost 8.5% in the first half of the year on the index. But for the immediate, very short term, Rahul, you mentioned 24,600 is a good level to take some profits and sit at the sidelines. But does the index have enough legs to get to 24,600 in the first place? Or do you see there is no meaningful resistance on the charts right now? And is the Nifty Bank more strongly positioned in comparison to the Nifty? Because that's the one that has been doing the heavy lifting, barring the last couple of days.
Yeah, so if you look at the last few weeks post the geopolitical situation subsided, it has been the financials and banks which have been leading the show and doing extremely well. Today we are seeing private banking, witnessing increased buying interest. So yes, somewhere or the other, financials are leading the market in the very short term. There is also defense, which has been doing well. There is also pharma, which is rock solid, which has been rock solid in this entire last 3-4 months time frame. So there are few sectors which are holding head and shoulders above the rest of the market. And whether we do 24,500 or not, probably next couple of sessions will let us know that. But having said that, I think the momentum is clearly for the very short term favoring the bulls until 24,500, 600. Post that, I think it's better to take a relook at it. Now, some stocks which are looking good from the defense pack, one of them is Cochin Shipyard. As a disclaimer, we've initiated a buy on this for our clients. The stock looks good for a target of 1650 over the next 8-10 trading sessions. One can look to buy at these levels, have a stop loss placed at 1490. And apart from that, another one is Tata Steel from the metal pack. Looks good for a target of 200, 205. Stop loss can be maintained at 188. So both are trading actionable ideas. Like we said, it's more of a trader's market and it's better to be one.
Any tactical trades on IT names?
Yeah, so IT is purely a bounce back as of now. We don't see a structural reversal of any sort. So, it's better to be a trader in this space. As of now, we're just waiting for some bit of a dip to happen. Today we've opened, yesterday IT was the best gainer in the entire market. A bit of dip from here can make our entry look more attractive. At this point in time, we don't really advise initiating fresh longs in IT.
An interlinked question, Rahul. The US dollar index at one point had gone up to 101.5, but after yesterday's jobs report, that's down to sub 101 again. What are the charts on the dollar indicating? And if the dollar is poised for further upside, what does one do to a lot of these metal names? Because a stronger dollar is not necessarily good for all of them.
Yes, absolutely. That is the reason why we saw the metals saw a bit of a correction. Broadly, metals have been strong throughout, but the recent correction was due to this. Now, looking at the dollar index chart, 100.5 roundabouts is a very strong support for it. So in all likelihood, we may see a bounce back from these levels purely from a technical perspective, and it could very well head back to its recent high of 101.6 odd. So yes, it's going to be volatile, and above that 10.5 mark, I think it strongly remains in an uptrend. Unless and until it decisively goes below the 100 mark, I think it's best to sort of be selective in especially stocks related to metals or some of the higher beta names.
Well, one sector that has done very well, Rahul, in the recent times is pharma. It did very well last week. It did very well this week as well. A lot of these pharma names are at 52-week highs. At these levels, you still see buying opportunities, still see more legs because the index is continuing still at the day's high today.
Yes, absolutely. Pharma is sort of very, very strong at these levels. I think that the latest to add to the list of breakouts in the pharma space is Sun Pharma. The stock has seen significant volumes on a comparative basis, above average volumes in today's session. The stock is taking out the previous top of around 1920 odd. My sense is this stock could head very well towards the 2000 mark and can be traded long at these levels. Overall pharma pack, whether it is Oro Pharma, Laurus Labs, Sun Pharma, or even some of the names like Divi's Labs, are positioned very well. It's a matter of just picking up the risk rewards and getting into them. And as far as this overall sector is concerned, the pharma index is in a structural up move, and unless and until the market comes out of this overall broad trading range, we feel that pharma is here to stay. So we very well remain positive on that space, and Sun Pharma could be looked upon for trading from the current market perspective.
Very quickly, Rahul, before we let you go, the underperformers of the day have been the transformer names, the GE Vernovas, Hitachi Energy, CG Power, all of them taking a big knock today. They run up equally significantly as well. Is this just profit booking from higher levels, or is this the start of a structural breakdown on the charts for them?
Yeah, looking at the way the price and volume action have played out, it seems more like a profit booking kind of a move. And as you likely said, they had their party on the way up. So some bit of pullback only makes the overall trend healthier and stronger in the broader scheme of things. So once this profit booking period settles down, we are looking to re-entry opportunities into these setups, like for something like a GV, TND, very robust chart on the long-term setups, whether it is monthly or weekly charts. It's a correction worth looking at. So let the correction play out for the next couple of days maybe, and post that once the stock stabilizes, we could look at re-entry opportunities at around key support levels.
Thank you very much for that. The mid-cap index will come up for you on your screen. It slipped to the day's low and flat now. It was up 0.5% at the day's high. It's given up all the gains as the session has progressed. Get into a break. We'll get you more on the markets.
Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे, गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा, आप अपना देख लो।
Welcome back. Leverage in Dalal Street is climbing. The MTF book has now crossed 1.35 lakh crore in the month of June. Hormus is joining in with the data. Hormus.
Some very interesting data that has come in this time around for the MTF book for the month of June. Not the fact that it has still continued to grow, the fact that it is still at record high levels, the 1.35 lakh crore now at the end of June. So it was a 7% month-on-month change that we saw for the MTF book. And if you take a look at the stocks as well, the top traded stocks on the MTF book, there have been some changes, and Reliance Industries has now moved right at the top as the most levered stock on the MTF book. So 41% month-on-month growth. There's a similar growth that came out in the last month as well. But the actual move has been seen on Infosys. The moves that you saw on the stock in December, the MTF positioning has gone up and it has crossed 2,000 crore rupees now. A 56% month-on-month move that the stock saw in the month of June on the MTF book. The unwinding has been seen in HDFC Bank. At the end of the May month, the stock was the top traded one on the MTF book. That has seen a 20% correction on that positioning, and it has now gone sub 1800. At one point was almost 2400 as well. So that's a 20% drop on HDFC Bank. And similar to Infosys, TCS too has seen a 23% jump in its MTF positioning for the month of June. But now take a look at the stocks that have seen the biggest increase. These were the top 5 on the MTF book. Now these are the ones that you see that are the biggest increase. Persistent Systems, again, in fact the last month Persistent Systems was among the top names that had seen a reduction in its positions. This time around, from 220 crore the number has moved to around 550 crore on the MTF book. Is a 146% up move that you have seen on Persistent. Vedanta, of course, the second full month after its demerger, that has also almost doubled on the MTF book, is around in a 90% up move in the month of June. BSC has seen a 70% move, and the two Tata Group names, Tata Steel has done well, and Tata Motors Passenger Vehicles, which has been fairly volatile in terms of price action, but on the MTF book, both of them have grown anywhere between 60 to 70%. But the interesting bit is the fact that where there has been unwinding that has been taking place. Before that, look at the silver ETF. That has made a bit of a comeback as well. At one point at the start of the year, the silver ETF was possibly the most levered on the MTF book, but ever since the prices cooled off, the leveraged positioning also came down. There was liquidation there, but in the month of June, there has been a 30% up move that you have seen on on the silver ETF. The Nippon AMC silver ETF is what I'm talking about. From close to 700 crore, it's now 900 crore plus at the end of last month. Now come to the unwinding bit. All 5 names of the top 5 unwinding are Nifty names. We spoke about HDFC Bank, but take a look at the others as well. SBI was among the top 5 in the last month. It has slipped out of the top 5 this time. There's a 43% down move that you have seen in the MTF positions. A similar story playing out for Indigo and for Shriram Finance as well. Of course, the sums there are not significant, but trend too, as the stock saw a bit of a recovery from lower levels in the month of June, but the MTF positioning came down around 37%, and Bajaj Finance too. The stock doing well today, but the MTF positioning has seen some liquidation, and from around about 450 crore, it's now down around 300 crore, sub 300 crore for Bajaj Finance. So interesting trends. The MTF book continues to grow, but the Nifty names are the ones that have seen some significant liquidation, HDFC Bank included.
Thank you very much for that interesting data. Let's talk about one more stock, and that's Avenue Supermarts. And this is not an account of the MTF related news, but the weak business update that they've given for the first quarter. Stock is under pressure. Mangalam joins in with the numbers and what's disappointed the street.
Well, it's a soft first quarter update that has come in for Avenue Supermarts. It's a 15% revenue growth that the company has reported in the first quarter, much below what the street was anticipating this time around. The important parameters that we're looking at along with just the revenue growth is also store additions. Last quarter was a fairly strong one, not so much for the first quarter where they added just about 3 stores. And if you look at it year on year, the store addition has actually been 18.5%, which implies that perhaps the same store sales growth for DMart this time would have been negative if not flattish. So that is something that we will most definitely track, in the street not liking that. Brokerages too have cut their estimates, and that explains why the stock is lower. A lot of the revenue weakness can also be explained by destocking of the pantry stocking that took place in the fourth quarter, and perhaps realizations lower on account of the GST cuts that came by too. But still, it is a lot lower than what the street expectations were, and along with that, even lower than what we've seen for other value retailers report.
Avenue Supermarts among the casualties of the day. Mangalam, thank you for that update there. But auto sales numbers had come in the first 2 days of the month, and Bajaj Auto reported a healthy number as well. Earlier today, we spoke to its joint managing director, Rakesh Sharma, and he said that the trend for the electric vehicles remains strong. Now, on the Delhi electric vehicle policy, he said that allowing hybrid products would have made the Delhi EV policy more balanced. Listen into what he had to say.
It's definitely a very bold move. Particularly because it is very handsomely supported by subsidy and scrappage incentives, etc., which will be persuasive for the customer. But having said that, Delhi is a very large city with vast distances. And in such a market, that what happens is that there is a lot of different types of use cases. A singular approach, which is entirely based on only electric, may not serve the purpose of all types of customer segments. We must use the array of options which are available to us and have a solution drawn from that. But banning everything else in preference to just one approach may not serve all the purposes in the longer term. It stacks up to between 2 to 4% of our all India sales. It's a very, very busy quarter for us in quarter 2 because there are many new launches lined up, and I think that will sparkle the business for us. We are taking all measures to progressively double our capacity, which is right now 50,000 units per month. We are looking over a period of time to double this capacity because we think that this segment is set to grow very fast.
Bajaj Auto there on the auto sales and of course on the Delhi EV policy as well. Take a short break. Back with more on the other side. Stay tuned. Welcome back. The markets continue to remain where they are, and that's something that the bulls would be happy with. They'd want to end the week on a high. This is going to be the 4th straight weekly advance for the index. So that's the positive. And a very interesting note that has come in on what else but the hot topic, that is AI, and that is from Nuvama. And Rima will tell us more on that.
Well, indeed. So, Nuvama believes that the AI mania is now exhibiting clear signs of excess. There is a melt-up of hardware stocks, high valuation, retail euphoria, and IPO boom. They acknowledge that this time, the frenzy is backed by strong cash flows. Unlike in the dot-com era, Nuvama says it is not shock-proof, and shareholders are likely to dissent, which they're saying is already visible, and the shareholder dissent will force hyperscalers to reassess their capex plan. And I think that is an interesting trend to watch, because up until now, shareholders would, or investors would, reward the AI companies for their capex plans. Every time, if the capex plan was not increased, there was a stock disappointment. But now, if that trend continues and shareholders start weighing in, we will have to watch that place. And they're saying that this comes at a time when Fed is also increasingly focused on price stability. I remember one expert saying that what we are facing is commodity deflation and AI inflation. The fading AI mania, Nuvama goes on to say, and rising demand risks a warrant decisive defensive shift, especially when cyclicals are one standard deviation expensive and defensives, whether it's private banks, IT, are on the cheaper side. So the Nuvama strategy is now tilting towards defensives, in that it includes cement, focus on profitability, chemicals, because there's a forex tailwind. Pharma is a defensive, and they are underweight on auto cyclicals given the demand risks ahead. So they do expect perhaps the AI bubble or the mania to cool down, but their tilt is towards defensives.
Cooling down, it is cooling down actually with all the semiconductor stocks and the way they are selling off, recently on Wall Street, all the AMDs and the Microns, all of them over the last
And for the last 2 days, the software companies have made a comeback.
Software companies are doing well, yeah. That's their time in the sun. Saying, oh, we are still around. Don't forget us. But with markets navigating global uncertainty and an uncertain growth outlook, Axis Mutual Fund Shreyas Devalkar shared his views on sectors that he likes, the margin pressures due to input costs, and the road ahead for India's economy.
One view we are also taking that it is also we have to look at 2-3 quarters ahead, because already these commodities have started falling and you are sitting on a price increase. So how much impact it will have on the margins 2 quarters down the line. So this quarter margin may be washed out for someone because of the raw material impact. So this holistic picture we are taking, and when you are talking about FMCG, I'm just broadening this conversation to entire consumption basket, including retail credit growth driven banks and NBFC, including the FMCG, autos, and many of the consumption segment of market. So one, as I said, and the second is the coordinated efforts of both central bank and central government to bring in the FII flows, especially in the bond market. So these were the two main triggers for this. We are positive on entire capital goods space, especially the mid and small cap oriented funds. And when I say capital goods, it is more to do about manufacturing. So it is whether it is auto ancillary. They are also having a lot of manufacturing through non-auto businesses. The market may reward more of the manufacturing segment because of the global disruptions. Whenever nominal GDP growth improves, the headline numbers start improving, and that gets reflected in the quarterly previews what are getting released now, that you may observe that. Even the retail credit growth, what we are witnessing upwards of 15%, is partly because of that, partly because of from bond market to banks, etc.
And on that note, we take your leave on this edition of a Trading Hour for the final time this week. From Rima and me, thank you so much for watching. Halftime report on the other side.
Stocks see a broad-based rally with advances significantly outnumbering the declines. IT, healthcare and realty are the big gainers, while PSU banks are in the weak spot.
HCL Technologies bags a $1.14 billion deal from a Fortune 50 company to build an AI-driven enterprise model. The deal from this new client has an initial term of 5.5 years, extendable by another 5 years. The stock climbs on the news.
Brokerages flag the threat from a likely recent easing of restrictions on supply of transformers by 4 Chinese players. The move said to be driven by the need to rein in prices and enhance supply takes a toll on stocks of peers.
PB Fintech sees a sharp drop after Temasek sells a near 2.6% stake, while DMart and Union Bank slump after posting disappointing business updates for the first quarter of fiscal 2027.
Hello, good afternoon. You've tuned into a halftime report coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Sonal Putra. Sonal, a good afternoon and a good Friday coming in for the market so far, right? They're managing to hold steady. Nifty around the 24,350, around that market's what it's holding on to. Not much of a move in today's trading session from that level. So more of that range that we're seeing coming in here. Now, today what's interesting is the IT pack. That continues to see an up move today, 2% gains for the Nifty IT, so watch out for that. Apart from that, what are the banks doing? Not as much as an uptick that we are expecting it to see. Nifty Bank is holding on to a slight bit of a gain in today's trading session. Flattish largely as of now in the trade. It's flip-flopping between the red and the green. Pharma, realty, metals, that continue to shine. And energy is also something that's a bit muted in the trading session, Sona.
Okay, so bulls definitely in the Friday mode, and so are we. It's been a long week, but if we talk about the markets, as Vinny mentioned, the broader end of the markets in favor of advances. If we talk about some of the big Nifty gainers, we do have HCLTech on the back of that big deal, is up around 6% in trade, followed by a lot of these pharma names, hospital names as well. So Max Healthcare is up around 2.5%, Dr. Reddy's, Apollo Hospitals, Sun Pharma. The list continues for the pharma and the healthcare space. We'll discuss that and a lot on transformer stocks as well, and something on the realty space as well. So let's tell you what we do have on the show today. We'll focus on the transformer stocks on the back of power sector policy shift and take the conversation forward with Amit Anwani of PL Capital. We will talk about Lodha and Shriram Finance after a CLSA note says that both the stocks stand out as a technically attractive opportunity. Housing sales have declined 6%, and Mumbai and Bengaluru accounted for over 48% of total sales in Q2 of 2026. We'll discuss residential trends with Anrock Property Consultants' latest report with the chairman, Anuj Puri, and Manisha will talk about the fall in cryptocurrencies in the month of June. And with that, we'll go across to Vivek and talk about some of the stocks that are moving around in trade. Vivek.
Well, thank you so much for that. You know, it's a very topsy-turvy market, especially the kind of heavy news flow that we've seen, quarterly updates, developments as far as the capital goods space is concerned, and also the kind of rebound that we've seen as far as the entire IT pack is concerned. So let's start off with the IT names first. Yesterday, you saw the IT index itself high by almost 4.5%, and today there's been a bit of a follow-on rally. HCLTech, a very large deal announcement that's come about, Persistent, Emphasis, Coforge, all of these stocks continue the rebound quite smartly. The other name on the radar, of course, has to be some of the NBFC names, both Bajaj Finance as well as Bajaj Housing Finance. Very encouraging quarterly update. Bajaj Finance, in fact, hitting the upper end of the guidance as far as the growth is concerned. Both of these names higher in the session today. M&M Financial, very healthy business growth. Remember, Q1 is a seasonally weak quarter for the company, despite that higher by 4% today. Angel One, that particular stock too, despite the weakness in capital goods names, is doing quite well. The MTF book has hit a fresh record high. And pharma stocks, last couple of trading sessions, we've seen a bounce over there. Today, most of them have continued the rebound. Aurobindo Pharma high by 4%. Sun, Piramal Pharma and Lupin also moving higher in the session. On the other hand, the capital goods stocks are worry about the competition coming in from Chinese players is something that's taken down most of the transformer companies. Have a look at Hitachi Energy, also known as Power India, down 9%. BHEL, another stock that could be severely impacted, down 4%. CG Power and Siemens Energy also on a downward trend. Union Bank is the other name on the radar. Sequential deposit growth has been quite muted. That stock lower by 6.5%. Policy Bazaar, we saw a large block trade, but the stock hasn't recovered after that, still down around 5%. And DMart, remember, last couple of trading sessions, it was a significant underperformer versus the consumer goods and the consumer discretionary space. Today, down by another 5%. The quarterly update is not what the street was anticipating.
Yes, it's down 4.5% on the back of that. Thank you so much, Vivek, for bringing us all those details. So those are some buzzing stocks. Let's talk about the realty space now. A latest Anurag research data says persistent uncertainty amid the West Asia war and supply chain disruptions impacted housing sales in the top 7 cities in Q2 of 2026. Residential sales have overall declined by 6% on a YOY basis. To talk to us more about the trends on ground, we have with us Anuj Puri, Chairman at Anurag Property Consultants. Anuj, good afternoon. Thank you so much for joining us. Q2 did see a lot of impact in terms of West Asia crisis, but do you think this decline could be sustainable because demand maybe has peaked and we could continue to see fall going forward as well?
Good afternoon to you and all the viewers. It is true is that the April to June quarter, we saw a decline both in the number of units sold as well as the value. So in the number of units sold, there was a 6% decline in the top 7 cities. And in terms of the value, there was a 7.2% decline compared to the last year. Clearly, the way the data has come out is that April was absolutely a disaster. May and June really came back bouncing. In fact, May was the best May that we have seen as a month over the last 18 months, and May and June combined did well, as a result of which they were able to cover a lot of the shortfall that had happened in April. We do believe is that there is going to be pressure on the affordable housing that has continued to remain very muted and overall has now gone to only 6% of the overall supply. And you may recall before COVID, it was about 34%. So really affordable has got big time impacted. And we are starting to see the downward trend in the mid-housing segment as well. What is really taking up the value in terms of the residential is the luxury. And there the demand still continues to remain solid. The developers are continuing to pour concrete on the luxury because as a unit economics, that is really working for them, and the demand continues to remain strong in premium and luxury.
Okay, premium luxury is where the demand is steady. Mr. Puri, good afternoon. Thanks so much for joining in. Any specific geographies which are seeing any specific trends? Is there any varying trend, or it's across the country that we're seeing similar trends?
So it is almost across the country, but clearly Mumbai and Bangalore led the sales in April to June quarter, with the Oberoi Construction having a very successful launch in this quarter. At the start of July, they've had a very successful launch. So our data is showing is that July to September quarter for NCR is going to be very strong. And these three markets, NCR, MMR, and Bangalore, put together is about 65% of the overall market in India. So we do see is growth coming in all these three cities.
Okay. Anuj, you also indicated that supply increased in some of these geographies. How does it compare with demand across the board? And 6% decline in Q2, a lot of it led by the crisis that we saw. Do you expect the degrowth to continue, the decline to continue, or do you think we'll see a positive number in the quarters coming by?
So overall, our thought is that 26, 27, we should be able to see a growth of 8 to 10% in terms of value. So definitely in the subsequent quarters, we do expect the growth to come back across all the major markets.
Will it be led by volumes or will it be led by pricing?
I think pricing has been very, very firm, and we haven't seen any decline in the pricing. In fact, the developers, whilst the volume and value had gone down in first quarter, in terms of the number of launches, it was 7% up compared to the previous year. So clearly, the developers are still continuing to see that there is enough energy and inertia, as a result of which they have continued to launch in the first quarter of this financial year. And even if you were to look at the land acquisitions that have been done, about 3,000 crores of land acquisitions that were done by the developers. So there seems to be a lot of positivity still continuing within the residential segment.
Okay, just a question again on the pricing, Anuj, since the supply-demand dynamics are not exactly matching. And also you're talking about affordable and mid-housing seeing some pressure right now, which has not reached luxury yet, which is also where the demand tends to get little inelastic because of the price point that we are talking. Do you think going forward there is a possibility of price cuts, or will they continue to consolidate at current levels?
We definitely don't see price rise happening. Is a lot of the costs that had got increased through the West Asia crisis have really been taken as a hit by the developers. They haven't been able to pass on that cost to the buyers. Once they've absorbed this cost, we do not feel that there is any indication coming in from the developers on a price cut. So I do feel is that whatever buffer the developers had in terms of profit, they have consumed that buffer with the West Asia crisis increase in the input cost, and ability to bring down the prices is just not there with the developers.
Okay, point taken there, Mr. Puri. Also, I just want to understand specifically now for Indian markets, overall, how will the dynamics change as well? You spoke about it, that, there are a lot of players who have come in here as well. Oberoi Realty also coming up here. They've been there, but there's an increase in terms of presence. So how does this change the overall dynamics, and any change in terms of the pricing maybe we could see, especially for Mumbai?
So it's a very good question that you ask. Is what we are seeing is a consolidation in the overall play. As I said, is that our thought is that this year the value and volume should go up by 8 to 10%. But you will see is amongst the listed players, they will grow between 10 to 20% year on year. And that's where the trend is very visible and noticeable, that if good quality developers are launching their projects, I give that example of Oberoi, which happened just a couple of days ago, we're seeing clearly a huge amount of demand coming in for quality developers, both listed and unlisted, which does mean is that the market is consolidating very rapidly in favor of the good quality developers. And you will see is that they will outpace the growth in the market, a trend that we have seen in many mature markets, including China. When this entire maturity of the real estate started, the consolidation of the developers happened, where B and C developers will find it difficult to be able to sell. And it'll be largely A-grade developers who are going to be sort of having somebody else's lunch.
Okay, we've been talking about the consolidation theme for a while now. We did see that impact in the balance sheets, in the numbers for all these organized listed players as well. Thank you, Anuj, for joining us today with your thoughts and telling us what the demand is looking like on ground. So yes, Q2 did see a decline, but the expectation is that that could reverse in the coming quarters, and they're expecting a growth of around 8 to 10% in FY27. We'll slip into a short break. When we come back, we'll put focus on the transformer stocks. We'll speak to Amit Anwani of PL Capital to understand the new regulation that has come by for this space.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
Jimmy?
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
जिंदल साथी सील है तो असली स्टेनलेस स्टील है।
तो जब भी आप स्टेनलेस स्टील पाइप्स एंड ट्यूब्स खरीदें, जिंदल साथी सील जरूर चेक करें।
Jindal Stainless, India's leading producer of stainless steel.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is inched up a bit in terms of a few points higher. We are now 192 points higher in terms for trade for the Nifty 50. 360, 370 levels around is where the Nifty trades at. Broader end of the market also seeing some bit of attraction. But one sector that is not doing well today is the capital goods side. We have some announcements that came in, and this is obviously that is sourced from brokerages as well. What we see that the Ministry of Finance has come out with a memo. This is actually a government exemption under the public procurement order. This is for a 2-year exemption for Chinese companies that were exporting transformers here. So this is mainly coming in for 4 Chinese companies now. TBEA Energy, we have Nanjing Electric, as well as New Northeast Electric and Taikai Electric, which are involved in this as well. To understand more on this, what it means for transformers companies, what it means for the HVDC projects, who could see the impact of all of this coming in if this is a 2-year extension that's coming. Let's bring on board Amit Anwani, Vice President Institutional Research, PL Capital, joining us right now. Amit, good afternoon. Thank you so much as always for joining in. Now, obviously, in the update that is coming here, what is the major impact now we see coming in? Should companies be more impacted, given that previously in Feb 2026 we had seen this coming in for TBEA? They had announced about that. So is this something more of a worry for these companies now?
Thank you so much for having me. I think so. I think we have seen the impact today in pricing of Siemens, the frontline MNC companies in HVDC. Just to the point in perspective that we as a downgrade because the valuations were already expensive, upward 20x, 75x for this pack, despite they have a very strong order book. I think critical here that the notification is talking about easing the supply chain, and the companies which mentioned they also includes few product insulators and bushings, which have kind of giving challenge to the OEMs and increasing the lead times for many. So I think this notification is deliberate in terms of giving a short-term or medium-term ease to the supply chain till for bushing, insulators, and few other critical components ramps up. That is the point which I can.
So you're saying these are some critical components that we require, right? So currently, obviously, these are those subsidiaries of the Chinese company. So you have anything in terms of the capacity that they already have here? And do Indian players also have this capacity? Do we have enough of it? Or was this required maybe for the supply right now?
Right. So if you see the all HVDC companies plus the MNCs have already announced mega capex. If I do it cumulatively, more than 10,000 crores to localize plus to get benefited from or to be ready for the HVDC pipeline, which is there. But I think the key component which was adding there is a lot of components, as I discussed. I think the notification talks about these companies have to have a facility from which they will be supplying. So now I think the next question is whether, apart from the existing capacity these 3-4 companies have, are they going to invest more, participate in future projects? Probably that is the question we have to ask. But what can happen is probably in the space like bushing hitters, few companies, probably the prices were elevated and it was impacting the deliveries at the OEM end. That can be eased off. So I think the project executions and OEMs might be at some bit of ease. Suppliers comes into the market.
So you say that supply will ease because of this particular notification which is coming from the government, but it will increase competition for existing players, right? That's something which is expected.
Right. So not the HVDC player, because HVDC players have been, as I said, investing heavily in India, and they basically are the OEMs. Probably for insulator manufacturing companies, for example, the names I recollect: Yash High Voltage, Modern Insulator. There's a few companies who are increasing, ramping up capacity. Also,
so Amit, what are the stocks? Yeah. So then, what are the stocks factoring in today? Is there a fear that it would go out to HVDC as well, this relaxation that is coming from Chinese companies? If it does happen, if you can compare Chinese producers versus Indian producers in terms of their scale, in terms of the margins that this would come at, there is something that the street is factoring in here, right? Or is it an unexpected decline that we are seeing across the board?
I think, see, this notification came Jan, and what we gathered from the companies, especially the HVDC companies, is that there would be no minimum impact, and it is unlikely that the government will allow the traded goods to come from Chinese. And even if the Chinese companies have to supply, there's already save it to that they have to do it from manufacturing companies. So I doubt that will be directly impacting the future HVDC projects, where government is already talking minimum 60% local requirement, which all of these MNCs also have to comply with. By F35, they have to do minimum 60% local component supply, all the HVDC, VLC, LCC projects. So that is there. But having said that, the valuations were already steep for these companies. The correction has happened in this space here.
Okay, so that is why you already had, you didn't have a overweight rating on this, right? Right now, any of these stocks?
So we actually downgraded. So in terms of rating, my rating down from buy to accumulate for GE with 4,600 target price, and for Hitachi from accumulate with 30,700 target price for Hitachi. We downgraded both the space back, yeah.
So which amongst these stocks for you, Amit, would be still a pick or a buy from the sector despite whatever notifications coming in and valuations, or are you generally negative on the sector overall now because of valuations?
Correct. So I think whole space, the valuation is steep, and we have been highlighting this. But if at all I have to pick one company in the space we are discussing, probably generally at dips is something I would prefer.
Okay. Amit, the point taken there, and thank you so much, for joining us this afternoon and speaking with us and explaining us what this notification actually means for these companies as well, and who is likely to be exempted given valuations are so high for these companies. Thanks so much for joining in. But yes, that's all about the capital goods space right now. We're going to sip into a very short break. After the break, we'll come back and we'll have Saumil Mehta of Mirai Asset Sher Khan, who will join us to talk to us about his trading strategies. Stay tuned in.
Concerned about the market dip?
Yeah. Last time this happened, I just stopped my SIP. I don't want to lose more.
But let's get an expert opinion. We have Rakesh who's joining us.
The market has dipped, and that's exactly when your SIPs work the hardest for you. The biggest mistakes that investors make is stopping when they should not. The whole idea of SIP is when the market dips, you're buying more units of the mutual fund with the same amount of money. And that's how the rupee cost averaging works. Stay invested, stay disciplined.
Absolutely. Sip on your coffee. That's the spirit. Let the SIP do what it's supposed to do.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
We are over, Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
जिंदल साथी सील है तो असली स्टेनलेस स्टील है।
तो जब भी आप स्टेनलेस स्टील पाइप्स एंड ट्यूब्स खरीदें, जिंदल साथी सील जरूर चेक करें।
जिंदल स्टेनलेस, इंडियाज लीडिंग प्रोड्यूसर ऑफ स्टेनलेस स्टील।
Exchange.
Welcome back. You're still tuned into Halftime Report. The mid-cap index continues to do well, but it is underperforming the benchmarks. We do have a couple of stocks in the broader markets which are buzzing on the upside. Huge volumes. We have IKEA Lighting, which is higher, up around 15.5%. There is Suvain Life Sciences, which is up around 10.5% as well. The mid-cap IT space continues its up move. Zensar is up around 10.5%. We also have this new listing, Waterways Leisure, which was up 10% yesterday, is adding another 10% today. Despite that muted debut, the stock is making a comeback, and that's another day of upper circuit on this name. But that's all about individual names. The markets, they continue to trend higher. Let's go across to Sudarshan, who is here to talk to us about all the trends that he's tracking in the F&O space. Sudarshan.
So market continues to trend higher, as you have said, and what's supporting the market are two major segments, or say defensive sectors, and those are IT and pharma. Nifty Bank, though, remains a bit of weak. It continues to see like selling when it tries to cross the level of 58,000. Major buying in the banks can return only when Nifty Bank crosses the level of 58,500. Another positive part is volatility index. India VIX continues to hold the levels below 12, and that's 5-month low. And also we are seeing major put writing between 24,200 to 24,300, and at the same time we are seeing short covering on the call side between the range of 24,100 to 24,200. So it gives you the range for Nifty. At the lower level, 24,100 is going to act as a major support. At the same time, when it tries to cross the level of 24,400, it's like it becomes a major supply zone. So for Nifty to move higher, it has to cross 24,400 comfortably. As far as Nifty Bank is concerned, support would be around 100 DMA of 57,200, and resistance, as I told you, that major buying will return only when it crosses the level of 58,500. Some of the stocks that have been in the focus, L&T Finance ahead of quarterly updates has been seeing fresh longs, and over the last few days this stock has been moving higher, and over the last 2 days MCX and BSE have been weak, and today also both these counters have been seeing fresh short additions, and Bajaj Finance, after strong quarterly updates, has been seeing fresh longs.
Okay, Sudarshan, thank you so much for the update midday in the world of F&O. Thanks so much for that. But on that note, let's also bring on what Somil Mehta, Head of Retail Research at Mirae Asset, Sher Khan, joining us on the show now. Somil, good afternoon. Thank you so much for joining in as always. And, we've seen gains coming in the last few trading sessions. Now, today, obviously, we're managing to hold on to those 24,300 levels. What does it mean if we close above these levels? Could we see a further run up, or do we have to wait, or would we be range bound now? What's your view?
Good afternoon to everyone. See, the view definitely is positive. We're making higher tops, higher bottom on the daily charts, weekly charts. We've broken the previous week high as well. We've been trading about 20 and 40 daily moving average. So overall, the trend is positive. Now, the most important part here is that we've taken support. Nifty has taken support at 23,000, 23,100, which was a very crucial support, very crucial, mark, because it was the 61% retracement of the entire rally, which we saw previously from 22,200 to 24,600. So that level is very crucial. Now, in the very short term, we're making higher top, higher bottom. And the crucial resistance now is at 200 daily exponential moving average, which is 24,400, 430 to be precise. 24,430 is a very crucial hurdle for the markets. And if we close above that, then the next level opens up, that is 24,600 in the very short term. However, because we are making higher top, higher bottom formations on the weekly and monthly charts, I think the medium term outlook remains positive, and in the medium term I'll be expecting a target of 25,100, which is a gap area formed 3 or 4 months back. Now the support levels in the very short term will remain around 24,000 mark, which was yesterday's low, and 20 daily moving average, which is very close to 23,800. So these are the levels, and the strategy should be to buy on declines. Bank Nifty, again, same thing. It has been consolidating in the last couple of weeks. It has not broken out like Nifty. I'll be expecting this consolidation to break on the upside for Bank Nifty for a target of 59,700, which is the upper end of the Bollinger Band, and the support remains around 57,400. Overall, the bias remains positive, and the strategy should be to buy on declines.
Saumil, quickly, if you can tell us which are some of the stocks that you're betting on?
2 stocks. First one is SRF. SRF has broken out of a triangle pattern, closing above 200 daily exponential moving average. Great setup here. I think this is a medium term breakout because it has broken the previous week high as well. So my targets would be 3,000 and my stop loss would be 2,740. The second stock is Max Health. Pharma sector is definitely doing really well. Max Health has started forming higher tops, higher bottom, very good risk reward ratio for investors as well. Now here, the stop loss in the very short term would be 1,110 and the target would be 1,230.
Okay. Saumil, we have a couple of queries that have come in from viewers as well. We have Manish Gupta who's writing to us from Chandigarh. He's asking if it's the right time to invest in Swiggy for the short term at current levels. Last 1 year, obviously, the stock has seen a fall of around 35%. Would it merit entering now?
In the very short term, I like Eternal more. It has just broken out of a consolidation. But for very Swiggy, it's very risky at this point of time, because in the last, if you've seen in the last 3 to 4 months, it has been taking resistance at 40 daily moving average and slipping down. Even right now, at this point of time, it is exactly at the 40 daily moving average. So I'll wait and watch. Till the time we don't get a close about 260, I would stay away from Swiggy.
Okay, so the next one is coming from Sunita Jain. She's writing to us from Pune, holds 400 shares of Ashok Leyland at 85 rupees. She asks if she can book her profits now. Decent profits, actually, almost doubled from her buying price. What do you make of this stock technically?
Yeah, I'm still very bullish on Ashok Leyland. It has just broken out of a flag pattern on the daily charts, closing about 200 daily exponential moving average. So my targets for Ashok Leyland in the very short term would be 172. And if it closes above 172, the next level would be 180. So these are my targets. I think you can hold on to it.
Okay. We'll keep an eye on those levels over there for Ashok Leyland. But on that note, Saumil, thank you so much for joining us this afternoon. Again, talking to us about your individual strategies as well as in terms of individual stocks and markets. But on that note, we're going to slip into a very short break. After the break, we'll have Manisha Gupta, who will be in conversation with Harshal Barot of Metals, and they'll be focusing on metals as well.
Welcome back. Joining us on the show now is Harshal Barot. He's Senior Consultant South Asia at Metal Focus. Harshal, hi, thank you so much for joining in. And my concern or my focus really is on silver, because we have seen gold and silver, both of those imports continue to decline month-on-month basis in 2026. But the kind of decline that we are looking at in silver has been really sharp, and May is a 3-year lows. What are the concerns, the kind of premiums that silver is running right now? What is your sense going forward on that?
Good afternoon, Manisha. As far as premiums are concerned, yesterday they were around $6 an ounce, so roughly 10% premium, and they've been persisting for quite a few days now. So one of the big reasons is that silver, basically under all HS codes except silver dore, has been restricted. So you basically require a DGFT license to import silver into India. And from what we know from our discussions is that it's very difficult to get the license. Certain traders have applied for it, but they're not sure about the quantities that they'll be granted. So in a way, there is a supply squeeze in the market. There's no fresh metal available. So the market is at the moment running on stocks that were previously imported, or the selling that we are seeing from ETFs in general, and some amount of recycled silver that is coming into the market. But fresh imports are definitely very, very low at the moment.
With the way things are right now, is there a lot of demand as well? Or do you think with 10% of a premium, that itself is deterring some fresh demand?
I wouldn't say that at the moment, because it's a seasonally slow period as far as silver demand is concerned. So we would expect demand to start coming in from August, September onwards, when the festive and the wedding season starts in India. So I think that's the only saving grace. Otherwise, the premiums would have been way more higher than what we have at the moment. So I think we are keeping a close eye on this. We expect some kind of easing to happen, because from what we gather, the trade is also actively trying to source silver dore if they can, because that's the only avenue available at the moment. So either ways, if the imports resume, if we see some normalcy in that, the premiums might come down. But otherwise, we are going to see a very interesting festive period where we have good demand coming back into the market, but there's no supply.
How are you also looking at the overall demand? I mean, as you said, the jewelry demand, the investment demand perhaps is not so strong, but the industrial demand side of it, do you see that inelastic? Do you think that is sustaining?
I think that's relatively inelastic in our opinion, because that doesn't tend to change as much with the price. So we don't see any major impact as such from the industrial side. Investment demand, definitely what we are seeing is that, yes, there is some amount of selling that's coming from ETF, but otherwise investors still broadly holding on to the metal. So nobody is in a hurry to sell silver at the moment. I think people are still generally bullish as far as the price is concerned. So yes, it is slow, but we are not seeing outright selling happening as well.
Harshal, what is your sense, as in Metal Focus in-house sense, on silver prices going forward from here? Because various banks and brokerages are putting out numbers anywhere between 40 on the lower side to 135 on the higher side in a period of next 12 months.
So Manisha, I think we are somewhere in between. We are not bearish as such. So I think on the lower side, we still see, 55 odd levels, which we saw, the market coming close to previously as well. I think they should hold. And with the latest data that we've seen from the US, some of the concerns regarding an outright rate hike, I think they seem to be overdone as well. So I think that should support both gold and silver going forward. We expect the price to move higher over the next 12 months, more in the $80-85 range as of now. But eventually, I think if the momentum in investment really resumes like we saw last year, then we could be looking at $100 odd as well. But at the moment, we are seeing more of an $80-85 target for the next 12 months.
Harshal, given the fact that we're looking at an El Nino year, the monsoon is still deficient. July till time seems fine, but that also is an expectation that July first half is going to look at good monsoon. With the way the prices are and the availability, and with the fact that yes, urban has started to pick up in sense of silver, in sense of investment demand, but rural buys a lot of silver. Are you looking at a bit of a disparity across pan-India when it comes to silver buying this time around?
Yes, Manisha, I think, the rural consumer is also far more price sensitive. So we've seen that negative impact on silver purchases in the rural market since the last year and a half when the prices started to make record highs in the Indian market. So I think that dynamic will continue. We'll wait and see how the agricultural scenario pans out in India. but that's definitely a dynamic that we are watching very closely. And as you rightly said, on the urban side, we have a different dynamic at play where the silver market is getting more organized. There's more acceptance of fashion silver jewelry. We have more organized stores coming up, just exclusively selling silver jewelry. So I think that that's the positive side of it, which should help support volumes in the Indian market. But that being said, that kind of jewelry is still far more lightweight than what you sell in rural India, the kind of piles and anklets, which are far more heavier in weight. So the urban demand will offset, but not completely the decline that we are seeing in the rural demand.
Okay.
Okay, all right, Harshal, thank you so much for joining us with your thoughts. Manisha, thank you so much for taking us through this interesting conversation. Slip into a short break now. We'll get you more on the market, stock-specific action on the other side, and take your leave for now.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back, and now it's time for our Crypto Corner segment. We have Manisha back with us, taking us through what's happening, what are we watching out for in terms of the developments in the world of cryptos. Manisha, over to you.
Well, thank you so much for that. When you look at the overall crypto market, the month of June wasn't so great really, because the Bitcoin closed June down by 20.5%, which was a 7th negative month of a decline therein. And then you have June also as the worst month since we've seen in 2022. And that's not just about Bitcoin. If you look at Ethereum, that fell 21.7%, 8th June in negative since Ethereum started to trade. The institutional sell-off has been one reason for that. And then you also have a record $4.5 billion in net outflows from the US spot Bitcoin ETFs and markets therein. Overall market capitalization also has taken a hit. Currently, we're trading at $2.1 trillion. An all-time high was $4.3 trillion back into October 2025. But there is just so much to watch out for. The markets, for example, are reacting right now to the weak US payroll data. The street was anticipating a number of 110,000. You got 57,000 there. And then there also are immediate fears of aggressive US rate hike actually going down into the markets. There are 5 US regulatory bodies which are proposing a strict bank-grade KYC compliance rules under Genius Act. If this goes through, you could be looking at some positivity and transparency coming back into the markets. And then there also are some major companies like Stripe, Coinbase, BlackRock, which are backing a new stablecoin protocol, which is called OpenUSD, worth watching out for. In focus also is going to be the White House 4th July symbolic target deadline date to sign the Clarity Act. So today and tomorrow, the street will watch out for that. And then it is going to be about the federal banking regulators facing July 18 deadline to look into the final rules governing payment stablecoin issuers. So those 2 dates should be on your radar. There also are upgrades in blockchain. You have Ethereum, Glamsterdam, Hard Rock, which is coming in second half of 2026. A major scaling up coming in from Ethereum after a very long time. And then you have real-world asset tokenization, wherein financial platforms like Ondo Finance and Securities have developed or deployed SEC-aligned tokenization stock models on Solana and Avalanche blockchains. These are trading shares on-chain real-time, and this is quite a move from traditional asset classes into on-chain rails.
All right, important updates there. Thank you so much for bringing us all these details from the world of cryptocurrencies, Manisha. Let's submit a short break now. When we come back, we'll talk about some stock-specific action on the other side.
CNBC TV 18 presents Crypto Corner, powered by Binance.
If they
Welcome back. You're still tuned into Halftime Report. Well, the big call coming in today, CLSA's Lawrence Blanco says while the Nifty itself remains trapped within a broad trading range and lacks a clear directional catalyst, underlying market breadth remains constructive. The impending breakout on the Nifty Midcap 100 suggests risk appetite is trending outside the large cap universe. Shriram Finance and Lodha Developers stand out as technically attractive opportunities, both having recently completed significant basing and consolidation pattern breakouts. So these are two stocks that CLSA is quite bullish on. So let's talk about both of them, and let me start with Lodha Developers. That's the technical call coming in from CLSA. Let's talk about some fundamentals for now, because the company has been seeing a lot of action. Last week itself, promoters sold 1.99% stake in the company at a price of 937.85 rupees a share, which was a total of around 1864 crore rupees, and shares were sold to Fidelity managed funds. So that was a big deal that took place where promoters sold 2% stake in the company. Let's talk about what's expected going forward. Quarter one updates are expected very soon, and Jefferies has put out a note where they expect the company to see pre-sales growth of around 5 to 10% between 4,800 to 5,000 crore rupees. Remember, the company has a guidance of 24,000 crore rupees for this year in terms of pre-sales. So Jefferies says the quarter one performance will be lower than the FY27 guidance that the company has spoken about. Now, if we talk about how Lodha has performed fundamentally since its listing back in April 2021, they've delivered 28% pre-sales CAGR. Their leverage, which was a big problem during IPO, it has come down sharply from 5 times to around 0.23 times. And the company says they will continue to achieve those levels. Company aims to lift their rental income from around 300 crore rupees in FY26 to 3,000 crore rupees in FY32, which will be led by their data center business. And data center business is something that a lot of analysts are also quite bullish on. The company, remember, missed their FY26 sales guidance because of the impact of West Asia war. But overall, if we look at the realty performance, the realty index fell around 30% from its peak at the start of this year. It has recovered sharply from those lows as well, around 25%. And if we take a look at some of these stocks and their valuations, 1-year forward price to book for Lodha is at 3.3, which is lower than the 5-year average. Similar is the case for DLF as well, which is largely similar. Godrej Properties has seen a big fall. Oberoi Realty is largely at same levels as 5-year average. But if we talk about Prestige Estates, that is one which is trading at a premium to its 5-year average. So Lodha and Oberoi Realty are something to these two stocks, and also Godrej Properties, which are trading at a discount as of now. The stock is off around 28% from its 52-week high, has been gaining around 11% this week, is absolutely flat this year so far. But the technical charts indicate that there could be an up move which would come by.
Absolutely, that's about Lodha, but let's also talk about Shriram Finance, right? That's the other one. Ananya is here to give us more details on that. Ananya, over to you.
So, well, yes, Shriram Finance continues to remain a standout performer in the NBFC space. So, if you see, the stock has gained over 18% in the last 1 month, 7% in the last 6 months, and delivered a stellar 1-year return of around 58%. Now, while breaking above the 1,000 mark. Now, the rally is backed by strong participation with daily delivery of around 71%. Now, if you look at the fundamentals, management has retained its FY27 AUM growth guidance of around 18% and expects NIM to remain around 8.5%, supported by lower funding costs, while asset quality and credit costs are expected to stay stable. Now, the street is broadly expecting 17 to 20% AUM growth, ROA of 3.7 to 3.9%, and ROE of 13 to 14%, driven by healthy vehicle finance demand, strong gold loan growth, and improving operating leverage. Now, with gold prices also rallying today, that could provide an additional tailwind to its gold loan business. Now, coming to the valuation. Now, on valuation, the stock currently trades at around 3 times book value. Motilal Oswal maintains a buy with a target price of 1,175, valuing it at 1.9 times FY27 book and 1.7 times FY28 book. Now, the broader brokerage view also remains positive with a target price in the range of 1,200 to 1,250 and valuation of around 2.2 times FY27 book. So, overall, if you see, Shriram Finance continues to take most of the boxes in this space. Okay, all right. Thank you so much, Ananya, for joining us with all those details. Those are the two stocks on our radar. And with that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.
Stocks see a broad-based rally with advances significantly outnumbering declines. IT, healthcare and realty are the big gainers, while PSU banks are the weak spots.
HCL Technologies bags a $1.14 billion deal from a Fortune 50 company to build an AI-driven enterprise model. The deal from this new client has an initial term of 5.5 years, extendable by another 5 years. The stock climbs on the news.
Brokerages flag the threat from a likely recent easing of restrictions on supply of transformers by 4 Chinese players. The move, said to be driven by the need to rein in prices and enhance supply, takes a toll on the stock of these companies.
PB Fintech sees a sharp drop after Temasek sells a near 2.6% stake, while DMart and Union Bank slip after posting disappointing business updates for the first quarter of fiscal 27.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Patakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormuz. You know, positive global cues helping the Nifty climb that 24,350 mark at that point as we speak. But the broader market's not doing as well.
Well, par for the course. And the Nifty, of course, after the weak start to the week, has had a very strong start to the month of July, actually. Call it Friday blues, actually. But yeah, well, it's been a good start for the Nifty, at least to this session and to end the week on a high as well. It's closed at a very important supply zone in yesterday's trade, and it has broken out above that level that was of 24,150, 24,200, and more importantly, it has sustained above those levels. So the bulls would like that. The fact that they're going to end the week on a high is going to be the 4th straight weekly gain, and now it opens up 2 very important levels on the upside for the Nifty. One, of course, is going to be the 7th of May high, which is 24,482, and of course the April 21st swing high, which is 24,601. That is the level that you need to now watch, the 2 levels on the upside. But for now, the bulls will be happy with this, and they'll be happier for the fact that the gains over the last 2 days have come without the banks outperforming.
Absolutely. And, you know, that's the IT stocks that have been helping them climb higher, right? They rally for the 2nd straight day. It is the top gaining index today, about 2.3% in the green. HCLTech rallied in trade and is now nearly 7% higher after the $1 billion AI transformational deal. Other stocks also perk up on the back of this. Persistent, Coforge, both of those up over 3% in trade. We've got those healthcare names. Those are doing well as well. Sun Pharma, Max Healthcare, Apollo Hospitals, all of them between 1 and 3% in the green. On the downside, we've got those PSU banks, as Hormaz pointed out. The banks haven't been participating in this rally as much as they were previously. So PSU banks feeling the pressure. We've got Union Bank, which is down 6.5%, Bank of Baroda down 3.5%, and Indian Bank down nearly 3% in trade.
Indeed, and well, for Union Bank, of course, we also need to take into account that it's ex-dividend from today, so that's 5 rupees on that as well. But since we are on the subject of banks, a lot of them actually reported their business updates for the quarter. Ananya is here to summarize all of those details for us. Ananya.
So, well, yes, good day for NBFC stocks, but PSU banks are seeing some pressure today. Now, let me first start with Bajaj Finance. Very strong numbers coming in the start of FY27. AUM growing 24% year on year and 7.2% sequentially towards the upper end of its 20 to 24% guidance, alongside record customer additions and a 20% rise in new loans. Now, coming to Bajaj Housing Finance, which is also surging today, also reported a steady update with AUM growing 24% and disbursements rising 33%. Now, brokerages like JP Morgan upgraded the stock to neutral from underweight with a target price of 85, but noted that the stock continues to trade at a premium valuation compared to the peers like PNB Housing Finance and LIC Housing Finance. So, due to this, PNB Housing Finance remains a top pick for them. Now, coming to Mahindra and Mahindra Financial Services, which is also rallying in the trade today, they delivered a healthy set of numbers for Q1 with disbursements rising 21% and business assets growing 12%. Now, collection efficiency, though moderated to 95% from 98% in the March quarter, though it remained stable when we see year on year. Now, while stage 2 and stage 3 asset quality also improved. Now, on the other hand, Union Bank reported healthy advance growth of 12.5% and stable CASA ratio. But weak deposit growth and a sequential decline in deposits appear to be weighing on the stock today. You need to also take in account the ex-dividend thing. So, yes, that's a...
All right. All right, Ananya, thank you so much for taking us through those details. Now, India has allowed 4 Chinese-linked power equipment firms to bid for government projects. Vinny Motiwala joins us now with all of those updates. Vinny?
Hi, afternoon. So, yes, when you talk about, the latest update that has come in, and this is obviously we're picking up from brokerages, the Ministry of Finance memo that has been come in. The government has given exemptions under the public procurement order, and the Ministry of Finance has said that they are granting a 2-year exemption for 4 following Chinese companies. One is Nifty Energy India. That was already there. We'd spoken about this before as well. Since then, we're seeing these news flows coming in. So yes, that is one. Then we have Nanjing Electric, we have New Northeast Electric Company, as well as Taika Electric Company, which are the 4 companies which are getting this exemption for a time period of 2 years. There's a condition that comes in that there should be 50% minimum made in India, locally made products are included in the manufacturing of this as well. Now, what is the view coming in from brokerages? PL, the view from PL Capital is that these companies were previously catering to large private developers. So the exemption could increase competitive intensity in the small and medium transformer segment companies. That could see a short and medium term impact for these smaller players. The exemption is likely to cover critical transmission equipment, including bushing, insulators, circuit breakers, power transformers, and GIS switch gears as well. They said that the exemption is not expected for the HVDC side. So HVDC projects, we're not expecting any impact coming in here, and a lot of Indian transformer companies have been focusing on the HVDC side of the projects. A lot of tenders are coming in on that front as well. So that is not expected to see an impact. Competitive landscape surely is something that will see an increase, and overall impact will come in slight bit in the terms of the sentiment also for these T&D players in terms of pricing. That's the view from PL Capital. Also, IIFL, they said that this move was something that they were not expecting. We knew about TBEA getting this exemption, but these other companies are something that was not as expected as one was that has come in terms of the memo. Domestic pricing is at its peak. Chinese competition obviously flagging, and competition increase from these Chinese players as well. And they said the direct impact would come in for transformer pricing, largely for standalone transformers. And they highlight some of the companies like Hitachi could see a bit of an impact as well.
A very forgettable day for a lot of these companies. Vinny, thank you for that. GE Vernova is now down 10% as we speak. Hitachi Energy is now down 9. CG Power is down 7. Thermax is down 6. Siemens is down 6. And it's a kind of one-way traffic on the way down for a lot of these companies. Of course, that they've surged as well, so in proportion to that.
Absolutely. And leverage on Dalal Street is climbing. The MTF book crossed 1.35 lakh crore rupees in June. Harmaz, you have all of that data, so take us through it.
Now, the fact that the MTF book continues to grow despite the markets being choppy is one highlight of the month of June. But the other highlight, of course, we'll get to that in just a bit. But the headline number is that the overall MTF book has grown 7% from the last month and is grown up to our 1.35 lakh crore rupees. Take a look at the top 5 names on the MTF book, and there have been changes. Now, HDFC Bank, which was the top most leveraged on the MTF book at the end of May, has slipped down 2 positions because its leveraged positions have been liquidated by 20%, and that's now gone down to number 3. The top of the pile is Reliance Industries, and after the slew of announcements that took place, be it with regards to the Jio IPO, the AGM, and so on and so forth, that is now having an exposure of around 2200 crore on the MTF book. Another 41% month-on-month jump, which was something similar that we saw in the month of May as well. And of course, IT, the sell-off that you saw in the month of June, Infosys, TCS. Infosys has now also crossed that 2,000 crore rupee mark on the leverage front, 57% higher on a month-on-month basis, and TCS too has seen a growth of around 20%. Now take a look at the names which have seen an increase in the biggest increase. Persistent Systems, in fact, in the last month had seen its positions go down. Here, it has now gone up by 150% on a month-on-month basis, so from around 220 odd crore to 550 crore. Vedanta has had a similar move from around 500 crore to over 900 crore rupees. BSE, Tata Steel, Tata Motors also completing that list. But the actual highlight is the fact that the headline number, the exposure that has come down for a lot of these companies, and all of these names in that list are Nifty names. But before I get to that, look at the silver ETF as well. At one point earlier this year, when the silver prices were at their peak, the silver ETF was among the most leveraged on the MTF book. But after prices started to come down, they started to see some liquidation as well, and from around 700 crore rupees, it has now gone up around 30% in the month of June to around 900 crore rupees. Not that the prices have stopped declining in any form. Now take a look at this plate. All 5 names in this list where the exposure has gone down are Nifty names. SBI leading the pack at last month, it was among the top 3. It has now gone down to sub 1,000 crore. Same is the trend playing out with Indigo, for Shriram Finance, Trent as well. So all of these names have gone down by around 35 to 40%. So the broad trend here is that the MTF book has continued to grow, but the Nifty names have seen a significant unwinding in the month of June, HDFC Bank included.
Absolutely. And moving on, crude prices have eased from the Iran war high of $120 a barrel, and India's crude oil basket has now dipped to below $70 compared to the conflict high of over $110 a barrel. Union Petroleum Minister Hardeep Puri, however, has ruled out a fuel price cut for now. During an interaction with the media in Delhi, he said there's a case for a cut only if lower crude prices hold for the next 2 to 3 months. Take a look.
The crude the petrol and diesel that you buy at the dispensing station today, that crude would have been obtained 2 months ago. Because you float a tender, you buy the crude. So it's bought either at the price, it has to be bought at the price available then. So 2 months ago, or whatever they represented, 6 weeks or 3 months or I don't know, then the price was not this price, it was higher price. The cost of insurance freight was also that price. So today that crude is being sold. Customers, it wasn't raised, but the oil marketing companies were losing. Now, if the question is, when will you bring prices down? Well, as I said, now they are still carrying the stock which was bought at a higher price with higher insurance, higher freight rates. If this persists next 2-3 months, then that would be a legitimate question. But, that's hypothetical. I won't get into that case.
Now, reports say that the OPEC, along with oil-producing countries, will likely agree to a further hike in their output targets from August when they meet on Sunday. CNBC's Dan Murphy is now here with more details. Dan.
Reports indicate 7 key producers, of course, led by Saudi Arabia and Russia, are locked in to rubber stamp what will be an August production increase of 188,000 barrels per day. That mirrors the exact supply boost that we saw in June and July as this alliance continues to roll back those voluntary cuts. This will also be the 5th largely symbolic increase that we've seen since the start of the Iran war. The real wildcard, though, remains the critical global choke point, which is the Strait of Hormuz. And despite this MOU between Washington and Tehran, maritime traffic has been really a total roller coaster here. Ship tracking numbers show 34 vessels crossed the waterway on July 1st. And right now, we're still a long way off the post-MOU peak of about 70 crossings recorded back on June 24th. And of course, well below the pre-war peacetime baseline of about 120 ships per day. We are keeping one very close eye on the UAE, where crude and condensate exports rocketed to a record high last month. That massive push, of course, follows Abu Dhabi's exit from OPEC on May 1st as it sprints now to monetize its massive capacity investments. Attention also now on how fast Gulf and OPEC producers can recover here with production levels tumbling during the peak of this conflict. Now, among them is Iraq, and this is going to be very closely watched. Iraq really feeling the fiscal squeeze here. The country's oil ministry aggressively lobbying OPEC to raise its production quota to help dig the country out of its wartime economic malaise. Baghdad also pushing back against those rumors, though, officially denying it and saying that it has no immediate plans to follow the UAE out of the OPEC door.
All right, Dan, thank you so much for taking us through those details. But on that note, it is time for us to head into a short break. More news and updates follow on the other side. Stay tuned.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
We are over, Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
जिंदल साथी सील है तो असली स्टेनलेस स्टील है।
तो जब भी आप स्टेनलेस स्टील पाइप्स एंड ट्यूब्स खरीदें, जिंदल साथी सील जरूर चेक करें।
जिंदल स्टेनलेस, इंडियाज लीडिंग प्रोड्यूसर ऑफ स्टेनलेस स्टील।
Welcome back. You're still with us on Business Lunch. U.S. job growth slowed sharply in June and payroll gains for the prior 2 months were revised lower, pointing to a cooling labor market and prompting financial markets to dial back expectations for a near-term interest rate hike from the Federal Reserve. CNBC's Steve Leesman joins us now with all of those updates.
A mixed payroll report that raises some new questions about both the strength and the weakness of the U.S. job market. Non-farm payrolls coming in at 57,000 against an estimate of 115,000, and that compares to the prior month of 129,000, which was revised down by 43,000. The unemployment rate falling to 4.2% from 4.3%, somewhat unexpectedly, while hourly wages coming in exactly as estimated at 0.3%, leading to a year-over-year gain of modest 3.5%. Why did the unemployment rate fall? Well, because the labor force fell by 720,000 as more people dropped out. Fewer people were employed, according to the separate household survey. The unemployed declining as well, but the not in the labor force number surging by 832,000. There were jobs pretty much where we've seen jobs. Healthcare and social assistance up by 47,000. Private education up by 22,000. One good sign for the future could be in temporary help. Sometimes employers hire temporary help before they bring people on full-time, up by 9,000. But retail sinking by 8,000. And an unexpected decline in leisure and hospitality, down by 61,000. That was expected to surge in part because of the World Cup happening across North America and, of course, the United States. Accommodations were down 22, and restaurants and bars down as well. The Fed likely to take these numbers with a bit of a grain of salt, as there have been a continuing series of large upward and downward revisions. Stephen Stanley from Santander writing, quote, "Today's results may change the perception of Fed officials ever so slightly, but I would expect that most policymakers will continue to regard the labor market as stable and neither too hot nor too cold." Fed futures markets changed their view of what the Fed would do ever so slightly as well. What had been about a 70% probability of a rate hike in September fell down to 54%. So rate hikes are not for the next meeting and maybe not for the meeting after that, solidifying for now that the new Warsh Fed is like the old Powell Fed, on hold.
Now on to a CNBC exclusive with the US President Donald Trump. CNBC's Joe Kernan sat down with the US President to discuss a whole host of topics ranging from the Federal Reserve to Trump's business dealings. Kernan asked the President about the latest jobs report and the newly appointed Fed Chair Kevin Warsh, and asked him whether the stars are aligned for Warsh to cut rates. This is what he had to say.
Well, he's got a board that maybe is a little bit hostile, and, unfortunately. And maybe a board that wants to do the wrong thing, so I don't know. He's a great guy and a great pro, and I know where he'd like to be, but he has to do what he has to do. I really think that I would love to be able to get back. You know, in the old days, probably maybe before you started thinking about these things, but if you go back 20 or 25 years, when you announced great numbers, the stock market went up. When you announced bad numbers, the stock market would go down. Today, it's the opposite. When you announce good numbers, the stock market goes down, sometimes really way down, depending on how good. The better they are, the more, because they have this phobia, they have this horrible derangement syndrome about inflation. And growth can be good for inflation, not just bad for inflation. And it's a shame. Anytime numbers are announced that are not so good, I wish they could flip it the old way, that when you announce great numbers, because otherwise it's almost like they want to kill strength. They want to kill success. You announce good numbers. I want to, like, you have a couple of countries. India is one, doing very well, but it's at 7-8%. Others, take a look at Japan's numbers. I mean, they're doing very well. She's very good. She's doing a good job, a friend of mine, but they're allowed to go up. We're not allowed to go up. If we go up, they want to kill it. There's no reason we should stop at 4%. We should be at 12% and 13% GDP. And I hate what happens where in the old days we would be, that's how we built the country. Now you announce positive things and they want to bring it down by raising interest rates. And it shouldn't be that way. It should go back to the way it was.
You mentioned that Warsh might not, the chairman has other people on the Fed, obviously. He still has Lisa Cook on the Fed. The Supreme Court ruled on Monday. I'm not really sure exactly whether it was on the merits or whether it was procedure, but I think you said that
procedure.
You're going to take the appropriate action when the time comes. What could you do to get rid of?
Get her off.
How would you do it at this point?
By winning the case. They sent it back, not based on the merits, they sent it back on process and procedure. So we'll start the process and we'll do perfect process and perfect procedure.
On that note, it's time for another short break. News and updates follow on the other side. Stay tuned.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
जिंदल साथी सील है तो असली स्टेनलेस स्टील है।
तो जब भी आप स्टेनलेस स्टील पाइप्स एंड ट्यूब्स खरीदें, जिंदल साथी सील जरूर चेक करें।
जिंदल स्टेनलेस, इंडियाज लीडिंग प्रोड्यूसर ऑफ स्टेनलेस स्टील।
To be in
Welcome back to Business Lunch. The Indian government has asked Meta to pause the rollout of WhatsApp's new username feature in India, with the IT ministry seeking a detailed response from the company, explaining the details and the motive behind this feature. This after the centre flagged concerns around impersonation, digital fraud and traceability, warning that usernames could be misused to impersonate banks, government agencies or public figures without revealing phone numbers. The government is also reviewing similar features on Telegram and Signal. Listen in to what S. Krishnan, the Secretary for the Ministry of Electronics and IT, had to say regarding this.
We have taken up the issue of using usernames because there is a serious possibility of impersonation, and there is the kind of encouragement that it provides, or the facility it provides for committing more cybercrimes, which is a very serious issue. This is another dimension of the way that cybercrimes can be committed, which is the reason why we have directed WhatsApp to explain why they have this feature, and likewise we have similarly sought explanations from others.
Now on to updates from West Asia. Iran's Joint Military Command has issued a warning to vessels transiting the Strait of Hormuz to follow designated paths or encounter a forceful response. Now, Iranian officials also said that any U.S. interference in the Strait of Hormuz would trigger a decisive and rapid response, adding that the continued presence of the U.S. air assets across the waterway endangered regional security. Meanwhile, more than 20 million people are expected in Tehran for the funeral of their former Supreme Leader Ali Khamenei, who was killed at the start of the US-Israel war on Iran.
It was an eventful night of action in the FIFA World Cup round of 32 fixtures. The Portugal versus Croatia clash was a thriller, keeping fans on the edge of their seats till the final whistle in a match which saw 4 goals ruled out by VAR intervention. Now, Croatia took the lead with a goal by Ivan Perisic. Ronaldo equalized via penalty in the second half to draw Portugal level. Substitute Gonçalo Ramos scored to give Portugal the lead, and there was heartbreak for Croatia as a last-minute equalizer was ruled out for offside. Meanwhile, Spain cruised past Austria 3-0 to book their place in the round of 16, where they will take on Portugal. In the day's third match, Switzerland produced a clinical display to defeat Algeria 2-0, securing their spot in the round of 16.
And with that, we take your leave on this edition of Business Lunch. The markets have cooled off ever so slightly from the highs of the day, and you can see the culprit for that as well on top of us, the Nifty Bank. We take your leave from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. It's a Friday afternoon, so we all are quite happy about that. But of course, the markets too are in a Friday mode. We have come up slightly from the highs of the day. The midcaps and banks are underperforming. The Nifty, though, continues to stay higher above that 24,300 mark. But yes, there is some selling pressure from the top. Hey, Vivek.
Right. Good afternoon. And nothing exemplifies the selling pressure more than the capital goods stocks that are witnessing quite a bit of a meltdown across the space, especially transformer companies. And the IT pack has seen a bit of a bounce back. But we have a whole host of stocks to cover and some important developments too that we will be tracking. So let's start off with the top headlines. Stocks see a broad-based rally with advances significantly outnumbering declines. IT, healthcare and realty are the big gainers, while PSU banks are the weak spot. Mid-caps lag.
Brokerages flag threat from a likely recent easing of restrictions on supply of transformers by 4 Chinese players. The move set to be driven by the need to rein in prices and enhance supply takes a toll on the stock of peers.
Angel One trades higher as the company's funding book continues to scale new highs while trading activity rebounds. Client addition trend also stabilizes.
Shares of Bajaj Housing Finance trade higher as the company reports a 24% uptick in its assets under management, while gross disbursements and loan assets also see a double-digit growth. JP Morgan upgrades the stock to neutral from underperform.
A large block deal sees nearly 2.5% equity worth over 1,700 crore change hands at 601 rupees a share in Policy Bazaar. Private equity investor Temasek is likely to have sold the stock. The stock slips 7%.
Okay, these are the top headlines that we are tracking. Some of them we'll discuss in greater detail. For the markets, as I indicated, the Nifty has come off from the highs of the day. Yes, we continue we have actually come below the 24,300 mark as well. So there is some selling pressure which is coming from the top, and Bank Nifty is a definite reason for that. So the Bank Nifty in the red, down around 116 points. IT and Pharma continue to stay higher, but we do have some selling pressure in the capital goods space, something that we'll discuss in greater detail. And we do have the mid caps as well, which are not doing so well. The small cap index, though, in the green for now, but absolutely flat with some positive bias. But this is our segment, Mid Cap Movers. We have Ria to take us through the mid caps that are moving around in trade. Ria.
Well, yes, starting off with the gainers first, we have Zensar Technologies performing well in today's trading session on the back of strong volumes too. Nearly 10 times the monthly average volumes traded in today's session, although the stock is down nearly 40% in the last 1 year. Aegis Vopak is next on the list with strong volumes yet again, nearly 8 times the monthly average volumes traded today. eClerx also seeing strong gains today. However, the stock is down nearly 37% on a year-to-date basis. Piramal Pharma also seeing strong gains today, as well as AW Agri, but this stock also an underperformer in the last 1 year, down nearly 25%. Also looking at some of the stocks which have hit their 52-week highs as well as their all-time highs today, we have Nuvama Wealth, Aurobindo Pharma, Anand Rathi Wealth, Aadhar Housing Finance, as well as AB Capital on that list. And on the flip side, looking at the losers in today's trading session, we have Apar Industries. Although this stock has been performing well on a year-to-date basis, it is up nearly 70%. Welspun Corporation also seeing gains of 80% in the last 2.5 months, but today taking a knock. Kirloskar Oil also taking a cut today, although this stock again is up 80% on a year-to-date basis. And also on the losers list today, we have RHI Magnesita as well as Tube Investments.
Well, thank you so much, Ria, for joining us and giving us a list of all the stocks in the broad end of the markets that are moving around. But it's a good time to welcome Hemen Kapadia from DR Choksi Finserv for a quick technical check on the market. Good afternoon, Hemen, and thank you so much for joining us. Well, you're actually seeing very volatile moves, a bit of a comeback as far as the IT pack is concerned. Where do you see the Nifty headed from here on?
Very good afternoon, Vivek. Thank you for having me on the show. It's always a pleasure. 24,150 was important, Vivek. We've sustained above that, sort of. But the next level was 24,344. Didn't expect it to be overcome at the first attempt. We've had a bullish gap today, which I believe will get covered up by the next time we speak, next Friday. So I believe a small cool off resistance at higher level, like you mentioned, is very much apparent. VIX is below 12, so that is a big fillip for bulls. Bank Nifty, like you guys mentioned, is under pressure. I think there's going to be some more decline coming in. We're at 27,815. Will be look like going down to 57,364. So pressure from banks. Nifty had resistances. Reliance hasn't done much. IT is on a bounce up from doldrums. It's maybe auto, pharma, and metal. So frankly speaking, not much. It's better to be stock specific than being index specific. So till we don't take out 24,344, Vivek, I think we'll maybe consolidate for a few trading sessions more.
Okay, all right. So what about individual names? So the markets have come off from the highs. So what kind of bets would you take?
Hi, Sonal. I think as far as individual stocks, one gets the feeling that we have, I have a buy call on IndusInd Bank. IndusInd Bank is on the verge of breaking out. The daily and the weekly oscillators have turned positive above the 55-week exponential moving average. Seems set to perform after a long period of not performing. So buy on IndusInd Bank at around 955, stop loss of 930, target of 1005. Second one is a buy call on SRF Sonal. It's breaking out from a symmetrical triangle. Looks good. It's on the verge of doing an upward bar reversal on the weekly chart also. One can buy SRF at 2690, stop loss 2630, target of 2810. Sonal.
Hey, man, we are not going to let you go without asking your views as far as the capital goods space is concerned. There's been a bit of news developments over here. Capital goods index, especially names like Hitachi Energy, or also Power India, BHEL, these are stocks under significant pressure. Even a CG Power. Do you track these names? Any view on them?
Well, yeah, not very closely, but if you look at all of these stocks, Vivek, I mean, they were off the charts. Hitachi Energy was like from 17,000 to 39,000. And more or less, if you go back in time, from 1920, it was 1,500. So you had a phenomenal, humongous bull run. Well, this was a event risk. There was a development, Chinese guys, but allowed. But frankly speaking, we needed a correction. It cannot go on like this forever. So the laws of gravity needed to catch up, and that's what's happening. I won't turn bearish, but yeah, this correction was needed, and I don't think it's going to end in a jiffy. We could take some more time on this, Vivek.
Okay, take that point. That's about the capital goods space. Thank you so much, Hemant, for joining us as always, and have a great weekend ahead. By the way, the fall continues for the markets. A couple of these names from the Nifty pack, which are falling from the highs of the day. HUL is one of them. So some of these consumption names not doing so well. We do have Hindalco, Axis Bank, Asian Paints, Reliance Industries. All these stocks which are leading to the selling pressure on the Nifty as we speak. Bank Nifty, of course, is one of the segments which are putting pressure from the highs of the day. We'll do one thing. We'll slip into a short break for now. When we come back, we'll get you more stock-specific action on the other side. Stay tuned for that.
Welcome back to Midcap Radar. Well, one particular stock that's standing out today on the back of news flow is Angel One. Angel One, Devyani, Q1 was a very volatile quarter as far as equity markets are concerned. How has Angel One performed?
Well, you know, June was a steady month for Angel One, in line with street expectations. Now, the funding book, that was a standout for the company, up 7.5% on a month-on-month basis, reaching new all-time highs for the second consecutive month. Now, the client acquisition was also steady, with client base seeing a 1% uptick month-on-month, with gross additions up 8% on a month-on-month basis after a declining trend that was seen over the last 4 months. Now, trading activity is where things get interesting. The average daily premium turnover was up 27.5% on a month-on-month basis. That was largely led by the commodities trading surge, but equity F&O premium, that actually saw a decline of around 10% on a month-on-month basis. Now, from a market share standpoint, it was a mixed set of numbers. Commodity share recovered, but the cash and equities derivative share, that softened on a month-on-month basis. Overall, though, it was a steady set of numbers coming in from the company, with funding book remaining the key positive, but the street will now watch out for a broader recovery in the trading activity from Angel One.
Thank you so much, Devyani, for joining us with all those details. Now, the sector of the day has to be the capital goods space. India has allowed 4 Chinese-linked power equipment firms to bid for government projects. Vinny is joining us with more details and what the street is making of this move. Vinny.
Hi, the street is not too excited about this as well, right? What you see coming in is the Ministry of Finance as a memo that's come in. Now, the government has given an exemption under the public procurement order. Now, what does this order say? That there is going to be a 2-year exemption for 4 of these Chinese companies. TBEA, we have spoken about this before. Then you have Nanjing Electric India. You have New Northeast Electric India Private Limited, as well as Taikai Electric India Private Limited. Now, these are 4 Chinese companies which have obviously subsidiaries here and which are mainly making transformers. So now this side of the business, what is the view coming in from brokerages? They're saying that these companies, these 4 Chinese companies previously were catering largely to private sector developers. Now, this exemption maybe obviously is going to be increasing some bit of a competition for these players, for transformer players, specifically the mid and small transformer players. They will see more of an impact coming in, and this is going to be an impact over the short to medium term for these mid and small transformers companies. Then you have the exemption that is likely to come in for critical transmission equipment, that is including bushings, insulators, circuit breakers, power transmission, as well as GIS, switch gears, as well as the exemption will not come in for HVDC players. That's a word that PL is highlighting. Now, HVDC, why is it important? Because in India, a lot of players are focusing on HVDC expansion as well. We have a lot of tenders that are coming in here. So that is not a worry point that comes in for Indian players. Yes, obviously competition is going to increase a bit, and there is going to be some bit of a negative sentiment impact coming in for these companies, but HVDC unlikely to see that impact. IIFL, what are they highlighting? They highlight that this move was something that they were not expecting. We had already seen TBEA get that exemption in February 2026, but that was for 1 year. Now this is an exemption for 2 years. The Chinese competition that's been flagged off in the last 6 months as well for transformer players. The direct impact on transformer pricing is what they're highlighting is likely, and standalone players will see a worse impact versus MNC players. So that is something that even IIFL is highlighting, and that's a word coming in from both the brokerages. But right now we're seeing a negative impact on all these stocks.
Absolutely right. We need a sentiment negative or sentiment dampener as far as the entire capital goods space is concerned, trading at high valuations. But it's a good time to slip into a short break. We'll get him on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. You're still tuned into Mid-Cap Radar. The market continues to trend lower. The mid-caps are underperforming. But we have to talk about our special segment, Mid-Cap Spotlight. PB Fintech is under pressure after a large block deal. Yash is bringing us all the details on this one. Yash.
Well, the second large block deal, as far as the company is concerned, within a period of 30 days, this time it was Temasek arm Macrochi Investments, which was the seller in today's block deal. About 1.19 crore shares changed hands. That is about 2.64% of equity. The size of the block of this changing of hands was about 19-16 crore rupees. And the average price for this block was about 1600 rupees per share. Remember, yesterday's closing was 1682 rupees per share. This is the second large block deal within a period of 30 days, as I said. Just on May 29th, Yashish Daya and Alok Bansal, the management people, had sold about 38 lakh shares for about 665 crore rupees. The price back then was 1751 rupees per share. Now, as far as the company itself is concerned, in terms of operations, there are two important key events lined up for PB Fintech. The first one is the launch of Bima Sugam. The IRDAI chairman very recently, just a couple of days ago, saying that he expects insurance products to go live on Bima Sugam by September end, so just about a month and a half. This next big event is the consultation paper on distribution regulations. IRDAI chairman, again, as a part of the same conference, saying that that draft consultation paper expected by July end. So, of course, two key important events lined up for the company. And today, the stock reacting to that large block which happened in the morning.
Absolutely right. Yash, large block deal, and post which the stock really hasn't recovered that much. But remember, a whole host of financial stocks are reacting to Q1 FY27 business updates. Let's go across to Ananya for more details.
So, well, yes, NBFC stocks are buzzing in trade today, while PSU banks are facing some bit of pressure. Now, let me first start with Bajaj Finance. Now, they reported another healthy quarter with AUM rising 24% year-on-year and 7.2% sequentially to the higher end of its FY27 guidance, supported by record customer additions and a 20% increase in new loans. Now, let's get back to Bajaj Housing Finance also delivered a steady operational update with AUM up 24% and disbursements growing 33%. Now, brokerages like JP Morgan upgraded the stock to neutral from underweight with a target price of 85, but highlighted the stock is trading at a premium valuation when compared to peers like PNB Housing Finance and LIC Housing Finance. So, PNB Housing Finance, for these reasons, remains the top pick for JP Morgan. Now, coming to Mahindra and Mahindra Financial Services, the stock is also surging today in the trade post the strong business update by them, with disbursements growing 21% and business assets up 12%. Collection efficiency eased to 95% from 98% in the March quarter. Now, although it remains stable year on year, if you see, now while stage 2 and stage 3 asset quality also improved. Now, but meanwhile, Union Bank reported healthy advances growth, if you see, of 12.5%, but softer deposit growth and a sequential decline in deposits weighed on sentiment. And the stock is also trading ex-dividend today, so you have to keep that in mind, which is also adding to the pressure on the share price.
Okay, Ananya, thank you so much for joining us. So those are some financial updates. Let's move on now and talk about the big call coming in today. CLSA's Lawrence Belanco says, while the Nifty itself remains trapped within a broad trading range and lacks a clear directional catalyst, underlying market breadth remains constructive. The impending breakout on the Nifty Mid-Cap 100 suggests risk appetite is trending outside the large-cap universe. Shriram Finance and Lodha Developers stand out as technically attractive opportunities, both having recently completed significant basing and consolidation pattern breakouts. So let me take up Lodha from that. Lodha is the one which is in focus. And now do remember, there has been a lot that is happening with this particular company in last couple of trading sessions. The first one, of course, is that big block deal that took place last week, where the promoter entity sold around 1.99% stake worth 1864 crore rupees, which was sold to Fidelity managed funds. And Lodha, if we talk about the company, what is expected going forward, we do have Jefferies Q1 updates where pre-sales are expected to increase by 5 to 10% at 4,800 to 5,000 crore rupees. Now, remember, the company has a guidance of FY27 at 24,000 crore rupees. So the Q1 number looks like it will miss that guidance because it is expecting a 5 to 10% growth versus an expectation or a guidance of 17% growth in FY27. If we talk about Lodha's performance since listing in April 2021, it delivered a 28% pre-sales CAGR since then. Leverage, which was a big problem during listing, has come down substantially as well from 5 times to 0.23 times. And company also plans to increase their rental income to 3,000 crore rupees by FY32, which currently stands at 300 crore rupees. And data center is going to be a big business in that. Company, remember, missed their FY26 sales guidance because of the West Asia crisis. Now let's get to valuations because Lodha is trading at a discount to its 5-year average at 3.3 times price to book versus 4.7 times on a 5-year average basis. DLF is largely at the same level. We do have Godrej Properties as well, which is trading at a discount. We have seen a big fall in that stock as well. Oberoi Realty is largely at similar levels, but Prestige Estates is trading at a premium to that particular average. For Lodha in particular, the stock is off around 28% from its 52-week high. It has done well this week, up 11%, but has been absolutely flat so far. And CLSA now thinks that technically the stock is looking really strong. So that's why they are quite bullish on Lodha. But CLSA is also bullish on Shriram Finance. Ananya, tell us more.
So, well, yes, Shriram Finance, like Sonal mentioned, is one of the standard performers when it comes to NBFC space, or should I say the strongest performers. If you see, the stock has gained over 18% in the last 1 month, 7% in the last 6 months, and delivered a stellar one-year return of 58% and also crossed the 1,000 mark. Now, the move has been backed by strong conviction buying with daily delivery standing at around 71%. Now, from a business perspective, the outlook remains encouraging. When you talk about the fundamentals, the company has reiterated its FY27 AUM growth guidance of around 18% while aiming to maintain NIMs at around 8.5% as lower funding costs begin to flow through. Now, management also expects asset quality and credit costs to remain under control. Now, brokerages continue to remain constructive on the company. The broader street expects 17 to 20% AUM growth supported by healthy demand in vehicle finance, continued traction in the gold loan portfolio and improving operating leverage with ROA projected at 3.7% to 3.9% and ROE at 13 to 14% for FY27. Now, the rise in gold prices today could also provide an additional boost to the company's gold loan business. So, in terms of valuation also, the stock is currently trading at around 3 times book value. Motilal Oswal has a buy rating with a target price of 1175, valuing the stock at 1.9 times FY27 book and 1.7 times FY28 book, while the broader street remains positive with a target price ranging from 1200 to 1250, valuing at around 2.2 times FY27 book. So overall, Shriram Finance continues to stand out in this space.
Well, thank you so much, Ananya, for joining us, giving us all of the updates regarding Shriram Finance. Well, a couple of stocks on your radar. Waaree Energy, that particular name, has moved to the day's lowest point. The other set of stocks that have seen quite a bit of selling pressure are the PSU names. SBI dragging the market lower almost 1.4% lower. And Union Bank, after the weak sequential deposit growth, is something that has seen almost a 6% downtick. In terms of the capital goods names, CG Power stands out over there, over a 6% downtick. And Hitachi Energy, that is Power India, that is the stock that's clearly taking it on the chin on account of the heightened likely competition that we could be seeing in from Chinese players. On the back of that, it's all the time we have on this edition of Mid Cap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 80 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Arundhati Ramanan as well. Arundhati, good afternoon. We've come off from the day's highest point, but nonetheless still holding on to the green. We're still holding on to 24,280 levels, so near the 24,300 mark. But yes, look at it. You know, in the last 1 hour, 30 odd minutes, we could say we've seen that further decline coming in from the day's highest point, because we were trading comfortably about the 24,350 levels. So slight bit of a decline on that front. When you look at the mid cap, look at Nifty mid cap also. That has also come off from the highs. So overall, we're seeing a bit of the decline coming in the market as well. Nifty mid cap is now trading at the day's lowest point. So there's an underperformance again coming in from the broader end of the market. Nifty mid cap down 0.2%. We're seeing small cap also seeing a bit of a decline versus when we started off the day as well. So broader end of the market, nothing exciting happened there. Banks also too seen a bit of a decline out of the in trade right now.
Absolutely. We've started this July month on a strong note. The market's coming off those highs, as you pointed out. What's participating in this rally? It's those IT names, right? They've been doing well. 2 days of gains. You know, that big win from HCLTech boosting other stocks. So all of those IT names doing well in trade today. We've got those pharma names and healthcare names also rallying in trade. Those have been participating in the current rally that's happening in the markets. But what's not participating are those banks, and PSU banks are the top losing index. We've got Union Bank, we've got Bank of Baroda, all of them falling in trade as we speak today. So that's how the markets are shaping up. But let's go across to our guest to answer all of your stock queries. Joining us now are Vaishali Parekh, the Vice President Technical Research at Prabhudas Leeladhar, and Shaina Mukaddam, independent market expert. Ladies, thank you so much for taking time out and being here on Your Stocks to answer all of our guest queries. The first query that's coming in, Prashant is writing to us from Tamil Nadu. He holds 650 shares of NHPC at 99 rupees. The stock is currently at 80. He is making a loss. He wants to know whether to hold, average or exit. So Shaina, let me come to you first. What are the fundamentals looking like? Should he continue to hold the stock currently, or do you think averaging would be a good play right now?
So good afternoon, ladies. What I would suggest is that you hold as of now. Very recently in June, the government, sold approximately 6-7% of equity. So they have brought down the overall equity to now about 61%. That overhang has been lifted to a bit. But at the same time, I wouldn't suggest adding anything as of now. Let the stock settle. Because if you see the numbers, they have been very subdued. You see last 2 years. And the stock also has has corrected. I think at current levels, one can continue to hold basically because the balance sheet is actually, highly leveraged. So I wouldn't say add as of now. Let everything settle down, and then maybe you can relook at it, because power demand overall remains good, but not, it's not reflected in the numbers as of now.
Okay, that's a word on the fundamentals. On the technicals, what would you suggest for NHPC? Hold, average or exit this one, Vaishali?
Hi, good afternoon, all of you. I think NHPC right now currently is definitely consolidating. We are not seeing much of a movement. But when I'm looking at the longer term time period, I think 75 level is the one good appropriate level to average out the stock. And once if we see the stock moving above 82, it's ready to go towards 90. So I guess wait for a dip to add more. But if you're holding and want to continue, wait for 82 to be crossed, and you'll see further strength from there on.
Okay, let's keep an eye on those levels over there for NHPC. Let's move on to the next query for today. We have Deepak, who's writing to us from Pune. He's holding 200 shares of Infosys. Price is 2,035 rupees. Obviously making a loss on this one. He's a long-term investor. Wants to know whether to hold or sell. Shaina, that's the word that comes in for IT, right? And we've been talking about it while we see a couple of days of green, but then you've seen such a sharp fall already coming in for IT players, and especially these large IT companies. What should you do with this one? You know, does it merit holding? Because they've lost half of their capital that they've invested.
And actually that aligns with how the overall IT has performed. But I think there is some bit of sentiment coming back and some small buying coming back into IT as the overall sector. And Infosys, the valuations are very attractive, So having actually made such a big loss, I don't suggest selling at current levels. You could hold, see, FY28 valuations, if you look at it on a EV by beta also is pretty cheap. Even on a P basis, it's very cheap actually as of now. It's very attractive valuations. And while AI and that implementation globally could have some impact on the growth, I hope that the numbers that will come out on 23rd of June will give us some sort of clarity as to whether they will maintain their guidance. So as of now, I would suggest hold, watch on 23rd what the management says, and then let's take a call.
All right, so hold for now, and then we have to watch out what the management says to take a call. Vaishali, there's been a lot of volatility in these IT names. So what do you make? Should the investor continue to stay invested in Infosys at this point or sell?
Definitely not a sell because it's deeply corrected and deeply oversold. So in fact, whole of IT pack now shows some stability at these levels. So I would say just not in a hurry, but accumulation and adding on from every dip from here on would get you the better rate of your purchase. And when the time gets good for the IT sector, maybe you will get some good returns also. So not in a hurry, definitely not an exit at these levels, but perhaps start adding more at every dip, because I think the downside, if at all there is from here on, is very limited.
All right, so the downside from here on is very limited. The next question is coming in from Shiva Kumar, who writes to us from Coimbatore. He holds 10,000 shares of Z Entertainment at 118 rupees. He is making a loss. The stock is currently trading at 105. He wants to know whether to hold or sell at current levels. So Shaina, let me come to you. How are the fundamentals looking for this stock? Should he continue to hold at these levels?
Actually, it makes no sense, because if you see when the company has made a loss, they're planning to raise some funds. Fundraising is on the cards. So we do not know at what level that they will be able to raise funds and where the funds will be utilized. Overall valuation is not too expensive, but they made a loss in the last quarter, So I would say that we do not know how the numbers will pan out. They have got some good, platform just as Z5, but at the same time, I would say it's a very high risk stock. So it is better to switch in such markets into some better quality, which will give you better returns. There's so many sectors that have now started doing better. I think it's better to switch.
Okay, better to switch. That's a word coming in for Z on the fundamentals, on the technicals. Vaishali, what would your suggestion be?
Well, technicals, it is showing some trend, but I would say take this as a trading strategy. Take 100 or 98 as your stop loss and keep a range of 98 as support and 120 as your target for now. If we see the stock moving above 120, we can have a relook and maybe we can then look for higher targets of 145, 150. So definitely a trading bet for now with strict stop losses.
Okay, keep those stop losses in place also, at least even on the technical front. But let's move on to the next query for today. We have this is a investment query that is coming in from Rajeshwari, who's writing to us from Bangalore. She wants to know if she can invest in Sagility for the next 2 to 3 years. Fundamentally, Sagility, how is it looking like? Is it a good bet to look at right now? Shaina?
Yeah, so see, if you see the last couple of quarters, Bearings has brought down, which is a major shareholder, has brought down the equity to about 50%. Now we've seen this selling actually reflected in the overall stock price, which has corrected. Now after this strong correction, very steep corrections, the stock is starting, I would say, to start look reasonably valued. Still, it is about at 20 times. If you look at FY28 EV by EBITDA, I wouldn't say it is cheap. At the same time, of course, it's got a unique business model catering to the pharmaceutical sector in the US, where it gives IT-enabled services to both hospitals as well as other insurers, etc. So the business model is great. Promoter is stable, which is Bearings. At the same time, I would say because valuations are slightly on the higher side still, I would recommend you can start buying, but buy it in a staggered fashion over the next 6 to 8 months.
All right, so start buying, but buy in a staggered fashion. Vaishali, what's your view on Sagility? What are the technicals telling you from a 2 to 3 year target? Is it a good time to buy?
I would say so, because technically, if I look at it, the stock has corrected right from 58, 60 levels. And from there on, it made a low of 38. And then once again, a long consolidation at 40 levels. So I think this is right now in a good support formation. So I would suggest one can buy at this level, because I think once the stock shows strength above 44, it's back on track and you'll get higher returns. So for the long-term perspective, I don't think there's much to lose. Can start buying.
Okay.
All right. The next query is coming in from Ram Iyer, who's writing to us from Mumbai. He holds 2,700 shares of Apollo Microsystems at 211 rupees. He is making a profit on it. The stock is now at 453. And he wants to know if he should hold or book profits at these levels. Shaina, what are the fundamentals telling you? Should he book his profits now? He's making good profit on the stock right now.
See, I bought it at similar levels just a couple of months back, few months, 3-4 months back, and the stock has doubled. Now, if you look at it, personally, I would not sell, I would hold. Having said that, let me give you two negatives. One is that the stock, after the steep run-up, has become pretty expensive. If you look at it on a EV by EBITDA basis for FY28, it is 30 times. And if you look at it on the pledge, the promoter holding, the pledge is pretty high. So they have slightly brought it down, but I would see that also as an additional risk. Having said that, I would suggest, at least personally, I continue to hold, and I would hold because if you're a long-term investor, it is a very fast-growing defense company, and in a very niche segment, doing pretty well. It is a small cap. Hopefully, it will become a large cap within a couple of years. You hold it because also the recent acquisition that they made of IDL, I think that is also giving them an additional Ideal Explosives. It's giving them an additional line of business, expanding the overall product portfolio. So it is expensive. If the investor wants to take some money off the table, little bit of profit booking, yes, but otherwise continue to hold for the long term.
Okay, continue to hold for the long term. Little bit profit booking is fine. On the technical front also, would you suggest a little bit of profit booking maybe right now and hold for the long term, Vaishali?
Well, I do concur with Shaina on this, because one-way rally, a steep upward move. So I would say if you still want to hold and maximize your profit, keep a trailing stop loss of 420, because now the near-term projected target we are looking at is 480 to 500. So we are not not much of an upside is left. So I would suggest keep booking profit once you see a higher move getting in, and again get into the stock at lower levels for a long-term perspective.
Okay. That's the word on Apollo Microsystems. Next one and next query for today. We have this coming in from G. Krishnamurthy, writing to us from Chennai, holding 286 shares of ITC. Price is 455 rupees per share. They're making a loss on this one. What should they do? Hold or book out their losses? Shaina, what's the word on ITC? What should they be doing with this one now?
Yeah, so if you make good money in one stock, you lose in the other, right? So ITC has been an underperformer. If you look at it, post the demerger of the hotel business. So shorter term, it's been an underperformer. But if you see the numbers, it is sort of stabilizing. If you look at it on a comparative basis, last quarter, they did something like a 6% growth in EBITDA. And I would say cigarette business was affected, the profits, because of the high taxation. Also will affect this current quarter. But still, I would say as an investor, continue to hold for the longer term, though he's making losses. Because if you look at valuations, it is pretty cheap, if you compare it both with FMCG stocks as well as in the overall market. So I would say continue to hold for that if you're a long term.
All right, Shaina and Vaishali, thank you so much for joining us today and answering all of our stock queries. But on that note, it is time for us to head into a quick break. On the other side, Aditya Mongia of Kotak Institutional Equities will connect with us to talk about transformer stocks as the government relaxes procurement rules for select Chinese equipment suppliers. Stay tuned for that.
हे, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
जिंदल साथी सील है तो असली स्टेनलेस स्टील है।
तो जब भी आप स्टेनलेस स्टील पाइप्स एंड ट्यूब्स खरीदें, जिंदल साथी सील जरूर चेक करें।
जिंदल स्टेनलेस, इंडियाज लीडिंग प्रोड्यूसर ऑफ स्टेनलेस स्टील।
Prolonged.
Welcome back to your stocks on CNBC TV 18. We have those power equipment players that are under pressure today. And why is that coming? Because we are seeing that the government has actually given an order that has come in to allow Chinese power equipment companies with manufacturing in India to participate in PSU orders. There are 4 companies who have gotten this exemption. This exemption for is a time period is for 2 years. Now, 4 companies are TBEA Energy India. We have Nanjing Electric India, New Northeast Electric India, as well as Taikai Electric India Private Limited. These 4 companies from China have gotten an exemption. They have those plants and subsidiaries in India. But to understand more on this, what it means for our power equipment companies in the country, where are they headed as well? Aditya Mungia, analyst at Kotak Institutional Equities, joins us right now. Aditya, good afternoon. Thank you so much for joining us on the show. This order has come in since the last 6 months also. We've been on and off talking about this. First, we had TBEA that came in. Now, these 3 additional players, what does it mean for our Indian transformer manufacturers? Is it a big threat, or is this something that is already priced in and we will not see much of an impact?
Thanks, Winnie, for having me on the show. On this specific order, you're right that there's been a build-up to things that have happened in this space. If I was to just focusing on the order that is being discussed today, it came out somewhere in the last week of June. It focuses on these 4 companies and only on their spare capacities because it gives a 2-year limitation to them participating in PSU tenders. Our sense is that this means limited things for the domestic ecosystem as such. And just to give you a context, we anticipate more than a 1 lakh crore kind of annual ordering or execution to happen in the T&D space. Against that, even if you add up the spare capacities available of the companies under question, it may just be a mid-single digit number. And again, these capacities are being used in some form or the other today itself.
Okay.
So that's the extent that I would want to kind of suggest from a mathematical perspective, a modest impact for the sector as a whole.
Okay, modest impact for the sector. So as of now, you're saying that these companies do not even have the additional capacity that is required, right? Or enough to lead to a higher competition or decline for Indian players.
Yes, and they've not been investing in adding capacities as well. So just for instance, a TBEA would have a top line of about 1,000 crores, which is today booked up for some time. And against that, you have a 1 lakh crore kind of investment that is required in the sector, or revenues that are required in the sector, execution. Now, this is the largest of the 4 companies that we can talk about over here. The other companies are even smaller than this one. Some of them have a top line at the peak of it, which was in the tens of crores of revenues. Yeah.
Okay, Aditya, this is only transformers, or are there some other forms also of parts which are included as well, where we are facing some supply issues currently?
So that's true. It covers, so specifically it covers transformers, reactors, even the GIS side of things. And some of these companies actually work at the higher end of the KV range over here. So it does cover aspects wherein there is a capacity crunch that the country is facing. Does it become relevant for the HVDC ecosystem? Maybe somewhat, but yes, as a whole, the critical parts of where there's supply capacity deficit, there would be some benefit that comes in. And these capacities are already on ground, so that helps it out.
Okay, so where would we see the benefit coming in? And HVDC will not see the impact, right, of this?
Shouldn't be the case. The way the HVDC orders are structured, any which ways, most of them end up coming in through the private route. So these capacities could have bid for them earlier as well.
Okay. And Aditya, which specific names maybe will see an impact? Likely smaller players could see an impact of this, and which is maybe safe from this one as well. Today the reactions are quite sharp in all these stocks.
Yeah, that's true, and there may be other reasons also that are associated with the downtick happening in stocks. But for this event in specific, I don't think that the larger players in CG Power or even in Atlanta are going to be as impacted. It may be the smaller players that may be, but nothing on the mainstream side of things wherein one should be as much worried if one has to focus on only this event. And it seems that as part of the memorandum, it clearly says that
what a lot of for joining in. Going to this of Oxford always
what it's supposed to do. What it's supposed to do. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
We are over, Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे. गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा. आप अपना देख लो.
जिंदल साथी सील है तो असली स्टेनलेस स्टील है.
तो जब भी आप स्टेनलेस स्टील पाइप्स एंड ट्यूब्स खरीदें, जिंदल साथी सील जरूर चेक करें.
जिंदल स्टेनलेस, इंडियाज लीडिंग प्रोड्यूसर ऑफ स्टेनलेस स्टील.
days ago. Beyond market headlines. To understand the reasons for the day's movers and shakers. And Get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
This is the third day of the tech rotation, so Asia seems to be trading mixed.
Now they are still carrying the stock which was bought at a higher price with higher insurance, higher freight rates.
We should be at 12% and 13% GDP.
Dow, by the way, was up about 1% or so. It's made a new all-time high. 24,340, we're up about 0.6. The Nifty Bank is up 0.2.
So there is an impact that comes in for these transformer companies.
The market may reward more of the manufacturing segment because of the global disruptions.
Almost everyone is suffering from a similar situation like Delhi is.
And most importantly, this is 100% net new business for the company.
In the last 2 days that Reema has been on the show, the IT index is staging a very sharp rebound and is contributing to the Nifty moves today.
Now it kicked off FY27 with AUM growth of 24% year-on-year.
Much below what the street was anticipating this time around.
Markets too are in a Friday mode. We have come up slightly from the highs of the day. The mid-caps and banks are underperforming.
Well, that is the day so far. It's 90 points, which means that I think gains are, we're off the highs by quite a bit, but it's still 24,270 and a pretty respectable. I mean, if you go home with a 100-point gain, it's going to be just under 1% for the week, which is not bad. This is Closing Bell, last hour coming up. I'm Prashant, with me, my colleague Reema. Reema, hi.
Hi, it's about 100 points off from the session highs today. I think the disappointing bit is the mid-cap performance. The mid-cap index has given up its gains. At the session highs, the mid-cap index was up nearly 0.5%, and now as we speak, down about 0.25%. Small-cap index in the green, so the advanced decline ratio is still in favor of the gaining side, but then the gap between the two is not very large. On the way down, it's the PSU Bank. Some of the banking updates that have come through, whether it's from PNB or even a Bank of Baroda, some of them have been a bit subdued, which is why you are seeing the pressure. Energy, the Nifty Energy index is down, and on the way up, it's IT all the way. Yesterday, 4.5% gain on the Nifty IT index. It's followed it up with another 2.5% rally, and giving it company up are the pharmaceutical names. Real estate is having a good session, and this is an index which has gained 7.5%. So this week marks the comeback of the real estate names, and metals are having a good day with a gain of more than 1%.
Yeah, and some profit booking, as we highlighted in the morning, perhaps par for the course, because we've had a pretty strong run for 2 days, and it's been all across. It's not been limited to this or that sector, especially in the NSE 500 universe. Actually, excluding the top, if you exclude the top 100 companies, I mean, it's just been a very, very broad-based move out there. Real estate. Again, I think we're on track this week. IT, of course, will be one, which will go home with absolutely flat kind of change. Nothing for the Friday to Friday, but I think real estate is the winner this week. 7.5% gain for the Nifty Real Estate Index. And by the way, that 7.5% means that for the year, you're kind of flatlining. You're up about 1% or so on the Nifty Realty Index. Loda, once again, is doing very, very well. It's a stock, I think we highlighted yesterday, 10% for the week. DLF is not doing all that badly. One from Bombay, one from Delhi. DLF is up about 8.5% as well. So those are the two very large players, but I mean, it's a slew of names there across other cities as well. So just quickly running you through what's coming up here. Those transformer stocks are still down. I think they're off the lows, but that 2-year exemption for Chinese companies, 4 Chinese companies. Vinny gets us more details on this one. IT, of course, is in focus, recouping the losses, the first 3 days of losses. PB Fintech is off the lows again. It's seen a large block deal. So we'll put that in perspective, because there is news flow expected around the insurance sector, which I think should be pretty consequential for that company. That's what's coming up. How should you position yourself is the question. Mitesh is with us with that answer. Mitesh, good afternoon. Good to have you with us here. So 100 points on the day so far off the highs, but what would you do?
No, I think, Prashant, that upper end is not yet decisively conquered, despite the fact that we are still above 24,250. So keeping a wait and watch, I think the pattern is still on the positive side, and a lot of stocks are still doing good. So, as long as we don't break 24,250, 240, I think I would maintain a positive bias and maintain to trade a long position or long, biases on stocks as well as indices. So, of course, stock trading is slightly more rewarding than the way indices are behaving. So, maintain long bias as long as we don't get below 24 to 40. And even if you do that on the index, I think I would just prune down the stock exposure a little bit, but still maintain a net long bias.
Net long bias. Any stocks that you'd like to highlight, Mitesh?
On the stock side, I have a buy on Ambuja Cement. That's a buy with a stop below 431 for targets of around 460, 465. And Nifty Bank is something which is looking quite positive, breaking above the earlier swing highs. So buy that with a stop at about 953 for targets of around 1010.
Ambuja and this is the comeback this week and today.
In fact, real estate, we had a lot of trading calls a couple of days back, buy on and then over.
Hi, absolutely. So, like you mentioned, 4 companies which are given an exemption for 2 years. And this is mainly, what does this exemption mean, right? That these years, and this is mainly, what does this exemption mean, right? That these participating in which are given an exemption for 2 years. And this is mainly, what does this exemption mean, right? That these companies, they have a manufacturing in India, they're already participating in India. They're already private players. Now, this gives them an exemption to participate in PSU orders as well. This doesn't mean that they can directly, imply or, import actually products from China itself. Because they have the facility here, that is why these 4 players are given this exemption. So, we have TVA Energy, we have Nanjing Electric India, New Northeast Electric India, as well as Taikai Electric, which are the 4 companies which have gotten this exemption. Since the last 6 months, anyways, these conversations were going on. TBA was given this exemption first for a period of 1 year. Now this is a period of 2 years. What does this mean? What are analysts actually saying about these? These companies, like I mentioned, they were first giving it to private players. Prabhudas Leeladhar in Capital, in their note, is saying that the exemption could increase some bit of a competition, especially for a small and mid-cap transformer players, not for the large MNC players. So they're not expecting much impact coming in for Hitachi Energy, Siemens Energy. There will be some bit of a sentimental impact. Furthermore, they're saying that, this exemption will cover transmission equipment, bushings, insulators, circuit breakers, power transformers, as well as GIS switchgears. Why? Because there are some supply issues that are facing. So that's why they are allowing this to come in as of now in the system. HVDC projects, they are not a part of this as well. So HVDC projects are safe, and that's where most of the transformer companies are focusing on. So there's no problem on that front. IIFL, they too highlight that this move is something that was not expected in the industry to come in for all of these 4 players. But yes, this could see some bit of an increase in terms of competitive intensity, which was flagged off even 6 months ago. And direct impact will come in on pricing, likely for standalone transformer players, which will see the worst impact versus MNC players, which is not that much of an impact. Even when you talk about Kotak, they also highlight that, they see limited impact on transformer companies, given that most of these Chinese players, the 4 companies which are mentioned, they're already working on high capacity utilization. We do not know their capex plan, and even if the capex plan comes in, they'll not be able to grab the opportunity in just a time period of 2 years. So they do not find it as a much of a worry that comes in for most of these players. But yes, today the stocks are seeing a downtick. There is a negative sentiment that's come in here. But do not forget, valuations for most of these names also are around the peak levels itself. So that is also a reason that, slight bit of a negative news and you see the sharp fall.
Thank you very much for that. Sudeep Bandyopadhyay is now joining in. Sudeep, the way these stocks have run up, they're priced for perfection. So any bad news gets, the answer to that is a correction in stock prices. And you're seeing that 8-9% gone in many of the names. How big of an opportunity loss is this particular news flow? Or is the dip a buying opportunity? How would you analyze it?
Well, what you said is absolutely right. I think these stocks were priced to perfection. There was very little margin of error or any bad news hitting the counters. So as soon as this news flow came in, I think the stocks corrected, and I think they were waiting for some news to get corrected, and that's exactly what happened. As far as some of these stocks are concerned, particularly the the bigger ones, the multinational ones, GE, Vernova, Siemens, Hitachi, I think the impact on these companies will be extremely limited. Remember, apart from India, they have the parent company orders also coming in, which they are catering to. So I continue to remain positive on GE Vernova. More correction, I think it will be worth buying a long-term perspective.
What price will you buy GE Vernova?
Sorry?
At what price? You said you will look at GE Vernova if there is a correction.
Maybe another 5% correction. I think I will start recommending for buying at long term.
Okay, let's just quickly talk about IT since that's leading the gains. Well, today the news is about HCLTech, which has won a very large deal of $1.1 billion. It's for 5 years with the possibility of an extension for another 5 years. It's an AI deal and it's a net new deal, which means $1.1 billion over 5 years. So that is actually very significant, which is why the stock is up nearly 6%. It comes in from a European company, and it's one of the largest orders that the company has won in the last 2 years. And they say it is to build AI-driven operating model for a Fortune 50 European company. So the stock, of course, has seen a correction. Even after the up move yesterday and today, it's down 28-30% from the top. But this is an interesting bit that I picked up from the CLSA preview note, which came out yesterday. Well, they're saying that HCLTech is credited with a lot of industry AI-first initiatives. So they were the first ones to flag off the AI deflation, the fact that there is productivity benefits and they're being passed on to customers. This was highlighted by HCLTech first in their August 2024 analyst meet, so 2 years back. They partnered with OpenAI last year. They were the first to disclose advanced AI revenues. They were the first ones to make an investment in an LLM, Sarvam AI. It was a minority investment, 10%, but they're the only companies to have done so. And they're saying, CLSA says they're the only company, management who said that they're not penalizing the sales force of the company for passing on the productivity benefits, because by passing on the productivity benefits, you're effectively lowering the deal value, but they're not penalizing the sales team. According to CLSA, HCLTech will be the fastest growing large cap IT companies for the 4th consecutive year, which is why they have an outperform rating, and their target price is at 1,200. Earlier, it was a lot higher, but this quarter, we've seen many of the brokerages bring down their target price and valuations to align with the market. So the target price has come down, but they still see a little bit of an upside, or not too much downside, with a target price of 1,200. Sudeep, IT is always very tricky, right? And you've seen some violent moves in IT this week. I remember on Tuesday and Wednesday, or even on Monday when the persistent Nagarro news came, or on Wednesday when HCLTech issued the profit warning, the entire sector was bleeding. And now we've seen a rebound. And there is good news, a large AI deal. What's the call on IT?
Well, generally, the call is to stay away. And, I strongly believe that the AI-led disruption is real. We can talk about valuation. We can talk about, whether the AI companies are overcharging, like what Palantir CEO was yesterday talking about. But the fact remains that we have to, realize the fact that the way we work, the way we deliver services are going to change. And as far as Indian IT companies, the sooner they can adopt to this new reality and pivot towards AI, I think they will be better off. HCLTech is a classic example. I think they had spotted this quite some time back, as you have been talking about from the CLSA note, and they have been trying to pivot towards the AI and reorient their business model and the sales structure to cater to this kind of a situation. So as of now, I think I will hold back from recommending IT companies, particularly the large cap IT companies, but it all will depend on how they pivot. HCL definitely have taken steps towards that direction.
Got that. I think 95 points, right? And markets, of course, holding on. By the way, do you track this company, Corona Remedies? We had the management with us earlier today. Sudeep.
Yeah, I do. And I think there are a lot of interesting things happening there. The way I have been talking about pharma, I think for some time, I believe strongly that pharma is at a position where Indian IT was about 20 years back, the cusp of a quantum leap. And, pharma companies of all shapes, sizes, and nature will benefit from the current situation, which is a part of the pharma industry is moving towards patented branded products like a Sun. and others. CDMO players are getting lots and lots of business because of China Plus One getting reinforced, and domestic pharma growing at 25%. So whichever end of the spectrum you are likely to benefit over the next 5-10 years.
Got it. I understand. A couple of other stocks I want to address in just a bit, and these are companies we've had in the program recently, and interesting companies. So I'll put those to you in just a bit. But PB Fintech is what we want to address. Stock I think is lower. There was a block deal earlier. Yash is here with details. Yash, take it away.
Well, Prashant, it was a large block deal, and the second one within a period of about 30 days. As far as today's block deal is concerned, about 1.19 crore shares changing hands. That is about 2.64% equity, which was worth about 1,900 crore rupees. Temasek Arm MacRitchie Investments was the seller in today's block deal. And as far as the average price for today's block deal is concerned, that was at about 1,600 rupees per share, which was down from about 1,682 yesterday's close. So about 5% lower is where the block deal really happened. Now, importantly, as I said, this is the second block deal which has happened in a period of 30 days. Just about a month ago, on May 29th, Yashish Dahiya and Alok Bansal, they sold about 38 lakh shares for 665 crore rupees. Back then, the price at which that block deal happened was 1751 rupees. Today, the stock quoting 1592 rupees. Going forward, for the current month, that is the month of July and the month of September, there are two important corporate events, or rather regulatory events, which are lined up for the company. The first one is the launch and, the insurance products going live on insurance marketplace, that is Bima Sugam. IRDAI chairman very recently saying that insurance products expected to go live on Bima Sugam by September end. And the second one would be the consultation paper on those distribution regulations that, according to the IRDAI chairman, very recently is expected to happen in the last week of July itself.
Got it. So, fair bit of, yes, thanks very much for that. Fair bit of speculation around what will come, etc., etc. And stocks under pressure today on the back of the block deal is off the lows, though, by quite a bit as well. We'll see. We'll find out what comes and, we'll address it. I think is imminent. We don't know when. It's been imminent for a while. Sudeep, let's just get back to other stocks, right? And another company we had with us is Paisalo Digital, which is again an NBFC, 6,000 crore AUM. Lots of these smaller 4, 5, 6,000 crore NBFCs which are growing very fast. Growth rates are pretty strong. Any thoughts on this one?
Well, I think the excitement was around promoter increasing the shareholding on a continuous basis and the shareholding reaching close to 50%. I think the market excitement was built around this. But if I have to really, Prashant, look at the NBFCs, I'll rather look at the established ones. And believe me, they're also doing very well. They're growing rapidly. The asset quality is excellent. And the way the market and the economy is poised, they're expected to grow even better, in the coming quarters. So I'll go look at still that Bajaj Finance or Sundaram Finance at this stage, rather than going to the tier 3, tier 4 NBFCs.
Even M&M Financial's business update was quite strong, and I think the stock was up 4.5% the last time I checked. We should just get M&M Financial up for you on your screen. Their business update, 4.7% and still holding up in the green.
Another NBFC I think we spoke to was, do you remember One EMI? There was, again, it's about 5,000 crores in I think I'm getting the name, I think it'll come to me, but we had the management, again, growing very, very fast. But the point is, bulk of these, most of these come on EMI, sorry, it's called, it'll come up, ONEMI, has been doing very well. Stock's done very, very well. And we had them join us. I think this is a slightly bigger. I think there are about 10,000 crores now in terms of assets under management from what I remember. Segments are largely similar. I mean, there is a retail book, there is MSME, there is LAP, and and there's some unsecured as well. So if you look at Paisalo, you look at this one, and there are a bunch of others as well. So that's the entire NBFC space. One more name, Sudeep, is again, I'm sorry, throwing all these individual names at you and expecting you to have a view. I mean, if you do, that'll be great. Amagi Media. They essentially help broadcast companies they go events to go essentially help stream events, sporting events, and whatever else, events, etc. live. That's one part of the business. They help with cloud transition for media businesses. I mean, like CNBC and others. And they got another segment. So it's a kind of unique business. They work with all the big majors. Any thoughts?
Yeah, I've been tracking this company. It's very, very interesting business, Prashant. Good that you're talking about it. I think this company has significant potential. And while they're working with a lot of these marquee names at this stage, the opportunity for them to scale up and expand significantly is also there. So I would say this is a very interesting business to track. And we have been recommending a buy for our clients on Amagi Media.
Yeah, got it. Lots of interesting these newer businesses, right? Which are they're finding interest and they're finding buyers and they're finding allocation in portfolios, etc. There's institutional holding, by the way, across these three names that I mentioned. Thanks very much, Sudeep, for joining us. It's always good having you here. Appreciate your time. We'll take a quick commercial break. We'll come back. We'll put the spotlight on what's moving with Hormuz in terms of individual names and, of course, more market conversation after that.
Welcome back. For the markets, we're still up close to about 0.4% on the Nifty and the Sensex, mid-caps in the red. But now let's talk about some of the buzzing stocks where we are seeing a lot of momentum today. Hormuz joins in with more.
Can't not talk about the capital goods names or the power transformer companies who are having a very forgettable day in today's trading session. Be it GE Vernova, be it Hitachi, or be it Siemens, all of them. GE Vernova is down 10, Hitachi Energy is down 8, CG Power is also trading with losses of a similar quantum as is Siemens Energy, both of them down around 7% each. So not a good day for either of these companies. And you take a look at the F&O side of things as well. For the 28,000 put of Hitachi Energy, the premiums are up 460%. The CG Power, the 900 put option has tripled. And for GE Vernova as well, the put option is up 2.5 times in just one single trading session. You take a look at the volumes as well in today's trade. Hitachi Energy has had 6 lakh shares that have been traded. The 20-day average is only 1 lakh shares. The CG Power has had 2 crore shares that have been traded. The 20-day average is around 28 lakh. And GE Vernova 2 is trading with 4x its 20-day average. And there has been significant delivery volumes as well. a third for GE Vernova, CG Power and for Hitachi Energy, and half of the shares that have been traded for CG Power and GE Vernova have been marked for delivery. The next important levels on the downside for Hitachi Energy, it's the 50-day moving average. For CG Power, it's the 100, and for GE Vernova too, that is the 50-day moving average on the downside that you need to watch out for going forward. Now for HCLTech, that's one stock that has outperformed over the last two trading sessions, another 6% higher today, of course, after the back of that big deal announcement. The second straight day of gains. Volumes are the highest in 2 months as well. Premiums on the 1100 put option today are down 53%, so they have declined. They are among the most traded today. 1.2 crore shares have been traded on HCLTech. The 20-day average is around 26 lakh shares. A third of those are marked for delivery, and the stock still is below its key moving averages though, considering the sell-off that it has had previously. The 50-day moving average on the upside is now at 1160, so that's the first level to watch going forward. And before July, the stock had entered this month on the back of 5 straight months of losses. Now, on the flip side, Eternal is one stock that has had a very good week this time around. Gained in 4 out of the last 5 trading sessions. It's off the highs of the day though. 1 point was up 2.5%. Still up around 12% for the week. They're turning out to be the best one it has had since July of last year. It had 3 crore shares have been traded, marginally higher than the 20-day average, which is around 2.5 crore. Close to 60% of these shares traded have been marked for delivery. This is among the most traded on the Nifty 500, and in fact the stock has now moved above its 200-day moving average, which was at 279. So it's still around about those levels, but still down around about 23% from its 52-week highs, which was around 368.
All right. Eternal is exactly at the level where it it's at the midpoint of last year's range, and it was a pretty large range last year. Low was about 180, 184, and high was about 370. So we are at about 280 right now, which is where we were midpoint. So let's see. I mean, this is the third year where it's been consolidating with large swings and 50, 60, 70 rupee moves that basically have retraced both from the way up and on the way down. Tushar Pradhan is with us, Director of Hexagon Partners. Tushar, good to have you with us here. Thanks for joining in. Just weigh in on some of the big cuts on these Hitachi and G's, and I think this is the second instance. This Chinese competition bid news came earlier as well. Stocks all sold off, and then they all recovered, made newer highs. What's the reading this time?
I think the market generally also tends to overemphasize the news factor. So I don't think the market is accurately pricing the valuation or the impact of the 2-year leeway given to Chinese companies, etc. I think someone also was describing the fact that how large is the opportunity and what are we talking about? So I think if one looks at the overall opportunity, it is fairly large, and maybe one of the reasons why some of the newer entrants have been allowed is simply for the fact that the present, I would say, suppliers may not be in a shortage situation where they may tend to kind of overprice because of a lack of competition. So I think overall competition always is very good for any market. As of now, maybe their premium positioning is a little bit under question because of this entry. But you have to remember that these projects are fairly drawn out. The requirements for being onboarded for supply for such projects always is also not a given, which means that it doesn't really mean that these companies have to be downgraded right away. They may continue to have a lion's share of the market going forward, and maybe they emerge as better providers, and that is something that the market has to see. So I won't read too much into a per day kind of environment where suddenly this news has an impact. I think it is just what markets do on that one day that the news hits.
That's fair. But Tushar, the other point is that it's also, I think, we've all learned that buying stocks at 100, 150 times earnings is not a smart way to make money, right?
Not at all. But as you realize that there are other companies which trade at triple-digit multiples for a reason, that the opportunity appears to be so large and that the quarterly increments to earnings growth can be so, I would say, expectedly strong, that one would want to price it. But as a value investor, one would shun them at these multiples. But if you're a growth investor and if you have a fairly longish period where you can kind of stay with them, then I think there is enough adequate reason for you to look at them positively as well.
Tushar, many believe that the time is right now for banks to start outperforming from here on. In a way, the stars are aligned. The FCNRB deposits, bring in the deposits, they get the fee income on it, so that's positive. Plus, credit growth is finally picking up. We're at 17% at a system-wide industry level. So if you had to pick one bank or one NBFC, or maybe just two banks, to play the upcycle if you believe in it, which stocks would you bet on?
I think one has to understand that the fundamentals were always very positive for the banking sectors throughout this last period of probably softer prices due to various other factors. But the point is now that most of the banking companies are basically trading at a significant discount to their average valuations, even if you take the last 3 years, especially the private banks. To say that this is, going to be a choosing game between, what best among the sector would really be a difficult one, simply because each of these banks have their own range of activities. And it might be difficult at this time to anticipate which ones are actually going to do well. I would go with one PSU bank and one private bank if I were to hedge my bets, simply for the fact that most of the PSU banks, except for maybe State Bank, are trading at roughly about 1 time, 1.2 times, or even sub-book value. I think there is tremendous value if you think that the banking sector is going to do well from here. And they're actually increasing their share across the total credit market. If you look at the private banks, they are extremely efficient, they're very growth-oriented, and they can be very nimble in terms of how to react to a situation. So I think there, the field is fairly divided because you have some entrenched leaders, you have some pretenders, you have slightly smaller private banks, which are even more hungrier. So from a stock market perspective, I don't think you have to look for the best bank here. I think you have to look for the value embedded in the price that they're trading at, given the sort of growth they can achieve. The larger banks will find it a struggle to grow at the rates at which some of the smaller banks can do. So it is not about which bank, it is about the targeting of the positioning of the portfolio where you think that these companies are likely to grow faster than the average rate at which the banking sector will go. So I think investors have two things going for them. One is that valuation is in their favor compared to averages for the past 2 years or so. I think the growth is pretty much set out. Inflation expectations are benign for India. And I think if the monsoon is just a little below average, I think we will carry over this year without significant increases in prices. And of course, the imported inflation by way of crude oil is continuing to remain kind of under the weather for now. So if that remains, then we have a significant advantage for the banking sector as a whole doing well going forward.
Any thoughts on real estate? Stocks have fallen quite a bit, trying to come back up. There's some commentary around management meetings with individual companies here and there, sounding positive. I think I saw the data for not June but May, the last reported industry data, which is pretty decent. I mean, do you like it? Own anything here?
I think real estate is an interesting field for now because, first of all, we have seen this premiumization in terms of how the industry is moved towards super premium and super luxury, which increases the value component and the profit and the margin component for most real estate developers. And one might tend to think that overall demand is growing. But I think one has to be careful because these are cycles. And we've seen one cycle where the super premiumization actually ended up in breaking up the size of these luxury apartments to be sold then later on to the demand, which was actually much more steadier and middle of the road. So I hope that doesn't happen. But the fact is that these things are cycles. And one has to be kind of really, really specific about what company they would choose to own in their portfolios. It is not a generic thing. And as you know, real estate is not at all generic across cities, across locations, across the quality of housing, etc. So if you choose a geography like Bangalore, for example, or Delhi, NCR, or MMR, these are very, very different markets. And then you have to choose the company which plays those markets. So it becomes a little bit of a complex picture. But I think the traditional means of understanding where the demand is coming from, it should be fairly across the board. It should not be concentrated on super premium or say super luxury, because the value component becomes extremely volatile if those face a little bit of a storm in terms of incremental sales. So I think I would go with a middle of the road kind of real estate developer in a growing geography rather than choosing the super premium at this point of time.
Okay, thank you, Tushar, for joining in. I hope you have a lovely weekend. Thank you. All right, let's, as we get into a break, here are comments that we got from Adrian Mobat of Adrian Mobat. He tracks the emerging market space very closely. And his basic point is that India lacks a very strong catalyst that will wake up the FIs and say that come back and invest in India. So he's still underweight on India, and he's worried about the progressive talks between US and Iran. Listen in, and then we'll come back and continue talking and tracking the markets, and we'll get you some D-Street chatter.
At the moment, I'm struggling to see the sort of powerful catalyst that would make the FII wake up and think I need to get a bit more money into India. Now, that usually will be something to do with earnings revisions. And at the moment, earnings revisions have still been relatively poor within the Indian market. I'm still anxious about what's going on in the Middle East. The Straits of Hormuz is neither open nor closed. And there are some specific shortages of refined products around the world. So I think we've still got to be a little bit cautious about seeing some supply disruption as the inventory levels have been drawn to very critically low points. I don't feel that the negotiations between the US and Iran are going smoothly, to say the least.
Jimmy.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
Welcome back. D Street chatter with, I think, 30 minutes to go as far as market closing is concerned. Nimish is with us as always with what he's picking up, what he's hearing. Nimish, take it away.
Hi, Prashant. Day of profit booking, I would say, I guess a bit of Friday factor as well, which is playing out. But the volumes are on the lower side, so it looks like there is a lack of participation as well from larger institutions today. Remember, there were two large fundraisings, the big $1.5 billion QIP from Adani Enterprise, very strong demand for that. And also there was a large block, so the number will get skewed. because of that PB Fintech block as well. So that sucked a bit of liquidity in today's market. Having said that, from a flow perspective, again, a mixed day of trade, but I guess there is a bit of short covering rally now playing out, not only in IT, but in other sectors also. Real estate also stands out in terms of a bit of short covering rally in today's market. The cash volumes are on the lower side, so that again says that the participation is on the lower side today. Technically, 24,300, 24,350 is acting as a strong resistance. So every time we go towards those levels and we see a bit of profit booking, so that's something to watch out for. Even intraday, the PCR had moved almost to 1.4 and generally to close to 1.5, 1.6. We see a bit of profit booking there. So intraday, there is a bit of reversal, but I guess there is lack of participation as well from institutions today.
Well, volumes are also low because it's 4th of July, right? So a lot of foreign investors would be on leave, I guess. So less selling from that end.
Possible. Let's talk about some stocks as well, where there is chatter. Nimish, back to you.
So the first stock is CMPDI, big volumes and big up move as well in the last couple of days. My sense is at least one leading domestic mutual fund has been accumulating or buying at current levels. Hence, you're seeing a bit of an up move in that name of late. So that's the first stock. The second stock is Eternal. In fact, both for Eternal and for Swiggy, most of the brokerages have been writing about that they anticipate a very strong Q1. So for Eternal today, it's a combination of short covering as well as a bit of buying as well from large institutions. So that's the reason why a bit of an uptick there. The third name is Ujjivan Small Finance Bank. It's under pressure today, but for the last couple of days, my sense is there is a bit of accumulation happening and a couple of domestic mutual funds are actively buying or looking for blocks as well in Ujjivan Small Finance. And the last is Indus Tower. In this entire up move from the recent lows, this is only one stock which has relatively underperformed, largely on back of selling pressure. So there is this supply coming in from large institutions. And if you remember, last month, Jefferies had downgraded the stock as well. So a bit of FI selling, and that's the reason why among all these names, actually Indus Tower has underperformed in the last couple of weeks.
Nimish, and that Adani Enterprises QIP, all done, right?
All done. So the sense is they've raised $1.5 billion. So they're up the size. So now it's 15,000 crores that they've raised. It's been closed and allotted is what my sense is. So large domestic funds, large global funds, at least two, one domestic and one global fund seems to be the anchor investor. So nearly 50% of the book was allocated to those two funds, one domestic and one global FI. So it looks like it's a done deal now. 50,000 crore raised, and some very large market investors have participated in the Adani Enterprise QIP.
Anything, the news and brokerage, anything you're picking up on these transformer names? I mean, apart from what we've been carrying, and all still down sharply.
Which one?
The transformer names, CG and Hitachi and GE, and the others.
Not really, Prashant. But again, we've been talking about it. We did a piece as well. All these stocks were trading at very hefty valuations, 80 times, 90 times, 1 year, 2 year forward. And normally we've seen, there is no room for error in these kind of names when the valuations are so high. So looks like again, the sense I spoke to a couple of investors and they don't believe it's that big negative for the existing players. But again, the sentiment seems to be a bit of a challenger because valuations are quite high in most of those names.
Yeah, absolutely. So anything move, I mean, the moves are outsized, have been on the upside, and when they come on the downside, they're not small either. Thanks very much, Nimish, for that. Mitesh is back with us with trades. Mitesh, what do you have?
So I think, the market has slightly tapered off, not the best of the season, but it's not broken down. So we're still maintaining long bias. I have BTST and Apollo Hospital breaking out of a 5-6 days kind of a narrow consolidation. BTST here with a stop below 88.80 for targets of 89.50, 60, 70, 89, 60, 70 kind of range can be looked at. And the other one is Zydus Life Sciences. That's making a fresh 52-week high. It had earlier kind of failed to get past 11.20 or 11. So BTST here with a stop below 11.20 for targets of 11.75, but it will also be a trading call with a stop just 5-10 points lower and a target in excess of 12.
Yeah. He just put up Keynes. It's a beaten down kind of name. Today it's coming up a little bit. It's just the 6% is just today. For the week it's up about 2.5%. So not really. Thanks very much, Mitesh, for joining in with those two names, Apollo Hospitals and Zydus, on Mitesh's radar. But there's some more technical opinion. CLS's Lawrence Belanco says that while the Nifty itself remains trapped within a broad trading range and lacks a clear directional catalyst, Underlying market breadth remains constructive. The impending breakout in the Nifty Mid-Cap 100 suggests risk appetite is strengthening outside the large-cap universe. Shriram Finance, Lodha stand out as technically attractive opportunities, both having recently completed significant basing and consolidation pattern breakouts. Lawrence also has a view on gold. He says for the first time since speaking out in January of this year, gold's corrective phase is showing signs of maturity, with the developing price momentum divergence between the 10th and the 25th June lows, suggesting downside momentum is beginning to fade. This creates an attractive risk-reward accumulation opportunity. On the upside, initial resistance, according to him, is 4,400 to about 4,500 an ounce, where the 50 and the 200-day moving averages are downside. On the downside, and downtrend resistance from the January highs converge. A decisive break above this cluster would provide additional confirmation that the correction has run its course and that a new advance is underway. Well, that is Lawrence Belanco with his view on stocks and gold as well. Well, let's just also talk about a couple of stocks, right? And these are business updates for the first quarter. Ananya has got that list. Ananya, take it away.
So yes, few stocks are buzzing in trade today following their business updates. So let me walk you through the same. So first, let me first start with Raymond Realty. Now, the stock is surging after reporting a strong Q1 operational update. Now, pre-sales more than doubled, rising 129% YOY despite no new project launches. Now, while collection increased 47% YOY. Now, coming to Avenue Supermarts, this D-Mart is under pressure after reporting a soft quarter. Revenue grew 15% YOY while the company added 3 stores during the quarter. Now, for future investors, the board will also consider a proposal to raise funds through the issuance of debt securities on July 11th. Now, coming to IDFC First Bank is also witnessing strong buying interest after reporting healthy business growth for the June quarter. Loans grew 21% YOY, deposits rose 18%, while CASA deposits increased 25%, taking CASA ratio above 50%. Now, Mahindra and Mahindra Financial Services, they also posted a strong set of numbers with disbursement growing 21% and business assets up 12%, collection efficiency is 95% from 98% in the March quarter, although when you look at year on year, it is stable. Now, meanwhile, Union Bank is also under pressure after reporting, they reported stable advances growth of 13%, but softer deposit growth weighed on sentiment. Now, the stock is also trading ex-dividend, so you need to keep that in mind, which is adding the pressure on the share price. Now, also fresh updates coming in from Max Estates, which has just released its Q1 business update. Good set of numbers. We can see this company reported pre-sales of around 1,100 crore, up more than 5 times year on year, while collection stood at 500 crore. It also highlighted 7,200 crore GDV pipeline and plans to add around 2 million square feet of residential development annually. So these are the few stocks buzzing in trade today.
Thank you very much for that. Anand Tandon is now joining in on the last leg of the show. Anand, any of these real estate companies, Max Estates, Ananya was pointing out, or even a Raymond Realty, the Q1 update looked good because real estate seems to be seeing some buying at these levels now.
Well, there is, I don't think, any major change that has happened in the outlook for real estate. In fact, typically 2 things have been driving it. One is the fact that, interest rates have been low and therefore the EMI has been lower for the most part compared to the income of people, which has been going up. And the other part, of course, because of the stock market rising, enough people have reason to go and then buy real estate. But by and large, most cities around the country have seen sharp increase in real estate prices over the last couple of years. And I think you've now reached a kind of equilibrium where you'll have to really find not so much investors, but real users. And I think that is still a bit of a stretch. So I think you'll find inventories pick up. Right now, the market may be more bullish on it. I don't see anything fundamentally different.
You like Anand, hi, asset management names? There's one more coming, SBI Funds. The IPO was filed day before yesterday. We put some details out. I mean, sources tell us the asking valuation is between around 1.2 to 1.3 lakh crores. In that 35 to 40 times trailing earnings multiple.
So as a space, is asset management a good business to be in? Absolutely. Even more private equity funds, unfortunately, we don't have them listed. The problem, however, is that the AMCs typically are now running open-ended funds for the most part, and money can also move out. And if you see what is happening globally, so for example, something like in the US, we have companies where those who are not in ETFs have been actually seeing a steady bleed because the market continues to believe that, rather than managed funds, indexed or ETF-based funds are the ones that will continue to grow. So you are having a problem in terms of being able to maintain your yield. The largest of the world trades at something around 1.5% of AUM. Compare that to what you are seeing in India. I haven't seen the valuation of SBI, but by and large, it will be almost 10 to 12 times that. So yes, asset management is good. Is it going to grow at the same rate as we have seen in the last 5 years? I think it will have a slight slowdown. But that said, it is still a long-term story. The valuations I don't like.
50, I think 20-25% kind of growth. Assuming, of course, the flows keep coming in, plus there is the mark-to-market gains as well, right? It's once both are needed. So it's like the cycle, which of course has done well. I mean, and hopefully, but valuations, yes. Especially compared to some of the global peers. But that's true cross sectors here in India. We'll take a quick break. There is 12 minutes to go, so a lot more conversation with Anand coming up on the other side. We, by the way, also chatted with Shreyas Devalkar of Axis Mutual Fund earlier. So some views from Shreyas and Anand on the other side.
One view we are also taking that it is also we have to look at 2-3 quarters ahead because already these commodities have started falling and you are sitting on a price increase. So how much impact it will have on the margins 2 quarters down the line. So this quarter margin may be washed out for someone because of the raw material impact. So this holistic picture we are taking, and when you are talking about FMCG, I'm just broadening this conversation to entire consumption basket, including retail credit growth driven banks and NBFC, including the FMCG, autos, and many of the consumption segment of market. So one, as I said, and the second is the coordinated efforts of both central bank and central government to bring in the FII flows, especially in the bond market. So these were the two main triggers for this. We are positive on entire capital goods space, especially the mid and small cap oriented funds. And when I say capital goods, it is more to do about manufacturing. So it is whether it is auto ancillary. They are also having a lot of manufacturing through non-auto businesses. The market may reward more of the manufacturing segment because of the global disruptions. Whenever nominal GDP growth improves, the headline numbers start improving, and that gets reflected in the quarterly previews what are getting released now that you may observe that. Even the retail credit growth, what we are witnessing upwards of 15% is partly because of that, partly because of from bond market to banks, etc.
It is happening now. New tomorrows, new challenges. And all of it needs energy to work. Not afraid to imagine big. Because when energy stops taking, when it just gives, people can move. Really move. At this moment, the world's evolving. And so is energy. Suzlon. Good energies that work.
Hey, लाइफ में स्क्रैचेस तो आएंगे। गाड़ी के स्क्रैचेस को तो कॉस्मो पीपीएफ संभाल लेगा। आप अपना देख लो।
that he is
Welcome back. We've got a few minutes to go before we wind up today's trading session and for the week. Anand, there are very few pockets in the market right now where valuations would be comfortable for companies where you are seeing growth. We spoke about AMCs. Again, there is growth of 20-25%, but you find the valuations on the higher side. So what does one do? Should one buy value stocks, so say something like an IT, but IT there is no growth. So where are you investing your money right now?
Why other assets? To diversify, you need to move not only in equities but also in other asset classes, which can include commodities. Gold has given you a good opportunity. It has fallen off a cliff. International markets selectively, they are overpriced pockets again, as everywhere else. There are some sectors which have taken all the investments and have perhaps become humongously overpriced. But when we say that, there is a large number of listed companies in India, therefore you can always find something. I would just suggest that, India is finally 3% of the 4% of the world's economy. Surely in the 97%, you can find more than 4 companies to invest in as well. So net, the more you diversify, the less volatility you are likely to face. And of course, you will also get more average returns. But, so what you're really betting on is the fact when you're doing an SIP that you are getting some kind of an average return. So you can just diversify more. But coming back to specifically India, like I said, this is a good time perhaps to look at multi-asset funds as opposed to just looking at equities alone.
So should one increase our allocation to debt? Suppose someone has equity mutual funds, because you are talking about diversification.
Well,
or is it gold, commodities?
It's a difficult call for me to suggest for everybody because you don't know what the individual preferences or portfolios are. But as I said, from just looking at equities, it may be a good idea to look at asset allocator funds, which have the ability to move across various assets.
So I was looking at some of these multi-asset funds, whether it's from Axis or I think ICICI Pru, they broadly have about 60-65% in equities and the balance in debt and other in the other asset classes. So 60-65% in equities. That would be the appropriate way to allocate because that's what you'll get if you invest in these.
Well, that's right. But the advantage is that you have the fund manager has the ability to move. So, for example, if you assume that the index continues to move up for, let's say, by another 5 to 7% in the near term, you will again start to hit a valuation problem on the overall index, and they can then move it out into some other asset class, which looks relatively cheaper at that time. If you were to do it yourself, obviously that will have impact on both your ability to time it and also, more importantly, the taxes that you will have to pay every time you were to buy and sell. So, I'm just saying that for most investors who are watching this show, it may make more sense to just buy it as a fund. And yes, right now the equity part will be higher because your expectation is that the momentum we are seeing in the market will probably continue for a little while. But I would argue that it's only a little while.
Although in Anand, in these multi-asset funds, I think Naren was with us 2 days back and he said, I think the minimum you have to keep is 60%. So what they've done is they've introduced a multi-asset fund of funds, which basically then you kind of invest in schemes so you can go under 60. And Naren's point was that people are too overexposed to equity, which I think is your point as well.
Absolutely. So the more you diversify and not just diversify, but if you leave the asset allocation decision also to the fund manager, you are using their expertise to that extent. The more you constrain them, the better, the less, the more the onus is on you to make sure that you are able to time the sectoral moves or the asset allocation moves better. So I'm saying for most of the investors that would be watching your channel, assuming that we are not addressing the traders, the best thing is to give as much freedom to the fund manager to try and manage your money in a more systematic way.
Anand, we leave the conversation here. Thank you very much for joining in. Enjoy your weekend. Well, the Nifty looks like it's ending below the 24,300 mark in the green, so it's still a good Friday with a gain of 90 points, but off about 100 points from the session highs. The Nifty Sensex up 0.3% for the day, For the week, we've managed to rally close to about 1.1%. Mid-caps trail the frontliners, mid-cap index ending in the red. The mid-cap index down 0.25%. Today, for the week, we're up 0.6%. Advanced decline ratio in favor of the gaining side, but just by a smidge. On the way up, IT up 2.5%. Monday, Tuesday, Wednesday, the IT stocks sold off, but they rebounded sharply on Thursday and Friday, which is why for the week, we still have a gain of 1% on the Nifty IT index. Pharmaceutical names saw buying. Real estate was the big sector for the week. And metal index also up and about. Along with that, a couple of PSUs. So the Nifty CPSE index in the green. Banks were under pressure today. The Nifty banking index ending in the red, while PSU banks particularly were singled out with a cut of about 2%. Axis Bank under pressure. Kotak Mahindra Bank has lost 3%. After Ashok Vaswani said earlier this week that he will not be seeking another term. So there is that vacuum which is created till we get clarity. And a couple of these FMCG names also had a good session. Eternal in particular was your top Nifty gainer with an up move of 10% for the week.
Yeah, absolutely. Well, that's the bell which has gone off. You know, if you want to just review the market broadly, it's essentially the large caps and the small caps which have done very well. And everything kind of falls in between. Nifty is up 0.9, small cap index is up 2%. Sectorally, real estate has done by far the best, about 7.5% gain there. Top loser has been the PSU Bank index with a 3% cut. The big range sector of the week has been the IT index, which goes home absolutely flat, but after, of course, being all over the place through the course of the last 5 trading sessions. So that's it. That's the market for you without going into individual single stocks and names, etc. It's a wrap on this edition of Closing Bell. Thanks very much for staying with us. More comes up on Editors Roundtable on the other side. Stay with us.
this condition.
Markets end the week on a strong footing. The Nifty closing above the 24,250 mark. Benchmark indices extending their gains for the fourth straight week. But beneath the headline gains, there were plenty of moving parts. Hello and welcome to Editor's Roundtable. I'm Reema Tendulkar. With me are Prashant and Nimesh. And joining us here in the studios, Prashant Khemka, founder, White Oak Capital Group. Prashant, thank you very much for joining in, coming to India from Singapore and coming to our studio in this weather.
Pleasure to be here. Thank you for having me here.
I mean, we'll all the questions Prashant's way, but this week has been Nimesh, Reema has been busy. Reema has been explaining why IT was selling off on Monday and Tuesday.
And Wednesday, and then explaining why it's been up on Thursday and Friday. But all in all, yeah.
The last 3-4 weeks have been good, right? I mean,
Fourth week of gains,
4 weeks,
right?
4 weeks on a trot, a bit of a pullback rally. A lot of sectors are participating. Real estate finally is picking up. IT did well in the last couple of days. A lot of PSUs have started participating again. So I guess it's a decent pullback from the March lows that we saw. So, Prashant, what's your take?
And just one more thing, Nimesh. Nifty is up 1% this week, and I just sort of want to make a mention. But Naren was with us 2 days back, and he was saying he's not very positive on mid caps, but he likes large caps and small caps.
Yeah.
So I was noticing this week Nifty is up 1, the small cap index is up 2, and everything is kind of, half, 0.4, 0. Nothing very much. I don't know if you share that view, Prashant, which is that is where largely value lies.
See, we don't take a view from a top-down perspective. Our view always is that all the market cap segments would perform in line going forward. Yeah, sometimes one would be right, sometimes one would be wrong on either one of any of these market cap segments. For example, small caps have had a fantastic last 3-4 months. If you see, they've, I think, outperformed by 10 odd percentage points or so compared to large cap. Obviously, the prior 12 months they were beaten up. We just don't move around allocation or have any view at a. To us, it's hard enough to identify a single stock that we can have confidence in outperforming. Yeah. To talk about 250 stocks, small cap stocks, and compare them to 100 large cap stocks is just something we don't even try.
But is there, maybe I don't know, but most of the money is chasing because they can't. I mean, there are restrictions, and you got to have a minimum amount of market capitalization, and that has been cited. And I'm assuming you'd agree that is also the reason why the mid cap part of the market is so hotly chased, right? That is. So I don't know if that is one reason why. I take your point. Over a 20-year period, returns on Nifty, mid cap, small cap, everything will kind of even out, right?
Yeah. So there could be a point. It's just that it is not predictable. I was worried about the same thing mid-23, June 23. I'm glad we didn't act upon that worry, because last 3 years these have done really well, and maybe someday it unravels. Our view is there's just so much value that can be added by having your small cap component of your portfolio outperform the small caps. Yeah. Large caps outperform the large caps, mid cap outperform the mid caps, financials outperform the financials, healthcare. Why bother with, things that are inherently unpredictable?
Prashant, you sit in Singapore, right? So from an emerging market perspective, are you seeing some signs of AI fatigue? Because globally also we are seeing a broadening out. So people are betting on AI, but they are looking like this, for the last 4 days, Apple did very well in the technology space in the US. I think it was up about 9% from Monday to Thursday. So in that sense, are you seeing some fatigue when you see global investors about putting money again to the same stocks like your Samsung? And how is India, how many the crude price risk seems to be out of the way?
No, as of now, I agree with you, but this changes from day to day. South Korea is one day down 10%, the next 10% or so. Yeah, so today it's up 5-6%. Yesterday was down 8%. So it's entered in a very volatile phase now. It has been had been a unidirectional rally since, let's say, March of last year till March of this year or some point in time at that time. If you look at last 1 month, has been particularly volatile for AI. Comment from Meta can cause severe double-digit hits to stocks across the sector. I don't know, once again, impossible to call where it goes from here goes higher or lower. So that's not something that.
But fund managers are not going to like this kind of volatility, right? Isn't that a risk factor when you want to make fresh allocations?
See, it's risk factor in both directions. For fund managers, it's all about relative performance, as I've always said. It's, now the soccer, we usually give examples of cricket. Now soccer is going on. Doesn't matter how many goals you score. Whether you scored more goals than the other teams. So there is bound to be an allocation to AI. Yes, and India has done very well this last 1 month because of several factors, including this AI fatigue that you're talking about, Rima. You see quite clearly days when AI-linked stocks are severely hit. India tends to do better on those days because India has been considered an anti-AI. It's like, the ICE or the internal combustion engine few years ago was written off because of this electrification of vehicles and all that. So they're badly beaten up. And then at some point people figured out that no, ICE is not going to go into oblivion, at least not anytime soon. And those stocks started, stabilize and then did extraordinarily well for a while. And so right now, that kind of situation is there with AI and India globally.
But let's talk about sectors now in terms of micro themes. First on IT, Rima, you want to put out the large news? In a bit. Okay. And you own some of the IT names, Prashant. What's the broad view? You're still bullish on the mid-cap IT names?
Yes. See, IT, at the end of it, companies aren't going to stop spending on IT. JP Morgan, Goldman Sachs, all these big companies are going to continue to have a certain budget, maybe increases over time even, on IT. Now, within that, because AI is such a disruptive development, there would be, on the other side, some who will be relative winners and may win big.
Actually, my point of asking you was because you own a lot of the mid-cap IT names, are you happy with the fact that they've become more aggressive, the likes of Persistent going out and making a large acquisition, or Coforge that matter, putting out a very big deal in the overseas market?
Certainly.
What's your broad view there?
So not talking about specific names,
course,
but
broadly,
our view is some of these mid-cap companies where execution is very strong, they'll transform faster than some of the larger companies. And I'm not saying mid-cap in general, all mid-cap companies would transform better. So there'll be a new reality with AI, new skill sets required, and those who are able to transform their workforce capabilities faster and in a more nimble manner, they'll gain market share during that transition, which is what companies in any sector with strong managements tend to gain market share during more volatile time periods, and that's what we expect in IT as well.
But if you had allocated fresh money, I know you've been holding on for a longer time in mid-cap IT, but anyone who invested in mid-cap IT saying that, well, it's cheaper relatively last year, 2 years back, 3 years back, today the price is even lower than that. The index itself is at a 3-year low. So have you been buying more when the prices are coming down in this slide? Or are you still waiting to see where this stabilizes before putting fresh money? What have you done incrementally?
So see, Rima, for our team, if IT as a sector is, let's say, 10% in the benchmark, which it was a while ago, we are neither going to be 20% nor we are going to be less than 5%. Because you have to be certain, within certain, because it's otherwise it becomes a top-down view and top-down risk, which is not how we believe would make money. Different managers have different style. So today, IT is much lower weight in the benchmark. And it's about 5% or so, 5-6% or so. So our weight in the portfolio is also much lower. And because we don't own large cap IT, much of any at all, the overall weight in the portfolio is lower than the benchmark, but it is more represented in some of these select mid-cap names.
Sure. But Rima, to you on the IT names, what's the work?
Just one point about the large cap IT. So last year, IT exports, the revenues went up 12%, but the large cap revenue growth was only 3.5%. So basically, it's telling you that the money or the work is done more by the GCCs or other players in the mid-cap IT space. But it's been one wild week for the IT stocks this week. So Monday, Tuesday, Wednesday, all 3 days, the Nifty IT index was massively down. And then there came the rebound on Thursday and Friday. And there were lots of news flow headlines coming out. So Persistent acquired Nagarro, so that sent the stock in a tizzy. KPIT gave a profit warning on Wednesday. Then the Palantir CEO globally to CNBC Squawk Talk made a case for custom AI models, a pivot away from the general LLM models like OpenAI, Anthropic to custom AI models, which means there is work for the Indian IT companies. And finally, on Friday, we had HCLTech winning this large $1.1 billion net new deal. Now, the earnings season begins next week with TCS on the 9th of July. But what this week tells us is that basically, like KPIT, there could be accidents. The situation right now is very, very volatile. Expectations are very muted. So if I look at the large cap expectations, organic revenue growth, I'm looking at organic because Infosys would have some acquisitions contributing to the top line. They go from minus 1.5% to about 0.7%. And this is otherwise a seasonally strong quarter. Typically, you would have had growth of 3-4%, but not this year. And companies, when they speak to us, they speak to the investors, I think they're going to make a case for positioning themselves well. The AI narrative is going to be very important about the investments that they're making. But I think there's one table which I picked up from the CLSA preview note, and this is what's happened to the IT names. At the start of the year, consensus expectations for an Infosys, TCS, in terms of the valuation multiple. So, investors priced a TCS and an Infosys at 20, 22 times, 23 times. And now, this quarter, we've seen brokerages slash down, and I'm going to read out the list. CLSA, JP Morgan, Nomura, Motilal Oswal, HSBC, Kotak, Goldman, all of them have lowered the target valuation multiple on IT names, and they've lowered it massively, 10, 15, 20%. Sometimes you get that feeling, right? When many of these brokerages have thrown in the towel and brought down the valuation multiple, is it a sign of capitulation? But valuations for the Indian IT companies currently stand at close to about 13 to 15 times forward multiple. The bulls will argue, well, this is much cheaper than what they used to. Historically, it would be at 15 times. Large companies like TCS traded even higher. But the bears are saying that, well, this 13, 14, 15 times is still at a premium compared to an Accenture or Cognizant. So globally, companies are trading at 8 to 9 times. But I think in a nutshell, I'm going to borrow this line from Kotak, who say that the setup for Q1 FY27 is interesting. The valuations, according to them, limit the downside, but reiterating from here, needs growth to accelerate, and we still need to see some evidence of companies capturing the AI value. So right now, neither of that is visible. So that's the setup, but it's been one wild week. Prashant, we spoke about, the IT space from here on, but talk to us about the other themes that you're incrementally very bullish on.
Certainly. So if you've seen the portfolio where we are finding greater opportunities, and some of these have been more structural, like healthcare, we've always tended to find more opportunities to invest in because the nature of the sector is such. There are, first of all, unlike energy, for example, where there are barely a dozen names, most of them very large cap. In healthcare, and if I were to expand it to chemicals, there are hundreds of names, small and mid caps, a large variety of businesses, a heterogeneous variety of businesses with different management capabilities. And obviously, we have a very strong team that's able to identify those alpha opportunities. And so we've always had a fairly outsized allocation to healthcare. That remains so. Healthcare, chemicals, I'm putting together.
Healthcare means pharma, you're saying?
Pharma, hospitals, diagnostics, across board. Now, if you look at some other areas where at this point in time we are finding more opportunities, NBFC space in particular, those exposed to lower end of the credit spectrum, secured or unsecured, these companies were beaten up very badly because of the problems that we saw in the unsecured end of the market, and then the oil price spike was again thought to have weakened that segment of the consumer. Now oil prices have pulled back, so some of these stocks have also rebounded, but still the valuations, we believe, for many of these are very attractively placed, and the team has found some opportunities there. In industrials space as well, select industrials are very wide catch-all sector, but certain areas like defense, we continue to find good opportunities in private sector space as well in defense. In capital goods / machinery, we continue to have good exposure there. So these would be some of the areas. New age economy, some of the names we've always been somewhat higher allocated than the market in general. So those all continue to be where we find opportunity.
Lenskart, I think you all participated in the block deal that took place. I remember reading the name of White Oak Capital and even Corona Remedies. Because when we were chatting with the management and we spoke about how Sepia sold, in the buyers list was also White Oak Capital. So that comes in the pharmaceutical space.
Several names I think in this space that we have participated in of late as well in block deals or otherwise from the market.
Just one quick thing on NBFCs. You're talking about the larger names or?
So see, what were particularly beaten up was some of the smaller names. Yeah, the larger names, yes, they might have underperformed, but the valuation disparity had become quite extreme in these smaller NBFCs. So that's what.
Small isn't very small, because we've spoken to a few in the 10,000, 6,000 crore AUM range.
Yeah, so those I would term those as small.
Yeah.
Very small would be maybe 2, 3, 4,000 crores.
So in that basic.
I think the smaller you go, the greater the dislocation was, I would say.
And growth rates there, because they are small, I mean, they're all growing at 30,
growth rates
35%.
can be, but again, there are a lot of those names which have been a micro cap for very long and might remain micro cap for very long, because every cycle they, are able to mismanage themselves. Yeah. So execution is of paramount importance over there. So it is, because in NBFCs there are many dozens, if not more than 100 names in that small end spectrum. So we might have half a dozen out of those.
Okay, stay with us, Prashant. Just taking a quick commercial break. Coming back, more market conversation with Prashant Khemka.
Welcome back. You're watching Editor's Roundtable. Prashant, the other big theme, particularly on Friday, was the correction seen in many of these transformer names, Hitachi Energy, GE Vernova. Have you all been riding the up move in them? Where do you stand right now?
Yes, I think not necessarily these particular names, but as we do have exposure in the portfolio to names that are beneficiaries of AI. And over the last couple of years, they've benefited tremendously. And on a day like today, you are going to take a hit. So it's very tightly correlated to the global moves.
Yeah.
And when you see big downswings like yesterday in US market, in AI capex related food chain, you are bound to see the ripple effects in Indian market as well.
You briefly spoke about financials and within that the NBFCs, but what's your broad take on, say, private banks versus the PSU banks? We keep asking a lot of experts because of the big divergence in performance in the last 4-5 years.
Certainly. So see, it also is a function, the divergence is also a function of where we started 5 years ago with the benefit of hindsight. But on the whole, if we were to, and our global financials analysts, when they present to us the global comparisons, I think India financials relative to global financials are at their lowest relative premium. We always have traded at a premium for good reasons. So I would say they are at their lowest relative premium. So in that sense, the overall valuation of the overall financial sector lending side has derated quite materially compared to other emerging markets. Within that, we don't have much of a strong view between PSU versus private. We always tend to be in the portfolio, have much higher allocation in private.
Okay.
So if I were to broaden it to financials more generally, let's say balance sheet financials, not capital market players, which I forgot to mention earlier in the areas where we have a lot of allocation. So that continues to be the case with capital market intermediaries. But more broadly in balance sheet financials, we have more of these NBFCs that I mentioned about.
Anything else? India outside, because you have a global perspective and you invest everywhere else as well. What's looking hot? So much happening, right, Prashant? It's an exciting time to be.
Actually, what may
an exhausting time to be tracking global
markets.
It
is very, very exciting time to be investing. It always is a very exciting time. And when you have such massive leaps in technology and the impact it might have on the real world, which is what is expected out of AI, remains to be seen whether it does bear out. It makes it all the more exciting.
How's the private investing coming along? Because you have a fund.
Certainly. Oh, that's very exciting. I mean, the number of entrepreneurs in India, one of the things that I've always believed what sets India, separates India from many of the other countries, not all, I would say you see something similar in the US, you say something similar in some of the other markets like China and all. Just the entrepreneurial energy is amazing here. Despite all, in face of all odds, I think you find
so you must be getting pitched all the time. So tell us, tell us which, because we keep complaining about how there's lack of innovation and this and that and all of that stuff. But the point is, it doesn't come up to us. I mean, we speak with listed companies, so by nature are older companies, more established, traditional sectors. So on the private side, I mean, where do you see what kind of industries are seeing?
So maximum number by opportunities is definitely manufacturing. And has been for the last couple or 3 years.
What kind of manufacturing?
All kinds, from manufacturing a simple tube to manufacturing components that fit into, let's say, oil rigs or thermal power plants, to precision engineering across the spectrum. Yes, one of the things that, though I think India, and I think it comes in stages, is original equipment, intellectual property driven, are far fewer. I'm not saying they're not there, but far fewer. Would love to see over time more of those come through, and not just in manufacturing, but more of them come through across industries.
So manufacturing is this big kind of sort of
at this time. Chemicals also, chemicals, healthcare also, we see quite a large number. And then in consumption, new age economy, there obviously it's a vibrant area there. So these are some of the areas. Financials as well, fintechs or NBFCs continue to be there. You don't see many in refining and oil, obviously. So some of those sectors you don't see much. But defense is another one, large number of companies, which is fantastic to see. These were, the opportunities for entrepreneurs weren't there a few years ago in a space like, say, defense. Despite the country spending, being the largest spender on defense imports.
But that's
in the
obviously
world.
changed, right? The government's view towards private as well. I mean, they're shifting from public to private. So
absolutely, that's why it's fantastic to see that translate on the ground. So many entrepreneurs doing such fantastic jobs. So what the industry would look like in 10 years from now would be very, very different from what it is today.
Okay, thank you. Prashant, one final. Who are you cheering for to win the FIFA World Cup?
Well, not a big follower of
football analogies.
Of football. I'm not. I usually just watch the finals, but I am on a college Latino group. They supercharge themselves every 4 years, and right now it's that stage. So I'll have to keep up with. I'll have to take a check. Who might say Germany after Germany's already exactly. That's what I'm saying. So I don't want to goof up by calling a team which is already out.
Okay. All right. Thank you. Thank you very much for joining me.
Thank you, Prashant.
Thank you.
Well, with that, it's curtains down in this edition of Editors Roundtable. Thank you very much for watching.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty gain for the fourth straight week. Real estate, pharma, defense stocks lead the rally. Bank stocks underperform. Iran slams Washington for displaying complete contempt of peace in West Asia. Warns that Iran will respond if US and Israel don't honor their commitments to end the war. Millions expected at long-delayed funeral of slain Supreme Leader Ayatollah Ali Khamenei.
This is not a war per se. This is the de-nuking of Iran. You can't let them have a nuclear weapon.
President Trump defends Iran's strikes, calls it de-nuking of Iran, tells CNBC Fed Chair Wash faces a hostile board, adds he still wants to fire Lisa Cook from the Fed board despite the Supreme Court barring him from doing so. He says he feels bad that the presidency creates a conflict of interest in any of his children's investments. The government allows 4 Chinese power equipment makers with factories in India to participate in government tenders. The exemption applies for a 2-year period. Shares of CG Power, Hitachi and other local power gear manufacturers down in trade today. Petrol blended with 20% ethanol causes only a minor mileage, says the Petroleum Minister Reddy. Adds that the public has no reason to fear. Also says a make-believe narrative has been unleashed on social media in the past few days. The government, in its first public response since issuing a notice to WhatsApp, says usernames could facilitate more cyber crimes. IT Secretary says WhatsApp plans to roll out username feature, raises serious possibilities of impersonation. The government has already directed the platform not to roll out the feature till consultations are over. The government orders the removal of 3 Chinese battery management apps after they were misused to remotely disable e-rickshaws. Multiple viral videos showed users switching off the battery discharge function, leaving e-rickshaws stranded on the roads. Tesla reports record sales in Q2 after a sharp rebound in Europe. This raises hopes for the company to report annual growth for the first time in 3 years. The Bengaluru police arrest 1 woman caregiver over alleged child abuse at the on-campus daycare facility of IT firm Capgemini. Police are investigating 4 other suspects after videos showed physical and mental abuse, and that video went viral. Portugal's World Cup journey continues as it edges past Croatia in a nail-biting thriller. Croatia suffer heartbreak after VAR rules out a dramatic stoppage time equalizer. Spain sweeps aside Austria to cruise into the round of 16. Switzerland defeats Algeria to register its first ever knockout stage victory at a World Cup. Well, let's start with the day's market action, and the markets closing in the green with the benchmark indices outperforming the broader market today. The Sensex and the Nifty closed in the green for the 3rd straight session, and for the week the Sensex and the Nifty posted gains for 4 straight weeks. That's the picture for today. 100 points higher in the Nifty, the Sensex up 260. Nifty Bank underperforming, closing in the red but flat. The Nifty IT continued its upward move. For the week, the Nifty up about 1%. Similar story for the Sensex. Mid-caps up by about 0.5%, and the Nifty Bank down by about 0.5%. Prashant is standing by now to wrap up the market action for us. Prashant, a decent week for our markets. What can we now expect for the week ahead?
Well, it was not a bad week. We managed gains on Friday, off the highs by quite a bit on the Nifty. So Friday to Friday, that is for the week as such, the Nifty ended about 0.9% higher. Actually, the 2 areas which did well was the Nifty and the small cap part of the market. The small cap index was up 2%. The Nifty was up 0.9%. The Bank Nifty was down about 0.4%, and the mid cap index was up about 0.4 odd percent. So the Nifty was up 1%. Small cap index was up 2, 2 corners, very large and the small cap really participating this week. Makes sense to look at the week gone by sectorally. Real estate bounced back strongly, 7.5%. Pharma and healthcare were the other indices. That is the pharmaceutical companies and the hospital companies, 3% on those indices. The Nifty PSU Bank was the one index which actually was down by about 2.5% and 3%. And the big swing really came through on the IT index, right? So Monday and Tuesday, actually Monday, Tuesday, Wednesday, the Nifty IT index sold off 6%. And then over Thursday and Friday, the Nifty IT index went on to recoup all those losses. So basically ending slightly up for the week. That is the Nifty IT index. Now let's get to the large caps, right? And this is all weekly change. Eternal 10, Bajaj Finserv 7.5, Adani Enterprises, Bajaj Finance, Maruti, Adani Ports. This is all in the 4.5% kind of a range. On the downside, L&T was down about 4.5%. Aisha was down about 3%. And you also had a HDFC Life, which was down a little bit. Now, let me come to the broader market. And I'll start with what was up. Chempro was up almost 20%. Sumitomo Chemicals was up 17. Aegis Logistics was up 16. Zydus Wellness was up 15. Zensar was up about 50% or so. But, I can go down the list of names, and I think there are at least 15, 16 companies with more than 10% gains this week.
Decent week indeed, Prashant. Many thanks for joining us. Let's talk about the macros. Now, India services activity slowing to a 17-month low in June as domestic demand softened and hiring stagnated, according to the HSBC India Services PMI, down to 57.4 in June from 59.8 in May. The moderation in services activity was driven by the slowest expansion in new order intakes in nearly 3 years. The big interview of the day, and it is a CNBC exclusive. U.S. President Donald Trump defended the country's military action in Iran. He called it a de-nuking of Iran. In an exclusive interview with CNBC's Joe Kernan at the Oval Office inside the White House, Trump defended his children's business dealings, which have come under scrutiny over the last few days. He said he felt bad that the presidency creates a conflict of interest in any of his children's investments. That's not all. Fresh off the release of a massive financial disclosure showing the president made more than $2 billion in 2025, Trump said his son Eric handles his finances along with large financial institutions. When asked whether the stars had aligned for Kevin Walsh when it came to cutting interest rates, Trump said the new Fed chief faced a little hostile board.
Well, he's got a board that maybe is a little bit hostile, and, unfortunately, and maybe a board that wants to do the wrong thing, so I don't know. He's a great guy and a great pro, and I know where he'd like to be, but he has to do what he has to do. I really think that I would love to be able to get back. In the old days, probably maybe before you started thinking about these things, but if you go back 20 or 25 years, when you announced great numbers, the stock market went up. When you announced bad numbers, the stock market would go down. Today, it's the opposite. When you announce good numbers, the stock market goes down, sometimes really way down, depending on how good. The better they are, the more, because they have this phobia, they have this horrible derangement syndrome about inflation. And growth can be good for inflation, not just bad for inflation. And it's a shame. Anytime numbers are announced that are not so good, I wish I could flip it the old way, that when you announce great numbers, because otherwise it's almost like they want to kill strength. They want to kill success. You announce good numbers. I want to, you have a couple of countries. India is one, doing very well, but it's at 7-8%. Others, take a look at Japan's numbers. I mean, they're doing very well. She's very good. She's doing a good job, a friend of mine. But they're allowed to go up. We're not allowed to go up. If we go up, they want to kill it. There's no reason we should stop at 4%. We should be at 12% and 13%. I feel badly in a way for my kids, because every time my kids do, if they invest in a stock or if they go and do a bill, anything they do, because the presidency is so powerful, so big, everything, if they buy a cupcake company, well, the energy to make the cupcakes is, sort of like, how's my energy policy? So therefore you have a conflict. Almost anything they do, if they want to buy a truck, if they want to buy, if they buy an energy efficient truck, they have inside information. It's pretty tough in that sense. I tell my kids, stay away from as much as you can stay away from, but they also have a life. I don't do anything having to do with my business. My kids run it. I put a lot of money. I had a lot of money, and I have a lot of money, and I've made money. I'm a business person. I'm a really good business person. I've made money. I've made a tremendous amount of money, more than I would have ever thought I would have made. And I let people invest it. I don't even know who they are, but it's given to big firms like that are on your show all the time. My son Eric handles it. I don't talk to him about things such as this.
There was a large sum of money made in crypto. Did you know that your family business was going to engage in crypto? Did you have anything?
Well, I was there before I was in office. But the way I view crypto is a little differently. We have to be at the top, otherwise China's going to take it over.
Well, that's President Trump. In West Asia, Iran slammed Washington for displaying complete contempt for peace in the region ahead of the funeral of former Supreme Leader Ali Khamenei. Here are the latest developments. Iran's top negotiator, Mohammad Ghalibaf, has warned that Tehran will respond if the US and Israel do not fulfill their commitments to end the war. He also told regional allies to draw clear lessons from the war on Iran and work towards peace and security in West Asia. Meanwhile, the New York Times reports that US officials believe Israel may have plotted an assassination attempt on Ghalibaf and Foreign Minister Araghchi. The report also says that US officials informed Gulf states to convey security threats to Iranian officials during negotiations. In the oil market, Brent crude remains at $73. As shipping traffic in the Strait of Hormuz continues to recover, according to maritime intelligence firm Windward, nearly 8.5 million barrels of crude has transited through the strait on the 1st of July. Negotiations between Iran and the US have been paused until former Supreme Leader Ali Khamenei's funeral. Foreign leaders are expected in Tehran for the week-long funeral. An Indian delegation led by Bihar Governor Syed Atta Hasnain and Minister of State Pavitra Margarita are on their way to Tehran to pay their tribute. Congress leader Salman Khurshid and PDP leader Mehbooba Mufti will also attend the ceremony.
Iran's late supreme leader Ayatollah Ali Khamenei's coffin was unveiled in Tehran on Thursday. Khamenei was killed in US and Israeli strikes during the outset of the war. Now, Iran's ruling clerics are preparing days of mass funeral rites, hoping to turn Khamenei's death into a massive public show of support for the Islamic Republic. They hope to mobilize millions of supporters to flood Iran's cities, laying on transport, accommodation, and food to proclaim the might of their theocratic state. In Iran's theocratic system, Khamenei was not only the head of state, but also the earthly representative of Shiite Islam's 12th Imam. So, for his supporters, his death in an enemy attack carries powerful symbolism, drawing on Shiite traditions of martyrdom and mourning. Authorities say the funeral events will demonstrate the nation's unity and resilience after the war. But analysts say, behind the veneer of unity and devotion, public support for the Islamic Republic has worn paper thin, after years of economic hardship, sanctions, and periods of anti-government unrest. Following ceremonies in Tehran, Khamenei's remains will travel to the holy cities of Qum and Mashhad, with additional commemorations planned in Iraq before his burial next week. Security will be tight, with temporary airspace restrictions in place over Tehran and other cities, and threats of a powerful response if either the United States or Israel resumes attacks.
Back home, shares of CG Power, Hitachi and other local power gear manufacturers declined in trade, and this was because the government has allowed 4 Chinese power equipment makers who have factories in India to participate in government tenders. The exemption will apply for a 2-year period. Vinny joins us now to explain the impact on Indian companies and, of course, some others like GE Vernova. Vinny, what does this now mean?
When you talk about, the latest update that has come in, and this is obviously we're picking up from brokerages, the Ministry of Finance memo that has been come in. The government has given exemptions under the public procurement order, and the Ministry of Finance has said that they are granting a 2-year exemption for 4 following Chinese companies. One is Nifty Energy India. That was already there. We'd spoken about this before as well. Since Jan, we're seeing these news flows coming in. So yes, that is one. Then we have Nanjing Electric, we have New Northeast Electric Company, as well as Taika Electric Company, which are the 4 companies which are getting this exemption for a time period of 2 years. There's a condition that comes in that there should be 50% minimum made in India, locally made products are included in the manufacturing of this as well. Now, what is the view coming in from brokerages? PL, the view from PL Capital is that these companies were previously catering to large private developers. So the exemption could increase competitive intensity in the small and medium transformer segment companies. That could see a short and medium term impact for these smaller players. The exemption is likely to cover critical transmission equipment, including bushing, insulators, circuit breakers, power transformers, and GIS switchgears as well. They said that the exemption is not expected for the HVDC side. So HVDC projects, we're not expecting any impact coming in here, and a lot of Indian transformer companies have been focusing on the HVDC side of the projects. A lot of tenders are coming in on that front as well. So that is not expected to see an impact. Competitive landscape surely is something that will see an increase, and overall impact will come in slight bit in the terms of the sentiment also for these T&D players in terms of pricing. That's the view from PL Capital. Also IIFL, they said that this move was something that they were not expecting. We knew about TBEA getting this exemption, but these other companies are something that was not as expected as one was that has come in terms of the memo. Domestic pricing is at its peak. Chinese competition obviously flagging, and competition increase from these Chinese players as well. And they said the direct impact would come in for transformer pricing, largely for standalone transformers. And they highlight some of the companies like Hitachi could see a bit of an impact as well.
All right, Vinny, many thanks for joining us. Petroleum Minister Hardeep Puri says ethanol blending may affect mileage, but added that many other factors also played a role. Speaking to reporters yesterday, Puri said that there is enough space in the market for all fuel systems to coexist.
Somebody is saying that fuel mileage is going to be dropped. It's now well established that when you have ethanol, they use it in racing cars also. The acceleration increases. What is that thing called? The knocking. That improves. Mileage, yes, it may drop a little, but it may drop a little. Mileage can drop a little because of various things. If you're driving from here to Gurugram, and if you follow the route I follow, then there are many points at which there are toll bridge, other things. So calculate that. So we've been very open about it. My response to that is there is enough space in the growing Indian consumer market for all systems to coexist.
Well, that is the oil minister defending the move towards the adoption of E20 fuel. Shares of PB Fintech crashing in early trade. This after more than 1 crore shares, equating to nearly 3% of equity, changed hands on the bourses today. Sources tell CNBC TV 18 the Temasek-backed arm is a likely seller. The seller will be subject to a 60-day lock-in period on its residual stake. Adani Enterprises has increased the size of its qualified institutional placement to 15,000 crores. The company decided to upsize the offering after receiving bids worth nearly 38,000 crore rupees. That's about 3.8 times the original issue size. The group set the indicative issue price at 2,880 rupees per share, which is 10% lower than today's closing price. Coca-Cola has called for pitches from investment banks for the proposed IPO of its Indian bottling arm. Rachna joins us now with more. Rachna, an IPO for Coke's Indian bottler?
Absolutely, and the race to manage what will be India's biggest consumer listings has officially begun. Sources tell CNBC TV 18 that Coca-Cola has called for banker pitches for the IPO of its Indian bottling arm, Hindustan Coca-Cola Beverages. Now, sources also tell us that formal presentations, the pitches, will happen in London on the 9th and 10th of August. Also, what we've learned from our sources is that Rothschild is the advisor on this transaction, and from the global pack, JP Morgan, Morgan Stanley and Goldman Sachs have been called in. From the domestic pack, there will be JM Financial, Kotak, Access, IIFL and ICICI Securities. Sources also told CNBC TV 18 that the company is looking to raise $1 billion at a valuation of about $10 billion with this IPO. Now, why does this matter? Hindustan Coca-Cola Beverages is Coke's largest bottler in India. This is the company behind Thums Up, Sprite, Maaza, Limca, Minute Maid and Kinley. It runs 14 plants across 12 states and serves over 2.3 million outlets. Remember, the Jubilant Bhartiya Group already owns 40% of this business, and that deal closed last year at roughly 11,700 crore rupees. And Coca-Cola will stay invested with a significant stake even after the listing. So the management of Coca-Cola had confirmed that the listing would be in 2027, and with this being the first step, the process has now begun.
All right, Rachna, many thanks for joining us. The government, in its first public response since issuing a notice to WhatsApp, says that usernames could facilitate more cybercrimes. Now, earlier this week, the government directed the platform to pause the rollout of the new username feature in India. IT Secretary S. Krishnan says WhatsApp plans to roll out the feature raises serious possibilities of impersonation, and hence the notice. Take a look.
We have taken up the issue of using usernames because there is a serious possibility of impersonation, and there is the kind of encouragement that it provides, or the facility it provides for committing more cybercrimes, which is a very serious issue. This is another dimension of the way that cybercrimes can be committed, which is the reason why we have directed WhatsApp to explain why they have this feature, and likewise we have similarly sought explanations from others.
Well, that is the IT Secretary there. We'll head into a break, but up next, the government orders the removal of 3 Chinese battery management apps after they were misused to remotely disable e-rickshaws. That and more when we return. The government has ordered the removal of 3 Chinese battery management apps after they were misused to remotely disable e-rickshaws. Multiple viral videos showed users switching off the battery discharge function, leaving e-rickshaws stranded on the roads. Abhimanyu joins us now with more. Abhimanyu, take us through what exactly was going on with these apps and what is the decision that the government has taken.
You're traveling on an e-rickshaw and someone shuts off the vehicle using just their phone. Viral videos are blowing up, showing people prank stopping moving e-rickshaws from as far as 15 meters away. It looks like magic, but it's actually a major security flaw. Here is what is actually happening. Bat BMS, an app developed by a Chinese tech company to monitor Bluetooth-enabled lithium batteries which check health parameters and voltage, has a kill switch. Now, this is a feature which can turn the battery's power output on or off. It exploits the flaw with cheap, unbranded e-rickshaw batteries which are being shipped without any password protection. The result, anyone within the Bluetooth range of 10 to 15 meters can pair with the vehicle's battery and instantly cut off its power output. Now, this is not just a prank, since there is a large danger involved. Stopping a loaded e-rickshaw mid-traffic is a massive accident risk, which brings us to the question if EVs are safe or not. Now, if you own an electric scooter, bike or car from a major brand, there is no reason to panic. Established EV makers use secure, encrypted battery management systems, which means that this flaw is almost entirely limited to low-cost, unbranded e-rickshaw battery packs. The Indian government has already taken note of this situation and has stepped in, and MeitY has banned 2 apps linked to this remote shopping trick. They are actively working with app stores to block similar apps from popping up and interfering with operations of e-rickshaws. Meanwhile, if this happens to you or a driver you know, here is how to reboot. Start with turning the battery's main circuit breaker or the MCB off. Wait a few seconds and turn it back on. Then open up your Bat BMS app, reconnect and manually re-enable the discharge function. Most importantly, change the default Bluetooth password immediately so that no one else can connect.
Well, that is a serious challenge, and rightly that the government has acted on it. Abhimanyu, many thanks for joining us. With that, it is time for us to wrap up this edition of Business 360. Do stay tuned to CNBC TV 18. The news will continue right here. We're back in a moment.
Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host Surabhi Upadhyay, and if you have been following the show, you would know that we have been marking the International Day for Insurance Awareness right here on Let's Talk Money. Very, very important milestone. Usually these days become a talking point to at least have that conversation, out there in the open. And the conversation around having proper and adequate insurance is always a very, very important conversation. Always one worth having and repeating time and again. So last week, it was all about general insurance. Today, we are putting the spotlight on life insurance. And mind you, here we're keeping it very simple. We're not talking about insurance and investments and a lot of other plans. We're keeping it very, very simple. Having the right policy that will ensure that your loved ones are well taken care of, your liabilities are well taken care of in your absence. Well, I have with me Amit Chhabra, Chief Business Officer at Policy Bazaar, joining in, and also Mr. Satishwar B. Of Bandhan Life Insurance. Gentlemen, thank you so much for being here. First of all, I must wish Happy Insurance Awareness Day to both of you. Mr. Satishwar, I want to open with you because life insurance, as we know, is a product that we all need, we all know. But I want to start by getting your thoughts on how not investors, policy buyers. See, that's what comes to mind. Right now, I'm going to use the term policy buyers. How policy buyers are evolving. What are the lessons we've learned from COVID? And where the market is today.
So, first of all, thank you for having me here. And it's a wonderful initiative on improving awareness. And the biggest task was done last year when the government basically got an exemption, GST exemption on the life insurance, right? Kind of saying it's an important product to have. So, as an industry, the awareness has been continuously doing. So, two major events which has actually helped us. One is, of course, COVID. We saw an immediate spurt in the need for life insurance, kind of basically saying something can happen or anything happen anytime, right? And the family needs to be protected. So we saw a nice spurt, but it kind of, the fear went down, it kind of came down. And we currently again saw a nice interest coming up post the GST exemption, right? Which is basically kind of saying 18% discount. But the larger message, which I gathered from that, was basically it got into a lot of people's dining table discussion, right? Basically saying, an insurance premium being exempt from GST, it kind of drove a message saying it is an essential item to have, it's an essential service to have, it's an essential product to have, right? So that kind of helped. The awareness, wonderful. I think it has increased a lot, especially people, the nuclear families again, right? Overall, wherever they've started understanding that they have dependents and they need to kind of ensure that they are protected. The family is protected in case of any untoward incident which is happening. So that has come through.
So life insurance in India over the last so many decades has always been sold as a bundled offering, that it will protect you, it can also help you grow your wealth. But term is a very different conversation, and that's only come up in the last few years. So what is the rate of growth in terms of pure protection? Are people adapting towards it? At what rate? And how big is the term insurance market now?
No, so if you actually look at the number of policies there, so what we do is end up comparing it in terms of the premium number. So a savings premium will be naturally higher because there's a savings component attached to it. Term is a pure, it's a fee that you pay. For example, in the common current Gen Z language, it's a subscription, right? It's a kind of a subscription that you pay for ensuring that the earning replacement happens. So it's an earning replacement product. That's a word which I use, saying in case the earning member is no longer there, the earning still continues to come to the family. Right? The family is protected. So it's a subscription that you pay to take care of that. We have seen a good 15-20% kind of a CAGR as far as the number of policies are concerned. Okay. So quite a few people are interested. The awareness has gone well. What is still lacking is the adequacy of it. Okay. So you buy it once at the very early stage. Naturally, you are not at the peak of your career, quite possibly, or even it's a very early stage of your earning. Right? So you buy one, but you kind of then
forget about it,
top it up, or so which is good. Something is better than nothing for sure. But I strongly believe the adequacy is something which is still kind of lacking.
Okay, Amit, come in on this at the Policy Bazaar platform. What is the growth in term plans? Who's buying it? Is there any geographical sort of trend that you've picked up over the last 2-3 years?
So historically, Surabhi, what has happened is it's mostly the salaried people who've bought term insurance, young salaried people, say less than 45 years. And, I work at an organization. I want to make sure that my family is protected if something happens to me. That was the traditional, I would say, the way of buying term insurance. However, now that is evolving. What we're now seeing is a lot of newer segments are coming in. So what we're saying is, for example, a lot of self-employed people are now buying term insurance. And there was a problem in, giving income documents, for example, because India is, that country. But now more and more people are able to take term insurance. So self-employed people who are rich, who have all the wherewithal, but they never thought of term insurance. So that is one. Second, we have seen an interesting category coming up, that's housewives. So that's basically people buying for their spouses who don't have income, but you want them to be protected as well. That was again a category which was never touched.
Housewives buying term insurance?
Yes, either themselves or their spouses buying for them.
For them,
but they are buying increasingly. The third interesting category is NRIs buying term insurance in India. So I live in Dubai, or I live in Singapore, or the US. But I buy term insurance in India. The reason is because one, my roots are in India, and eventually a lot of people, for example, in Dubai or Singapore, they will come back to India eventually. So they want that when they turn old, at that time their insurance is in India and not in some other country. Secondly, term insurance in India is cheaper as well. So it's a good opportunity in that sense. So a lot of newer categories have opened up, and to Sir's point, also adequacy started to improve. So what was 1 crore 3 years back is now getting to 2 crores. So the average sum insured is now, I think, it's close to 2 crores now.
That's what I was going to ask. So most popular sum insured plans would be around the 2 crore plans, is
the
it?
average is about 1.5 right now.
1.5 crores.
It's split between 1 and 2. And it's going up. It's going up as inflation increases, as the incomes increases.
Lifestyle, all of that.
That is happening. So there is an evolution definitely that has started to happen. The last thing I would say is, as a trend, is that more and more people are also looking to buy plans where you end up paying upfront rather than paying through the lifetime of your policy, which means that, so let's say if I buy a policy where I have to pay for 30 years, then either I can pay for 30 years, month by month or year by year, or I can actually finish off my premium in the next 5 years. The benefit of that is, if you're earning right now and if you have the capacity to pay, it's better to pay now versus, let's say, when you're not earning at that time, to be paying premium becomes tougher.
So give me an example of, it could be any insurance provider, where what will be the cost if you're saying taking this upfront option versus an annual payout? And you can take the example of a prototype, maybe a 30-year-old who's looking to buy insurance.
Yeah, so typically the way to look, like I'll give you my premium example only. So I have a policy for about 40 years of a tenure, and the premium that I pay is about 4,000 rupees a month. Now this 4,000 rupees a month will, over a 40-year period, I will end up paying, let's say, amount X. If I end up paying in the first 5 years only, the total premium paid in the first 5 years versus over the duration of those 40 years, it reduces by almost 40%.
Oh, so you end up paying 40% lesser premium?
Over a period of time.
Cumulative.
So, yes. So here in the first case, I would have paid every month for the next 40 years. Here, I would pay only for the first 5 years. The cumulated amount will be much lesser. It will be significantly lesser, but I'm paying upfront. So the people who have the income right now, they prefer to pay it now because I don't want in the future when I'm not earning, the burden of premium should not come to me.
Fair enough. So that's one of the options that we can definitely consider. We have to take a break now, but we come back and make it even more granular. What are the questions to ask when you're out in the market shopping for a term plan? What are the chances of you getting a very comprehensive cover? All of those details discussed after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And as we mark the International Day for Insurance Awareness this week, it's full spotlight on life insurance. And life insurance in its purest form, pure protection, which is term insurance. So we, of course, have Mr. Satishwar B of Bandhan Life with us. So my question is very simple. Now, let's say that you're in your 30s, mid-30s. That's when you hopefully start getting a little more mature in life, right? And you realize that, okay, I'll have dependents at some point, maybe parents, maybe children, maybe a spouse. And you start thinking of a term plan. What all should you consider? What are the questions to ask? And from an insurer's perspective, we also want to know your side of the story. That are you likely to give the policy to someone who's a salaried person versus someone with business versus someone self-employed, very erratic, business or revenue sources? How does it work?
So let me first come from a customer perspective. Right? What you need to take care of. The core of this product, okay, the simplest form of life insurance, it's the most simplest form. You basically pay a premium. Something happens to the policy holder, which is specifically death in case of life insurance. The family or the dependents basically are taken care of as far as the income is, because it's an income replacement product. Okay. So it basically takes care of that the earnings continue to come for the family. So the adequacy of the cover should be something that is able to replace that income.
Sure.
Right. Now there can be a wonderful mathematics to it, but the simplest form which we say, and we can't go wrong, 99% you will get it right, is looking at it, if you are younger, look at it at say 20 times or 25 times your current income, which also takes care of inflation, plus gives the family a good 15-20 years to come back to the normal scope of life.
So roughly 20 times your annual income.
Yeah, if you're younger.
Okay, if you're a young person.
Or if you're above 40 plus, ideally that's too late to buy a life insurance product, but still better late than never, right? In that case, a good 10 to 15 times. The other rule is basically it's supposed to be taking care of your earning age. So assuming that you will retire at age 60, 60 minus your current age, that's your multiple.
Okay.
So that's another way of doing it.
That's the math.
So adequacy is the most critical one.
Sure.
So you need to take care of that.
Okay.
Right? From an insurer perspective, as I said, it's an income replacement tool. Right? And it's an uncertain event. So we know that death is uncertain. These are the two things that we always check whenever we buy a policy.
Yeah.
So we need to know what's your current income. So somebody who's earning, say, 3 lakh rupees a year, I can't give him a 3 crore cover. Right? It's basically kind of an anti-selection. It's not, because it's not an income making tool, it's an income replacement tool.
True.
That's the reason there is a financial underwriting that we do, which basically takes care of understanding what's your current income. And naturally you will take care, kind of consider
your
the inflation
living
part.
expenses have to then
More
be
than the expenses, we are basically saying what's your income.
Yeah,
right? What's your current
assuming your
earnings?
living expenses should be, commensurate to the income, because
Again,
that's how it has to be.
Coming back to it, so basically expenses has to be commensurate.
That's what.
Right? I will have to spend within my means.
Absolutely.
So we are actually replacing the means in case if that means stops. And that's the reason income. So it has to be an income replacement product.
So,
right? So the estimate of income is what we want to do. And two, it's a healthy guy. What do I mean by healthy guy? That I am not aware of, I am currently not suffering from major illnesses. And when I'm saying major illnesses, we are not talking about flu or something like that, right? It's kind of a critical illness which is not being said. So these are the two pieces that we do. One is financial underwriting, which to estimate his current earnings. Two is whether he's healthy.
Yeah.
From this perspective, salaried, non-salaried, as he said, self-employed, that's a segment we actually got in.
Professional, exactly.
Correct.
It could be so many different
So we
segments.
introduced self-segment as a specific focus, self-employed segment as a specific focus, because there was a struggle in terms of getting life insurance. It was a supply side issue as an insurer, because we were wanting to understand what's your current income is, and that was finding. But with all this new digital age, right? So everything is happening through, say, your UPI based thing, or you necessarily have a bank account, and various other pieces, which has currently started giving me a wonderful, without getting into too much of documentation, an estimate of the income, right? That has actually opened up that space. So what we want, your current estimated income, various ways of doing it, whether the customer is a salaried guy, steady income, a self-employed, a little wavering, but over the years we still know the kind of income that he can generate. So that's one, and a healthy thing.
So now, I want you to put some rough ballpark numbers or maybe some examples. And I mean, with the caveat, this is only an example. Say a 30-year-old comes to you. Now, here's a 30-year-old, no pre-existing diseases, no known ailments, has a certain income, say, is earning maybe 12 lakh rupees a year. Now, this individual wants an insurance cover versus a 30-year-old comes but has already developed, say, a hypertension or some kind of a ailment, but yet also wants to buy, term cover. Then how does the whole math change in terms of the kind of cover, the pricing? Some ballpark estimates will help.
So the cover still remains the same.
Okay.
Okay. So basically saying, so giving my example or the example which I normally try to do, take till age 60, 60 minus 30, 30 times your current earnings. So 30 into 12 is the kind of sum assured that he should have, right?
Okay.
The cover he should have.
Okay.
Now the guy, whether he currently doesn't have any health issues versus existing health issues, the premium goes up a bit. Right?
Okay. What is a bit?
It can range from a 10% to a 40%.
Okay.
Based on how
The health
bad
conditions,
the situation is and how are you taking care of it.
Okay.
So we also, in the sense, I am aware of it, but I'm doing nothing about it, right? Naturally, the premium goes up. But I'm aware of it and I am taking care of it, right? It's much under control. Right?
Okay.
That basically also brings down the premium. Because these are health or basically saying the example that you gave in are lifestyle issues.
Yeah.
If you manage it well, it can be controlled.
Sure.
Right? Because as a life insurance company, you're taking care of death. In case of health insurance, it might be a little different. But in case of life insurance, it's the death piece. So if you're basically showing more signs of managing it pretty well, we actually have
Just
models.
curious, how do you track that? Whether there's a 30-year-old who's becoming very responsible, improving his or her lifestyle to manage that condition versus someone who's telling you on paper.
The medical record does tell you that.
Okay, so the medical records.
Medical records and now, for example, HbA1c, which basically gives you the last 6 months average, right? And then you also do a current one.
Correct.
So there are various means of doing it.
Enough
But
medical
these are-
testing.
So if you are taking care of yourself,
Yeah.
the premiums naturally are much lesser.
Okay.
But there are clear signs saying you are not, then it becomes a little difficult.
Okay, got that. So that's helpful framework. Now we understand how, an insurer thinks about these things. Now, Amit, let's come back to the customer. So when the customer goes and decides, I need to buy a term insurance plan, we've discussed the adequacy part of it. There are a lot of other features as well. What all to consider? There are these riders you can add on. So just build the whole package for us.
I think just before the riders, one more important decision is till when do I want the coverage? As I was saying, should I only get the coverage till, let's say, till I'm earning, which is, let's say, 55 or 60 years of age? Should I get a whole life cover, like till whenever I'm alive, there is cover and then there is sort of a guaranteed payout in that sense? That is one more important decision point, and there are pros and cons. A lot of people look at it, in different ways. But deciding that age till when I will be covered is one important factor while buying a term insurance policy.
And I'm glad you brought this up because now there are policies which give you your premium back if you outlive the policy term. And there are some interesting exit options as we were discussing just before the show began. So just throw some light on this.
So there is a concept of return of premium, in which case, let's say if I have a policy till 60 years of age and and I don't die, then I get the entire premium back. It's called term return on premium, which means everything that I had given to the insurance company, that comes back to me.
Okay.
Typically, the premiums are slightly expensive than the regular premiums, but then I get my money back.
You're assured that this is not wastage, like some people think. That
unfortunate, but that's how a lot of consumers do think. So this is one option. You can also look at a whole life cover, which means practically till whenever you are alive, the cover is there. So you would get get the death benefit whenever, or your dependents get the death benefit whenever you die.
And Mr. Satishwar was telling us that now there are flexible plans which are also offering some flexibility. Like, okay, now I'm 60, I don't need the policy anymore. Or maybe at 65, so I can exit whenever I want, is it?
Not whenever you want. So the option has a very specific schedule. So as you said, right, the core purpose is income replacement. So I should ideally be covering it only for the working age. But you can actually also plan legacy, and the insurance company provides for it. If you want to buy it till, say, age 80, you can buy it till 80. Now, so suppose if you bought a policy till age 70 or 75, right? And by the time you're age 50, you would have created some corpus for yourself. So that is, of course, it's kind of taking care of that. But you're now free of all your obligations. Your kids have grown up, they're on their own, right? There are no liabilities on your head. Do we need an insurance company? Insurance is basically required where somebody is dependent on you. So you can choose at that point in time, say age 55, saying, okay, I don't want my insurance cover. And the insurance company actually says, okay, in that case, I bought it till 75, but age 55, I'm saying, okay, I no longer need it. So we insurance companies also actually kind of enable that process by saying that, okay, you can cancel your policy and we will pay all the premiums that you've paid till date back to you.
Okay.
Right. So that's an option. So it's okay. When I'm buying it, I've decided all the way till age 70 or 75. But it also gives me an option to get my money back, saying, okay, I no longer need it. Let me take my money back.
So two important things. First of all, the amount that you need, and then for how long do you need that cover to last? Two things to think about. Amit, what else?
I think a couple of riders which are additional protection covers that you must look at. One is a critical illness policy. So just basics, right? A term insurance protects you from death. You know, in case you die, your dependents will get money. What if you get cancer or a heart problem or a liver problem and you are actually out of your work for the next 6 months? You don't get any money from your term insurance policy. Your health insurance policy will pay for the hospitalization, but it will not pay your salary. You will be out of office, you will not get your salary. So there is an income loss that happens at that point in time. In fact, we were discussing last week as well, you know, around the health insurance topic as well. So critical illness coverage is extremely important, and it's again one of those topics which are not spoken about much.
Because
in the Indian
I mean, you don't plan to have suddenly like a liver issue or a kidney issue, so you don't build that in.
Exactly. We talk about hospitalization covers. We don't talk about income replacement in case a critical illness happens. So that is one important rider that should be looked at. And the second is accidental disability. See, again, term insurance covers for death. Health insurance will cover for your hospitalization. But what if there is a disability?
And you can't earn that much anymore.
And you can't earn. So that is what the personal accident cover, which can be as an add-on to your term insurance policy.
So these critical illness covers or the accidental, the personal accident covers, they are usually provided by the life insurers because they're income replacement products, is it?
Both do actually. So you can take from a life or a non-life company.
And what's the advantage either or? I mean, why should you opt for a life insurance product versus something coming from general insurance?
So the structure varies a bit. Like for example, in a critical illness policy from a general insurer or a health insurer, it will behave like a health insurance product in the sense it will get renewed every year. The premiums may change every year. In case you're buying from a life insurance company, it will behave like a term insurance product. So the premiums will be capped and the same premium will be paid, through the lifetime of the product. So the structure is different, the benefits are the same.
Okay, but something to consider for sure. Quick last thoughts. I think we have just the last, 2 minutes on the show. So, Mr. Satishwar, what would you say to people out there who are finally, ready to buy that term plan? What should their checklist be like?
The very fact that they're ready to buy a term plan, wonderful decision made, right? And I strongly believe it's an essential commodity or essential product to have, right? Because you don't think about death, but it's there. The only suggestion that I have is whenever you buy a plan, one is adequacy of the cover, but the other one is talking about your identification. Please ensure that you have given the right documents for the identification. So KYC is a must. Satishwar is Satishwar. Okay? The reason why certain claims get denied at a later point in time is somebody else represented Satishwar. Okay, that happens, and which is fraud, right? So, and might be the policyholder himself is not aware of it. Could have happened, but the piece is basically again. So documentation, digital documentation is taking care of it. So as insurance companies, we have actually made that process much more efficient, much more lighter, but you'll have to spend that time on it. Right? So one is KYC, ensure that you are actually present and doing it. Two is there are specifically certain declarations that we ask in the application form. These are not very lengthy, should be in the range of 12 to 15 questions, which are simple lifestyle related questions and health related. Please ensure that